Minute to go until the start of cash equity trading on Francine Lacroix in London with Tom McKenzie.
And here are your top stories. Debt ceiling optimism. President Joe Biden and House Speaker Kevin McCarthy postpone today's meeting as staff-level talks are said to make progress. Stock futures are in the green. It's a hopeful sign as central bankers and finance ministers gather in Japan for the G7. We speak exclusively with Treasury Secretary Janet Yellen this hour. Meanwhile, JP Morgan CEO Jamie Dimon warns that a US default would be, quote, potentially catastrophic. We'll hear more from yesterday's interview.
Now, Tom, if you look at the futures, as you're rightly saying, they're in the green for the moment. There's a bit of rapprochement between the U.S. and Beijing that investors are looking at. And then if you look at yields, actually investors, I guess, also weighing signs of a cooling U.S. job market with the rest of the world.
Yep, slivers of optimism coming through on the geopolitics and on the debt ceiling. Of course, on the geopolitics, Wang Yi and Jake Sullivan having 8 hours of talks. Whether that opens the door for further conversations and even potentially a meeting between the two presidents, of course, will be consequential in terms of that geopolitical risk. The FTSE 100 currently gaining 4 points in the session. We continue to look at the pressure coming through from commodities, how that feels into energy sector and basic resources. On the inflation front as well, by the way, the Spanish IBEX currently up 0.4%. We continue to watch the details and the data coming through from the Eurozone as, of course, ECB members debate how far to go in terms of the rate hike cycle there after adding 25 basis points. The CAC currently gaining 0.6% over in France, adding 41 points. Here in the UK, the FTSE 100 now up 0.2%. Let's flip it over then and see how things are working out cross-asset. Yes, on the data front, last night seems to think lining up with the Fed in terms of supporting that view, potentially around a pause from the Federal Reserve, particularly when you look at the jobs claims, the highest numbers in about 19 months. So that will be supported. That's good news, ultimately, of course, for the Fed in terms of their work to lead to some softness in the labour market. You also have producer prices coming in lower than expected, suggesting again that inflation is heading in the right direction as far as the central bank is concerned. The CPI numbers, talking of inflation coming through from Spain, currently CPI rising 6.6%. This is for the month of April, year on year, in line with the estimate. So it's an increase of 6.6% in terms of inflation out of Spain year on year, in line with estimates. Euro dollar currently trading at 109. It's been along that. It's barely broken above 109 in the last few weeks. Currently just up 0.1%. Fran.
Now, we're getting quite a lot of breaking news from Michelle Bowman. Michelle Bowman saying that it's not clear, of course, of the Fed, saying not clear if the Fed policy is restrictive enough. She's also expecting rates, or she says rates need to stay restrictive for some time. Now, there was a big interview, of course, that she's giving to our colleagues over in the news agency. She also says, look, if inflation rates remain much too high, then they'll need further tightening. She's basically saying that there's a lot more that the Fed could and should do. She's one of the biggest members that is very quite hawkish. I don't know whether it's moving euro dollar, but certainly we'll keep a very close eye on the market reaction to that fantastic interview.
Okay, and the markets, of course, traders still pricing in cuts, and there's the pushback coming from the markets, down to 4.2%, around 4.2, 4.3% by the end of the year. But those comments, of course, from Fed official Bowman being weighed up by investors as well. Now, US President Joe Biden says the debt ceiling meeting with House Speaker Kevin McCarthy and other congressional leaders, well, it's been pushed from Friday to next week. Speaking exclusively to Bloomberg, JP Morgan CEO Jamie Dimon warned of the dangers of a US default.
Actual default. That is potentially catastrophic. And you can go through a million ways and but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic. Markets get volatile. Maybe the stock market go down. The treasury markets will have their own problems. It's amazing you already have certain T-bills trading 3% and right next to them 5%. This is not good.
All right, joining us now is Claudia Pansera, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management. Claudia, good morning. You heard the warnings there then from Jamie Dimon. Not surprising, but of course we take note of his words. How do you position around these debt default risks?
So good morning. Thank you for having me this morning with you. Yeah, our positioning, I have to say, is pretty defensive since March. We agree with many things being said about interest rate remain at very high level. We don't expect the Fed cutting rate this year just because the economy is still very strong. You mentioned before about inflation coming down, but the overall level inflation is still very high versus the targets of the central bank and especially of the Fed. And the Fed usually cut rates when there are two situations: when inflation is low, and is not the case, is falling, but still above the target. And secondly, where we are in recession, and mentioned before, unemployment rate is all-time low. So clearly the two conditions for having a rate cut is not there. And at the same time, you have US stocks, which are trading 18.8 times, which is a multiple consistent with an expansionary economy, or alternatively with a cutting rate. So I see this market environment pretty difficult to read, but I also think that the rally we had recently is overdone.
But Claudia, and good morning to you. When you look at the concern over the debt ceiling, and we spoke to Jamie Dimon, he says, look, there's a war room, they talk about it, they meet up once a week, and then they'll meet up much more. If we have a US default, it will reprice all contracts, all treasuries, unclear when that day is. So tactically, how do you play the markets ahead of a possibility like that?
We think that volatility will remain very high, but we don't think about a default of the debt. We still believe that there will be an agreement few days before or at the X day, but we are cautious, and the way we are playing these is, for instance, being underweight equity versus high-grade bonds and investment grade, high-quality investment grade in US, because we believe that volatility on the equity market is too low, while some weakness and some risk are priced in the treasury. So clearly this low positioning on US equity is a way to be positioned for such an event.
Okay, so underweight, or at least reduce your exposure to US equities, looking at high-grade credit around this potential event. Of course, Jamie Dimon also speaking to Francine about the bank woes, the bank crisis, the bank pressures, regional banks in the US. Do you see that as an event that's now behind us? Does it now move on to commercial real estate? What is the next shoe to drop?
Unfortunately not. I think volatility remains pretty high. We are slightly negative on US banks. We are neutral on European banks. We don't believe that there is the same risk in Europe than in US. The risk on US banks is having more regulation, more rules, more requirement, as Jamie Dimon was announcing yesterday. So less profitability, impact of earnings in the month to come. And as long as rates remain at very high level, new deposit outflow is a risk. So this is also why we are cautious on US. I think there are plenty of elements which are not fully priced in the US market, even if the breadth of US market is very tight. So you have plenty of segment which price very low multiple, the risk of having a risk of a debt ceiling, the risk of having some, let's say, impact still on commercial real estate and US banks, but the overall market is still too expensive. So volatility should pick up, is very low. I will be very careful also on this rallying on the tech, which people have been seeing as a way to run away from cyclical high debt companies in US. But I want to remember that tech in US is cyclical, is exposed to consumer spending, and so is at risk when it's trading above 20 times.
Claudia, thanks so much. Claudia Panseri, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management, stays with us. Now, coming up, don't miss our exclusive conversation with the U.S. Treasury Secretary Janet Yellen. Our Anne-Marie Hordern will do that from Japan at the G7. It starts at 8:45 a.m. London time, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Season is here.
Earnings season is in full swing.
The UK consumer is still strong.
Bloomberg breaks the numbers first.
UniCredit smashing the earnings.
Underlying sales up by 10.5%. Volkswagen, BMW.
Deutsche is on fire.
With exclusive expert analysis.
The first quarter was very challenging.
Do you worry about the supply chain?
I'm really pleased with the quarter's result.
What's your timeline for this actually being able to reach market?
Our business remains very resilient.
The overall performance has been stellar.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to the Open. We are 11 minutes into the European trading day this Friday. It's currently seeing gains across the European benchmark of close to 0.4%. Futures in the US also pointing up. Focus on the pound, pairing some of the earlier losses in terms of the growth picture. The UK actually notching up a very slim growth in the first quarter. Euro dollar currently trading at 109. And of course, weighing up the jobs claims data out of the US, suggesting that maybe there's a little bit of softness coming through for the labour market in the States. Fran.
Now, Tom, JP Morgan Chief Executive Jamie Dimon says regulators will do whatever they need to do to end the banking turmoil. In an exclusive interview, Dimon says that policymakers will take away the wrong lessons from this year's upheaval.
The debt ceiling is potentially catastrophic.
Yeah.
So that's a whole different issue. Hopefully it won't happen. You know, the banking crisis, I still believe, will kind of sort its way through, and it's not anything like 08 or 09. Only a couple of people offsides with all these various things, which you knew about. So hopefully, you know, it's getting near the tail end of that.
But if you're Janet Yellen right now, what would you do differently?
I don't know. I think we need to finish the bank crisis. I think we've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. So, you know, whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, not be surprised constantly, because some of these things have been known about for quite a while, and so we've handled 3, SVB, Signature, First Republic, and so...
Yeah, so
but
are you asking
but I think it's very important. The regional banks, who I've been speaking to like every day for the last week, they're quite strong. They're quite worried because of the run on deposits, all that, but their financial results are good. Their financial results are going to be good, okay, next quarter. They're earning money. They've got very good clientele, very diversified, and they're quite strong.
So, Jenny, for like a comprehensive solution. So, if you're asking Janet Yellen to get the job done, what does that look like? That solution?
I'm not asking for a comprehensive solution.
Why not?
Just be prepared for problems. We don't need a comprehensive solution.
What do we need right now? Do we need regulators to look at short sellers of banks?
Yes. Look, my folks would tell me that that's not the problem, the short selling ban. If you actually analyze stocks and short sales, doesn't seem that big a deal. I think they may partially be wrong because, as you know, some people are unscrupulous and they use other means to go short. I think that but if you look at the detail, the SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales, and they should go. If someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them, and vigorously, and they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it, but my experience in life has been don't assume too much.
Do you think things will change because of this? Is this like a catalyst?
I think it's going to get worse for banks. I think that
what do you mean by worse?
It's just more regulations and more rules and more requirements. I hope they do it very thoughtfully because, we love the community banks, the regional banks. We're the biggest bank to those folks. But, if you overdo certain rules, requirements, regulations, some of these community banks tell me they have, more compliance people than loan officers. And so at one point you make it harder for them to do business. There are already hundreds of rules in place. And in a lot of ways, it's the mix of the rules. If you're going to change liquidity, maybe not capital. If you're going to change capital, maybe not liquidity. If you're going to add TLAC, then maybe you should do something with deposit insurance. They should sit down and have a very thoughtful conversation about what those things are and what we want the outcome to be. And if you look at the present outcome, a lot of things are leaving banks. And they should. If that's what they want, so be it. But that should be done with the forethought. That should not be done because you're just putting rules and regulations in place and you don't know the consequences.
All right, always fascinating, of course, with Jamie Dimon, JP Morgan CEO, speaking to Francine yesterday. Let's bring back Claudia Panzaro, then Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management. Claudia, you talked earlier about the opportunities in bonds. Is the window closing on being able to lock in these yields?
Not yet. I think there is some space to see some central bank, essentially in the Eurozone and UK, to keep hiking interest rate. But we are very close. We are very close, and bond yield and especially the short term of the yield curve should remain at very high level. According to us, we are not expecting any rate cuts for this year in US, not in Europe. So, but I think for clients which have been facing real rates negative for so long period of time, the opportunity is really impressive. When you look the level of yield and the total return in the coming 5 years, this is an excellent opportunity to lock in a high carry and the good performance of coming of a peaking of the rates.
Claudia, when you look at where then you want to be invested, so we also asked Jamie Dimon what he'd do with $1 million, I said, of his own money. And he basically said, well, I wouldn't buy sovereign bonds, but you see certain opportunities in parts of fixed income.
Yeah, I think for clients which want to reduce the volatility, want to have some carry, clients which are concerned, as we are, that the economy is slowing, having some bonds make a lot of sense now after a year of very low yield. For clients which have a long-term view, which are happy to look after 2023 and beginning of 2024, where volatility may stay still high, there are plenty of opportunity as well in equities, but outside US. Across the sector, I like the most, for instance, there is one which is cyclical, which may face some volatility, may have to come, but huge opportunities stand ahead, like industrial. There is a re-onshoring, there is huge amount of CapEx spending out of the governments on defense, and is benefiting, from instance, from energy transition. Is a sector which is not expensive, but is underperforming tech. So people continue to look into secular growth in tech, while you have secular growth opportunity outside tech at a reasonable price.
Claudia, what do you do with commodities in this environment? You're seeing iron ore below 100 per ton, WTI at $70 a barrel, Brent at $74 a barrel. Has the commodities trade run its course?
Yeah, we are still positive on commodities. I think the positive element of the commodity is more driven by energy and oil, which is undersupplied. There is still rising demand, increasing traveling across Asia. And clearly, we don't take into account another intervention, which cutting potential production in the month to come. So we clearly still expect a big upside on the brand in the month to come. For the other commodity price, I think we need to wait probably a bit more to see the upside, which is linked to China recovery. So far, China recovery is mainly focused on the services side. We didn't see a big improvement in industrial production. Manufacturing is still very weak. I think commodity will benefit from a second stage of recovery in China, which is not, I will say, something we expect in the very short term, but rather for the second part of the year.
So if you believe that there's more dollar weakness to come, Claudia, how do you take advantage of that?
I think there are many ways to look at the weakness of the dollar. In the currency space, is being exposed to currency which are very cheap. This is the case, for instance, of the Japanese yen. Is also in relative term, the euro look still very attractive. The Swiss franc is also very attractive in the very long term, is a very resilient currency, volatility picking up. If you look into our space, like equity, for instance, a falling dollar is positive for emerging market. Emerging market at China have been performing in line with other regions, and I think with depreciation of the dollar, you may have more upside on emerging market. And also the gold. I mean, gold has been performing very well, but if the dollar continues to depreciate, we may have a further upside on the gold. So there are plenty of opportunities which clients may look at with the dollar weakening. Of course, dollar weakening also means probably be aware there is sensibility of some other currency appreciation may have on earnings. So it also means that people need to do some extra work to see the impact of appreciation of the Swiss franc, of the euro on corporates.
Claudia, thank you so much. Claudia Panzeri, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management. Now let's get straight to the Bloomberg Business Flash. Here's Sarah Halls. Hi, Sarah.
Hi, Francine. Sources tell Bloomberg that at least 8 senior Credit Suisse bankers are leaving the firm for Santander. Mergers and Acquisitions Chief Steve Geller is said to be amongst them. We're told the moves reflect how Santander is expanding in the US. Representatives for Credit Suisse and Santander declined to comment. The Wall Street Journal reports that Linda Yaccarino, NBC Universal's head of advertising, is in talks to become Twitter's new CEO. Elon Musk tweeted he is transitioning his role at the firm to executive chair and CTO, where he'll oversee product, software, and system operations. Musk says the new CEO is slated to start in about 6 weeks. Carl Icahn's holding company has authorized the buyback equaling almost 27% of its shares trading on the open market. This potentially boosts the stock price as the financier feuds with Hindenburg Research. Meanwhile, the short seller has hit again at Icahn Enterprises. It says the famed corporate raider failed to disclose enough in response to questions raised in its earlier report. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Tom.
Sarah Halls in Dubai, thank you very much indeed. A couple of lines dropping from the recently appointed new head of UBS, of course, which is combining Credit Suisse, Sergio Amotti, and giving some details around the time frame for closing that deal. Amotti saying that they are on track to close the deal within 3 months from the announcement, saying that Kerner, of course, who was the head of CEO, that the role of Kerner is important in making Credit Suisse's integration work, and also saying, Amotti, that the merger doesn't create a bank that is too big for Switzerland. That, of course, remains a concern, Fran.
Yeah, what's interesting is, of course, we heard from the chairman, who has always been quite plain speaking with the markets, that, look, it takes 3 months for the transaction, this is a legal transaction, to go through, but then the integration, as you try and figure out what happens with the Swiss banking, what you do with, of course, Asia and some of the wealth management, will take 3 to 4 years. So it's not going to be a simple task. If you're a Mahdi, if you're a Colm Kelleher, then you're basically running a bank whilst integrating. So again, you're kind of driving a plane whilst trying to build it. Not easy.
Not easy at all. There's the 2 timelines then that you outlined: 3 months to complete, and then that 3 to 4 years to actually ensure that the integration is finished and wrapped up, tied up with a bow. Let's see if that happens. And of course, at a time when we know that Credit Suisse staff and some of their top leaders in parts of the world like Asia are moving. We've had stories around a number of their senior staff moving to Santander just in the last 12 hours or so. Right, coming up, we head to Turkey to discuss fresh uncertainty for the presidential election this weekend. That is next. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Let's check in on some of the stocks on the move. Broadly, of course, you're seeing gains across these European equities. A couple of individual names. SocGen coming in with a beat in terms of the FIC part of the business, particularly strong. SocGen currently up 0.2%. Richemont also coming in with very strong sales, boosted by China, up 5%. THG Group, though, very different stories. They break off talks with Apollo, currently down 14% and well below their IPO price of back into 2020. Fran.
Coming up, don't miss our exclusive interview with the U.S. Treasury Secretary Janet Yellen. That's must watch. Our Anne-Marie Horton will bring us live from the G7 in Japan. It's in about 20 minutes from now, 8:45 a.m. London time, and this is Bloomberg.
along and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Debt ceiling optimism. President Joe Biden and House Speaker Kevin McCarthy postponed today's meeting as staff-level talks are set to make progress. U.S. futures are in the green. It's a hopeful sign as central bankers and finance ministers gather in Japan for the G7. We speak exclusively with Treasury Secretary Janet Yellen this hour. And JP Morgan Chief Executive Jamie Dimon warns that a U.S. default would be potentially catastrophic. We'll have more from yesterday's interview. Tom, when you look at the markets, they seem to be a little bit more upbeat than they've been of late.
Yeah, there's a little bit of Friday optimism eking into this. And of course, part of the mix will be the staff level talks that continue around the debt ceiling, as we mentioned in the headlines, but also talks starting between China and the US. Will it lead to the two presidents finally having a conversation after, of course, the risks and the tension between the two sides? You're seeing gains of 0.4% across the benchmark. Here in the UK, we managed to eke out some very meager growth in the first quarter. We've had, of course, the up revisions to those growth forecasts coming through from the BOE after that 25 basis point hike yesterday. The DAX currently posting gains of 58 points over in the UK. Then the FTSE 100 currently gaining 0.4%. Across your sectors, the leadership coming through from the likes of consumer. We have some good news stories around luxury, but also the banks as well. SocGen coming in with a beat, particularly around its fixed income trading and lower loan loss provisions. European banks all performing pretty well, the majority at least, particularly around fixed income. And again, lower loan loss provisions. That has been a story across that sector. Consumer currently up 1.4%. Retail also gaining. But on the list, you've got the likes of basic resources, energy, and auto parts. Fran.
Now, Tom, Turkish voters head to the polls this Sunday for the country's general elections. A race expected to be tight amid growing economic concerns. So let's head straight to Bloomberg's Youssef Gameldin, who's in Istanbul for us. Youssef, good morning. So if you set the scene, what should we look out for this weekend?
Well, Fran, there's a lot at stake, and I would say these are the most tense elections that I have witnessed over the last 15 years, for sure. On Sunday, the voting stations are going to open at 8 a.m. local. They're going to close at 5 p.m. in the afternoon. If we don't get a clear winner, then this goes to a runoff on May 28th. The real question is what happens with the remaining presidential contenders. Initially, there were 4. It boils down to 3. Muharrem Ince dropped out. There's a sex tape, alleged sex tape that came out. That's been rejected from his side, but he nonetheless leaves the race, which leaves 2 main contenders and a third one. The 2 main ones is the incumbent Recep Tayyip Erdogan, and then the credible threat emerges from Kemal Kılıçdaroğlu. There's a lot at stake for the economy. The Turkish lira is at a record low. Foreign investor participation has eased ever more. And on the political side of things, you look at how the government has responded to the earthquake. that's a big debate here on the ground with many of the people I speak to when the 50,000 people died in that earthquake. And just a quick note on the currency as well, because a note out from HSBC and JP Morgan, and they're seeing potentially even more weakening from existing record lows, so maybe 24, 25 against the US dollar over the next 3 months. Regardless of what outcome we get, Fran, the top priority is going to be execute swiftly to save this economy, guys.
Okay, Yusuf Gamaluddin setting out what is at stake domestically for Turkey, but internationally as well, and for investors looking at that economy. Thank you in Istanbul for us previewing those elections. Now, US National Security Advisor Jake Sullivan and China's top diplomat Wang Yi met in Vienna as both sides work towards improving relations. The US and China have both described the meeting as substantive and constructive. For more, let's bring in Michelle Jamrisco, then, Bloomberg's senior Asia economy reporter. Michelle, put these latest talks into context. We know Bloomberg's reporting has suggested there's been a lot of outreach, particularly from the US side, to start conversations. Are there reasons for investors to be optimistic, or are we jumping the gun a bit?
Well, maybe it's that Friday optimism you were talking about, Tom, but it was really a low bar, right? They hadn't had a high-level meeting since the spy balloon incident, which seems like ages ago now. So this has a first step to it, to the groundwork that you're talking about, to lay the groundwork for a Xi-Biden call, which, as you mentioned, our colleagues in Washington, Peter Martin and Jenny Leonard, had a great story earlier this week about the U.S. kind of pushing those invitations to talk on all levels, and in the hopes that if China remains rejecting these calls, that they'll look like the recalcitrant one, they'll look like the ones being difficult. We'll see how that goes. It kind of sounds like a desperate dating strategy there, but investors did look kindly on this meeting. Some pointed to it being a reassurance that the two sides wouldn't let things get out of control, they wouldn't get into a vicious cycle, and others kind of pointed to maybe a calm before the storm, as we've got a lot going on in the tech space, especially other geopolitical strains, and as well a U.S. presidential election cycle that's going to be heating up with a lot more counter-China rhetoric.
So, Michelle, and the U.S., of course, said to also send flurries of talks and meeting invites to China. Like, when do we know if there's something fruitful in there, like if we actually achieve anything?
Yeah, it's hard to tell, Fran. I mean, there's so many developments, as we mentioned, they're talking about Russia, Ukraine, all the thick geopolitical issues in this meeting between Jake Sullivan and Wang Yi. Of course, those are coming up at all levels of talks between the two countries and staff. And China has been resisting a lot of these invitations, the thinking being that they don't want to lose the upper hand here. They don't want to kind of kowtow to the U.S. invitations before they're ready with all of this other stuff going on. And that other stuff, including what's going on this week at the G7 finance meetings, where, there's a not so thinly veiled effort by a U.S.-led group to kind of propose this supply chain partnership that's going to make its way into the statement at the end of these meetings, all about kind of reducing countries' reliance on China for things like critical minerals and sensitive technology materials. So in that sort of atmosphere, it's easy to see where China might not be so eager to jump on the phone just yet with the White House.
Thank you so much, Michelle Jamrisco there, Bloomberg's senior Asia economy reporter, always on point. Now, coming up is the end in sight for the BOE's most aggressive hiking cycle yet. We bring you more of our interview with the governor, Andrew Bailey. That's coming up next, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
Welcome back. Let's see if this Friday optimism holds. You're seeing gains of 0.4% across the European benchmark. 39 minutes into your European session. Gains in terms of the US futures. S&P evenings up 0.3 as well. Let's get the Bloomberg First Word News now with Sarah Hall. Sarah.
Hi, Tom. US President Joe Biden's debt ceiling meeting with House Speaker Kevin McCarthy and other congressional leaders has been pushed from Friday to next week. According to White House officials, the postponement is a signal that talks are making progress in a push to avert the looming fiscal crisis. The president will instead meet with congressional leaders early next week. The largest banks face billions of dollars in extra fees to replenish the U.S. government's deposit insurance fund. The assessment from the FDIC stems from the regulator's decision to insure all deposits at Silicon Valley Bank and Signature Bank. The FDIC estimates that move costs its deposit insurance fund around $15.8 billion. Thailand's consumer confidence in April has risen to highest level in more than 3 years. The index climbed to 55 from 53.8 in March. The University of the Thai Chamber of Commerce says pre-election spending and forest tourist arrivals are boosting spending. Consumers are estimated to have spent up to $886 million in the run-up to the election. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Francine.
Sarah, thanks so much. Sarah Halls in Dubai. Coming up, don't miss our exclusive interview with the U.S. Treasury Secretary Janet Yellen. That's next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open. We are 44 minutes into the European trading day. You're seeing gains of 0.4% across the European benchmark. Futures in the US also higher by 0.3 across your sector. Consumer products leading the charge, gains of 1.3%. You have a boost for luxury, and on the earnings front as well, a good picture coming through from SocGen as the CEO, O'Dea, of course, looks to step down after 15 years at the helm. Bottom of the list, you've got autos currently down 0.8%. The big picture, of course, one of the key headlines for the day is it seems there's a little bit of traction in terms of the staff level around the default ceiling. We're a long way from a resolution, but the meeting that had been penciled in Friday between the president and his Republican counterparts, that's now been pushed back as staff level meeting. But you used to be seeing Jamie Dimon, and he came out with some pretty strong comments on this.
Yeah, but I think there's just one urgent question that people want to know is actually what happens if Treasury runs out of cash? When does it run out of cash? And actually, what are some of the contingency plans? So we did speak to Jamie Dimon, that was yesterday, and he said he set up a war room looking at contingencies. The chief executive officer of JP Morgan basically said that at the moment they're meeting once a week. I did ask him whether he was in touch with Janet Yellen. There was a rumor that Janet Yellen had called him and say, like, look, what happens? And this is a kind of modeling of game theory because it would hurt the contracts, it would hurt treasuries. He didn't want to disclose that. He said it was a private conversation, but that they're meeting on this every week within JP Morgan. And then as the deadline gets nearer, maybe twice a week and then 3 times a week, and then let's see what happens with the market.
And that's really fascinating detail in terms of how the biggest bank in the land is working to isolate themselves, or at least building out contingencies for this potential risk. You have to wonder, of course, if other banks are doing the same thing. Of course, June the 1st is when the US Treasury sector had flagged as the X date. And you have the likes, of course, of ex-PIMCO head Bill Gross saying you may want to buy in to the short end because he thinks ultimately it will get resolved. But of course, the gathering of G7 central bankers and finance chiefs comes at an awkward time, given all of that, for the US, as America attempts to project its leadership on the world stage in Japan. A different story, as we've been touching on, is unfolding at home. With politicians in Washington unable to agree on that new debt limit, the country is at risk of defaulting for the first time ever. Anne-Marie Hoden joins us now from Niigata, Japan, alongside a guest for an exclusive interview. Not just any guest, Anne-Marie.
That's right, Tom. Thank you so much. We're pleased to be joined by U.S. Treasury Secretary Janet Yellen. Thank you so much for joining Bloomberg TV here in Japan.
Thanks for the invitation.
Oh, excellent. So, unfortunately for you, in a way, what is looming over this G7 meeting is these concerns coming out of Washington, the debt ceiling negotiations, as well as still tremors in the banking industry. I want to start with the debt ceiling.
Sure.
Of course, Wall Street is very concerned about this. There is that X date approaching that you laid out, potentially as soon as June 1st. But there's an assumption on Wall Street that if there's no negotiated deal after June 1st, Treasury will still maintain payments on securities. Is that assumption correct?
Look, you know, all I can say is that there is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
But this plan was outlined back in 2011, and you were there at the FOMC meeting about it, and it said that Treasury principals and securities would be paid. Is this something that, at least for contingency plan, has been discussed with the president?
So my understanding, I was at the Fed in 2011, is that this plan was never presented to the president and never approved. But
would you present it now?
Look, we would. We are working full time to work with Congress to raise the debt ceiling. That's where our focus is. We know that the only good outcome is one in which Congress acts as it has many times, almost 80 times since 1960, to raise the debt ceiling. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills that we've incurred as a consequence of our legislation, that we're not a deadbeat country. And if Congress fails to do that, it really impairs our credit rating. We have to default on some obligation, whether it's treasuries or payments to Social Security recipients. That's something America hasn't done since 1789, and we shouldn't start now. So we've not discussed what to do. If that doesn't occur with the president, our focus is on getting it done.
Because as you know, treasuries are the bedrock of the global financial system. And the asset managers I speak to, the investors, they don't have the luxury of not contingency planning. So at this point, should they assume that debt may not be serviced if there's no deal?
Look, if Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that that gets done.
As we get closer to June 1st, will you alert Congress on a more precise date?
Yes, I will update Congress as we have available information. But
anything new now, or still June 1st?
Well, what I've said is early June, and potentially as early as June 1. As we get closer, I may be able to provide more refined guidance. But, you know, there is a lot of uncertainty about the exact level of cash balances and payments that we have to make from day to day. And so there remains a level of uncertainty about precisely when we would run out of cash to be able to pay the government's bills.
Jamie Dimon was on Bloomberg TV yesterday, and he said he set up a war room for contingency planning. Are you actively speaking to executives?
I have talked, not within the last few weeks, but earlier, around the time in January when I sent my first letter, I talked to a number of bank executives. More recently, I've talked to leaders of businesses in different sectors of the economy, and I will be meeting with senior bankers next week when I get back. But I want to understand how they're thinking about the debt ceiling. And what I'm hearing is that it is a grave source of uncertainty that is one of the things that businesses are really concerned about, one of the biggest sources of uncertainty in terms of many big American businesses.
That's what we're hearing too at Bloomberg. How frustrated are you potentially that these bank executives you're speaking to are not putting pressure on Congress, particularly Republicans?
Well, you know, Wall Street executives and American business people have always spoken out about their concerns about the debt ceiling, and I think it's appropriate for them to talk about how they see the debt ceiling is impacting the American economy and the global economy. So those voices, we want to hear voices of people who will be affected by this.
On top of all this, there's still some tremors in the banking system. In 2 months, almost to the date, we've had 4 U.S. lenders fail. But the administration continuously says that the banking sector is sound and resilient. Is that a fair assessment when you look at the regional banking sector?
Well, the regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics that have made them vulnerable. The banks that failed tended to have substantial losses, mark-to-market losses on their hold-to-maturity portfolios. So although their regulatory capital wasn't impaired, their tangible equity was diminished, and they simultaneously had a very high proportion of uninsured deposits, and that profile is not very common. But look, a lot of banks, particularly regional banks, are seeing their earnings come under pressure. The amount that they're having to pay for deposits is rising, and in many cases their investments are at lower interest and their stock prices are coming under pressure. But most banks now, even including the ones that are seeing pressure on their stock prices, have solid liquidity, would be able to manage paying off uninsured depositors if they were to flee.
Are you confident no other regional or small lenders will fail?
Well, look, I don't want to talk about the situations of individual banks, but what I see is a banking system that overall is well capitalized, still has very solid earnings, and we've improved the available liquidity to the banking system, and think that banks are going to be able to survive this. But, you know, we're monitoring the situation very, very carefully.
The other big elephant in the room at this G7 meeting is, of course, China. And you spoke about this yesterday, how you're working with your peers to look at outbound investment, potentially. When it comes to China, this would add on to what the United States has already done with export controls and sanctions. And you recently gave this speech about China and how the U.S. views economic policy. And what you made clear is that national security concerns will be paramount, even if it becomes to economic concerns. So
That's right.
I'm curious why the U.S. still has tariffs on China if that is an economic benefit to many U.S. consumers.
Well, look, you know, there was a so-called 301 action that was filed against China for unfair trade practices. And China was found guilty of 301 violations, and those tariffs were put on place as retaliation for unfair trade practices. The Trump administration arrived at an agreement with China that might have led to lowering them. China didn't carry out their part.
But is there any national security concerns about clothing or upholstery?
No, that's not a national security concern. That's unfair trade practices. So that's not national security related. We do have concerns with some of the practices that China has engaged in with respect to trade and investment, whether it's forced technology transfer, massive subsidies to industries that really distort patterns of international trade.
Yeah, and that'll be a big topic as well when President Biden meets with the other leaders in Hiroshima. But also on China, I know that you're looking forward to potentially going to Beijing. You said at the appropriate time.
Yes.
We now have your counterpart in place, Ho Li-Feng. He's been there for several weeks. So are there any plans in the works?
I expect to travel there. I can't tell you what the date is. We have a number of senior American officials that are likely to go. We need to sequence them appropriately, and
will you be the first?
I don't know who will be the first, but we're working with the Chinese and discussing among ourselves what the appropriate
Any
sequencing
phone call yet,
is.
though, with Hu Lifeng, or you're just going to wait till you see him in person?
I haven't had contact yet with my new counterpart.
And if I could ask one final question, Madam Secretary, I know you're staying on for the remainder of the Biden administration, but President Biden also announced he's running for 2024. Would you consider another 4 years at Treasury?
Well, look, I was really thrilled to be asked to serve. I've really enjoyed the position I have. I have a lot of work to do, and that's a topic I have not yet given any thought to, but I would like to stay until the end of his first term and continue on the important agenda of work that we have at Treasury.
Okay, so not a no yet, maybe 2024 and beyond. Janet Yellen, U.S. Treasury Secretary, thank you so much for your time.
My pleasure.
That was the U.S. Treasury Secretary, of course, Janet Yellen, here at the G7 meeting. And of course, what's overshadowing all the work her and her peers are talking about is what's emanating out of Washington. And that is still this overhang on the debt ceiling, as we are now just 3 weeks away from as soon as we can hit that X date, June 1st.
Anne-Marie Herduran there with a great, fantastic interview, of course, the Treasury Secretary, Janet Yellen, who says the only good outcome is Congress raising the debt ceiling. Janet Yellen has mostly declined to really spell out what her department would do if Congress fails to raise the ceiling or actually suspend the debt limit before the Treasury finds itself unable to pay a lot of their obligations. Anne-Marie really trying to push Madam Secretary to give us some kind of indication of that. They also spoke about U.S.-China. Now, let's bring in our EMEA News Director, Ross Matheson, and our markets reporter, Tassos Vossos. Thank you both for joining us. Tassos, this was a great interview, really trying to figure out what happens with the debt ceiling. How much anxiousness are we going to see from now until June 1st as we get closer to that debt limit?
Well, you can say that this is the main risk that investors are facing right now. Whoever you speak to, they're going to say, what's going to happen with the debt ceiling? And the problem is that we don't have too many examples of what happened in the past. So we had 2011, and in subsequent cases. And one thing that people are pointing to is the fact that in addition to what's happening with the debt ceiling and the negotiations there, also what happens with the Fed's balance sheet. If the Fed's balance sheet is increasing, things tend to be fine. If it's not, as it is now, then it tend to be quite iffy.
And I want to ask you actually, concretely what happens. So we know there's a repricing of contracts and treasuries and things like that. But Roz, when you look at what we know so far, so negotiations today have been suspended because we understand that at a lower level, the guys that really get down to business and kind of try and find an agreement, that's going pretty well. Is that a real indication that we could have some kind of agreement, or is it just too soon to say?
It's really too soon to say. I mean, the messaging that we got from that was we're actually not, there's no point at the senior level us meeting because they are making progress at that lower level. But what that progress is remains unclear, and just how quickly it's moving remains unclear. And we are coming up not just against the June 1 deadline, but also the US president is due to leave the country later next week to travel to Asia for the Group of 7 summit. And he will want to get this wrapped up potentially before he goes, or at least a sense it's moving in the right direction. So there is talk, of course, the US president will meet with the House Speaker early next week, perhaps after a weekend of lower level talks. But at this stage, we just don't know how fast it's progressing and what's really on the table. And to the point about markets, really, what we're seeing is Janet Yellen just in the interview a short time ago, again, not really indicating what the Treasury would do if we do reach this deadline without a solution.
Yeah, and I guess, we did hear from Joe Biden that the administration could continue making some of the payments, invoking the 14th Amendment of the Constitution. But you're right, Roz, it just seems very vague. Are we going to, if we don't have an agreement, is someone going to come out and say, look, this is what will happen? Or, do you think they'll just try to muddle through?
They'll probably try and muddle through, but of course there is that incentive on both sides, really, to keep this at a high level intensity for the next couple of weeks. We are really hitting the strides in the US political season. The Republicans don't see any particular downside in keeping this going, the brinkmanship going from their end. Democrats can't be afford to sort of give in on the spending front. Of course, Janet Yellen now just saying the only solution to this is actually to lift the ceiling, which the Republicans are really not keen to do. So you're going to see that kind of level of tension politically coming in the next couple of weeks also.
And Tassos, would a failing, I guess, to service treasuries actually lead to a financial meltdown?
Well, in previous cases where we had this wrangling about the debt ceiling, one of the contingency plans was to actually pay coupons and principals. So that shouldn't have an effect in theory, but we have seen CDS of the United States reaching some obscene highs in recent days. So some people are taking a view of something catastrophic happen. In this case, it's just uncharted territory. And obviously, if we do reach that stage, then yes, you would expect if the safest asset on the planet fails, then it's going to have some consequences.
Our Anne-Marie Hordern in Japan, speaking to the Treasury Secretary Janet Yellen, saying the only good outcome in the current U.S. debt standoff is for Congress to raise the ceiling. This is what she said.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
Roz, when you look at what we heard from Janet Yellen and what the way forward is, again, is there, I don't know whether Donald Trump in a CNN town hall saying that actually we don't know how the markets react, that Republicans should stick to their guns, does that fuel the Republican side, or, do they listen to him less?
That's right. I mean, Donald Trump made those comments, but he tends to say pretty wild things about a lot of different topics these days as he's gearing up for his own run, potentially in 2024. But the Republicans in Congress are the ones who are doing the running here. And of course, even though they've got that incentive I was talking about to keep that gamemanship going, do you want to be the party that's responsible for what Janet Yellen has warned could be considerable financial pain for the U.S. economy, warning that hundreds of thousands of jobs are at risk, and the credit rating of the U.S., all sorts of other fallout, and the standing of the U.S. internationally? That's been a thing that they've been talking about constantly here. Do you want to be the party that's responsible for that? And so we've seen these episodes of brinkmanship over the years for, way back for decades even. And we've always seen in the end they find a way through because neither one wants to be responsible for the fallout. So markets are probably expecting that to be the case again, but there's no incentive, at least for now, for them to back down.
Tassos, the other big news, of course, out of the interview is the fact that Janet Yellen is expecting to travel to Beijing. She doesn't have a date yet, but there does seem to be more of a rapprochement between the U.S. and China. What does that mean for markets?
Well, actually, that is a good thing, and hopefully that's going to bring more certainty to markets. We have seen ever since China started reopening after closing its economy due to COVID, that is one thing that's acting as a tailwind. So despite all the negative headlines that we have from the U.S. regarding the debt ceiling, regarding regional banking woes, at least China is something that people are able to rely on in order to avoid some sort of meltdown in markets. And rapprochement is actually going to be a really good thing.
Yeah, Roz, the problem is that we've been here before. The two sides were getting closer and then something happens and they don't talk to each other. So what do you make of the Janet Yellen comments on China?
Well, they actually fit a pattern where the US does seem to want to tone things down after that spat over the alleged surveillance balloon from China caused, of course, that last-minute visit to be called off from the US Secretary of State. We've seen a pattern of lower-level meetings in the last couple of weeks between lower-level US envoys and Chinese envoys, ministers, and so on. As you can see from Janet Yellen, she's saying that she does intend to go to China. The really key thing is, does it build up to the point where there's a presidential conversation to really diffuse ties? It does seem that both sides recognize it's in their interests to do so. Of course, the US wants to maintain that strong posture against China in the run-up to the election, but they also need to keep the US economy going, and China is an integral part of that. On the China side, they also need their economy going, and President Xi Jinping has an incentive there. So it does seem to be building back towards, can there be a point where really senior figures get in the room? A senior US official does go to China.
Roz, I was going to ask, how much can this relationship get better? As you mentioned, we're in an election cycle, and it still plays well with the U.S. voters if you're bashing China.
Well, it's probably just more than anything to put a flaw under the relationship for both sides. We have fundamental tensions over trade, investment, technology, security, Taiwan, you name it. And it's not as though those things are going to go away. In fact, the US position in terms of the economic penalties on China is only hardening, and bringing in Europe also in that regard. But they're trying to juggle this thing where they've got sort of like competing with China on some things, collaborating with them on other issues. But really the overarching thing here is, can we just put a floor under the relationship, stop it getting worse, not really expecting it to get substantially better.
Okay, thank you both for joining us. Biden's debt ceiling meeting with House Speaker Kevin McCarthy and other congressional leaders we know has been pushed from today to next week. Meanwhile, speaking exclusively to us, the JP Morgan Chief Executive Officer Jamie Dimon also said he's in no doubt about how serious a default would be.
Actual default. That is potentially catastrophic. And you can go through a million ways, but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic. Markets get volatile. Maybe the stock market go down. The treasury markets will have their own problems. It's amazing you already have certain T-bills trading at 3% and right next to them 5%. This is not good.
JP Morgan Chief Executive Officer Jamie Dimon there speaking to me exclusively in Paris. He did not mince his words. Coming up, what does Mr. Dimon think about the banking crisis? We also talked regulation and some of the smaller lenders in the U.S. More from our exclusive interview next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Season is here.
Earnings season is in full swing.
UK consumer is still strong.
Bloomberg breaks the numbers first.
UniCredit smashing the earnings.
Underlying sales up by 10.5%. Volkswagen, BMW.
Deutsche is on fire.
With exclusive expert analysis.
The first quarter was very challenging.
Do you worry about the supply chain?
I'm really pleased with the quarter's results.
What's your timeline for this actually being able to reach market?
Our business remains very resilient.
The overall performance has been stellar.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The debt ceiling is potentially catastrophic.
Yeah.
So that's a whole different issue. Hopefully it won't happen. You know, the banking crisis, I still believe, will kind of sort its way through. And it's not anything like 08 or 09. Only a couple of people are offsides with all these various things, which you knew about. So hopefully, you know, it's getting near the tail end of that.
But if you're Janet Yellen right now, what would you do differently?
I don't know. I think we need to finish the bank crisis. I think we've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. So, you know, whatever the FDIC, the OCC, the Federal Reserve, you know, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, you know, not be surprised constantly, because some of these things have been known about for quite a while. And so we've handled 3, SVB, Signature, First Republic, and so.
Yeah, so
But
are you asking
but I think it's very important. The regional banks, who I've been speaking to like every day for the last week, they're quite strong. They're quite worried because of the run on deposits, all that. But their financial results are good. Their financial results are going to be good. Okay, next quarter. They're earning money. They got a very good clientele, very diversified, and they're quite strong.
You're asking Jenny for like a comprehensive solution. So if you're asking Janet Yellen to get the job done, what does that look like? That solution?
I'm not asking for a comprehensive solution.
Why not?
Just be prepared for problems. We don't need a comprehensive solution.
What do we need right now? Do we need regulators to look at short sellers of banks?
Yes. Look, my folks would tell me that that's not the problem, the short selling ban. If you actually analyze stocks and short sales, doesn't seem that big a deal. I think they may partially be wrong because, as you know, some people are unscrupulous and they use other means to go short. I think that if you look at the detail, the SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales, and they should go. If someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them, and vigorously, and they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it, but my experience in life has been don't assume too much.
Do you think things will change because of this? Is this like a catalyst?
I think it's going to get worse for banks. I think that
What do you mean by worse?
It's just more regulations and more rules and more requirements. I hope they do it very thoughtfully because, we love the community banks, the regional banks. We're the biggest bank to those folks. But, if you overdo certain rules, requirements, regulations, some of these community banks tell me they have, more compliance people than loan officers. And so at one point you make it harder for them to do business. There are already hundreds of rules in place. In a lot of ways, it's the mix of the rules. If you're going to change liquidity, maybe not capital. If you're going to change capital, maybe not liquidity. If you're going to add TLAC, then maybe you should do something with deposit insurance. They should sit down and have a very thoughtful conversation about what those things are and what we want the outcome to be. And if you look at the present outcome, a lot of things are leaving banks. And they should. If that's what they want, so be it. But that should be done with the forethought. That should not be done because you're just putting rules and regulations in place and you don't know the consequences.
Well, that was the JP Morgan Chief Executive Officer, Jamie Dimon, speaking to us exclusively. Now, Société Générale's fixed income trading unit also outperformed most peers in the first quarter with a 16% jump. Now, speaking exclusively to us, the Chief Executive Officer, Frédéric Oudéa, said the result came down to sound risk management.
I guess everyone in the U.S. has in mind the potential consequences of a default of the U.S. So I hope that there will be an agreement, maybe at the last minute. But there are other parameters which can play a geopolitical risk. Overall, this adjustment to a brutal increase of interest rates. So yes, the situation can remain volatile. That's where sound risk management is absolutely crucial.
Société Générale Chief Executive Frédéric Oudéa speaking exclusively to Bloomberg in his final interview after 15 years at the helm of the French bank. Now, we're also getting some breaking news out of SoftBank. We understand it started testing investor appetite for an initial public offering of the British chipmaker ARM, which could raise as much as $10 billion. Now, the Japanese conglomerate may launch a share sale in New York as soon as September. The IPO, of course, is on course to be the largest globally this year. It's a big blow to London and the UK that they're not listing here. We'll have plenty more, of course, on SoftBank and on some potential IPOs and why London, once again, seems to be losing out. Coming up is the end in sight for the BOE's most aggressive hiking cycle yet. We'll discuss that and break down the fresh GDP reading for you next. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
In terms of interest rates, let me be clear. We're very much going to respond to the evidence as it comes in. We've not given a direction one way or the other, and that's deliberate. I think we'll now be shaped by the evidence. We expect inflation to come off quite rapidly in the rest of this year. Obviously, we want to see that happen. We think quite a lot of it is in the numbers, as it were, because it's the other side of what happened last year with energy prices, particularly. But we want to see the evidence.
Okay. Can you be more specific on the evidence? What evidence will you be looking for?
Well, we put a lot of emphasis on the risk of persistence of inflation. Now, what I mean by that is, yes, inflation we think is going to come down rapidly this year, but it's got to go all the way back down to the target, and particularly in the core elements of inflation, the more domestic elements as they respond to some of these huge external shocks that we've had, how that works its way through the system. Now, what I would say, however, is that the news that we've had since we last met as the MPC, interestingly, has actually not so much really been in those sort of more persistent elements. It's been in some of the more front-load elements, food prices particularly. Actually, the more persistent elements, services prices, and actually wage setting in the economy has evolved pretty much as we thought it would.
Would it be fair to say that you are getting close to the end of the cycle?
Well, I'm going to say I hope we are, because this is the 12th consecutive increase in rates. But again, I'll be very clear that we will be guided by the evidence as it comes.
Bank of England Governor Andrew Bailey there speaking to our Guy Johnson. Now, the UK economy unexpectedly shrank in March as households turned more cautious and strikes hit activity. Let's get more now with our Bloomberg UK correspondent, Lizzie Burden. So, Lizzie, if you break down, of course, the numbers, consumers are getting hit.
They really were getting whacked, and that's especially clear in the latest data for March, as you say. That completes the quarter for Q1, and it's really anemic growth, 0.1%, as economists expected. The other narrative here, of course, are the strikes, weighing on sectors like healthcare, transport, education. You can see that they're the ones that were declining. But the good news is no recession, and that's exactly what the Bank of England forecast yesterday. Biggest upgrade to its forecast in its independent history. I have to say, Francine, it's a good job you weren't at that press conference yesterday. It was a tetchy one for Andrew Bailey, because he had reporter after reporter asking him about his credibility and the bank's forecast's credibility, because usually you would expect to see an upgrade to the inflation forecast in line with the growth forecast. But actually, he said that they're placing little weight on the medium-term forecast, so a defensive one in the press conference.
A defensive one. And he really signaled that, of course, the BOE may pause rates if there's something with inflation. So what are the markets pricing in right now?
Yeah, they're looking for 5% by September. Really, the focus was on the future path for rates, not the decision. Of course, that was pretty much a given, pretty nailed on. And so we didn't really get the hints in the guidance. Not much change to the language. We didn't get many hints in the presser. He was trying to stick to this data-dependent line. But in another part of that interview with Guy Johnson, there was a little bit of a dovish hint. Take a listen.
We are approaching, a point when we should be able to, in a sense, rest in terms of the level of rates. But we haven't seen the evidence yet to give a stronger sense of the read of that. So that's why I'm very clear that we have to be evidence-driven.
Andrew Bailey, there, of course, 12th consecutive rate rise that we saw yesterday. Lizzie, thank you so much. UK correspondent Lizzie Burden. Now, we'll be covering all things UK every week on Thursdays, 9:30 a.m. London time in our half-an-hour special. Returning now to our exclusive interview with Treasury Secretary Janet Yellen, speaking to Anne-Marie Hordern at the G7 finance meeting in Japan. Yellen warned there's no satisfactory solution for the U.S. other than Congress raising the ceiling.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets other than Congress acting to raise the debt ceiling.
So, Janet Yellen, they're certainly talking tough, not mincing her words, speaking to Anne-Marie Hordern. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The largest banks face billions of dollars in extra fees to replenish the U.S. government's deposit insurance fund. The assessment from the FDIC stems from the regulator's decision to insure all deposits at Silicon Valley Bank and also Signature Bank. The FDIC estimates that moves cost its deposit insurance fund around $15.8 billion. Now, Thailand's consumer confidence in April has risen to the highest level in more than 3 years. The index climbed to 55 from 53.8 in March. The University of the Thai Chamber of Commerce says pre-election spending and foreign tourist arrivals are boosting spending. Consumers are estimated to have spent up to $886 million in the run-up to that election. Now, U.S. National Security Advisor Jake Sullivan and China's top diplomat Wang Yi met in Vienna as both sides work towards improving relations. The White House says 2 days of talks covered tensions over Russia and Taiwan, among other issues. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Janet Yellen warns of economic and financial catastrophe if the debt limit is not raised in an exclusive interview with Bloomberg at the G7 meeting in Japan. President Joe Biden and House Speaker Kevin McCarthy postponed today's debt ceiling meeting as staff-level talks are set to make progress. Stock futures are up. But meanwhile, JP Morgan Chief Executive Officer Jamie Dimon warns that a U.S. default would be potentially catastrophic. We'll have more from our exclusive interview. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the U.S. Treasury Secretary Janet Yellen says a debt ceiling solution will be good for the economy and the markets. While she sat down in an exclusive interview with Bloomberg's Emily Hodern just moments ago in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
But this plan was outlined back in 2011, and you were there at the FOMC meeting about it, and it said that Treasury principals and securities would be paid. Is this something that, at least for contingency plan, has been discussed with the president?
So my understanding, I was at the Fed in 2011, is that this plan was never presented to the president and never approved. And
but would you present it now?
Look, we would. We are working full time to work with Congress to raise the debt ceiling. That's where our focus is. We know that the only good outcome is one in which Congress acts as it has many times, almost 80 times since 1960, to raise the debt ceiling. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills that we've incurred as a consequence of our legislation, that we're not a deadbeat country. And if Congress fails to do that, it really impairs our credit rating. We have to default on some obligation, whether it's treasuries or payments to Social Security recipients. That's something America hasn't done since 1789, and we shouldn't start now. So we've not discussed what to do. If that doesn't occur with the president, our focus is on getting it done.
Because as you know, treasuries are the bedrock of the global financial system. And the asset managers I speak to, the investors, they don't have the luxury of not contingency planning. So at this point, should they assume that debt may not be serviced if there's no deal?
Look, if Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that that gets done.
Well, that was Treasury Secretary Janet Yellen speaking exclusively to Bloomberg, thanks to our Anne-Marie Herder. Now, joining us now is Marie-Jacot-Cardoen, Chief Executive of Edmond de Rothschild Asset Management France. Marie, thank you for joining us. The debt ceiling, I mean, a lot of the market for the moment, apart from certain parts of T-bills and things like that that are on the move, is largely ignoring it. What's worst-case scenario?
There clearly is a risk of zero risk of the
Connection lost.
US defaulting on their sovereign debt. The market is pricing it. The US CDS is at 176 basis points. It was 77 in the summer of 2011 when the US got downgraded by S&P, and it's been on average historically around 20. So clearly, and the market is recognizing that there could be a risk of default, whether it's a short one or a long one. It's difficult to say. That's not our primary scenario. We believe
so you
that
think they'll find a deal.
They will find a deal. We, need to remember that negotiations between President Biden and McCarthy have only just started. They've met a couple of days ago. They're about to meet again. And it is likely that political antagonism is going to increase before a consensus is reached. But looking at the historical data, we believe that it is likely that a compromise will be found.
So from now until the 1st of June, and frankly, it's unclear what options the Treasury has. It's unclear also when the debt limit is. So it's all a bit, like the French say, it's a bit flou, right? It's a little bit vague exactly what happens and when it happens. Are you expecting just much more stress on the markets, and how do you play that?
We're expecting more volatility building up to a consensus being found. Look, we've been positioning portfolios accordingly. We've been quite conservative, not only in the rate space, but also with regards to equities, where there are fears of a recession globally, and we've been positioning our portfolios and favoring corporate bonds over equities for a while. We have taken advantage of government bond yields increasing, and we've increased duration gradually.
And is this, when you're saying what you're buying, is it for Europe or actually as a whole? If you look at region by region, of course, they're performing all quite differently.
There are, of course, regional specificities, but I would say overall, we've been very cautious in portfolios in Europe. And in global portfolios as well.
So what do you do with gold?
Gold is an exciting asset class. It's always been a refuge in times of uncertainty. I think the recent events on the geopolitical front or macro front have clearly brought the asset class to a level where we see a very good forward as well. There's several reasons to it, but I think the appeal for gold has risen. The first one is uncertainty, which we think is poised to remain. The second one is central banks will get to slow down their tightening policy at some point, and that's going to benefit gold.
This year, I mean, we're also talking about cuts from the Fed, which a lot of people are pushing back against.
That's not our expectation, and clearly that's not the indication that the Bank of England has given. They want to be evidence-based, and they will wait to see how the cuts are impacting the real economy, but we think that the Fed is going to pause their indicators that are clearly showing that it's time for a slowdown in the rate cuts. I think one of them is the CPI in April. It came at 0.4%. The undercore inflation came at 0.2% month-on-month, which is showing that inflation is slowing down and that there could be a pause in the tightening.
So, why do you see a difference between what the market is expecting, which is a cut from the Fed, and I guess their models are showing that there's a monetary lag by about 12, 14 months. So by the time that they started the first cuts, it's starting to play out now, and so we're going to see a seizing of the economy, a kind of credit crunch, and Fed officials, but also economists pushing back against that.
So I guess we have to obviously differentiate between Europe and the UK and the US. We believe that Europe and the UK are 6 months behind in terms of seeing the results of the monetary policy on the real economy and on inflation. In Europe, the inflation came at 5.6%. In April, so that's kind of a slowdown, but it's more of a base effect given the levels of last year, we believe, so no real effect yet. Whereas in the US, we think that, there clearly is There's antagonism between, yes, we're seeing a slowdown in inflation, so potentially a monetary policy that is going to be a bit more lenient going forward, but then we need to remember that there is this huge fear of recession, pressure on regional banks, and that will continue to weigh on investment.
And we saw actually the data points out of the UK today. The consumer softening a little bit. Have you been surprised that that the consumer in the UK, in France, elsewhere, almost globally, has held up so well so far?
I would say, we were expecting the, consumer to hold, quite well through the last couple of months, but we believe that, there is clearly a case for a big slowdown coming up, and that's the expectation. Hence the very cautious stance that we take on equities, despite the very good results that companies have shown in the first quarter.
Marie, thank you so much for joining us. So that was Marie Jacot-Cardoen, the Chief Executive Officer of Edmond de Rothschild Asset Management France. Coming up, we'll also be speaking to Daniel Kaplan, the Chief Executive and co-founder of Storskangen Group. That's after their earnings beat. It's interesting because we'll talk about the supply chain, and they're also acquiring quite a lot of companies. So he's next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Storskangen Group shares jumped after the Swedish investment company posted better than expected first quarter results. So joining us now is Daniel Kaplan, the Chief Executive Officer and co-founder of Storskangen Group. You have three businesses. Daniel, welcome to the program: trade, industry, and services. Now, I had to take a double take because we say that shares are gaining, but they're up 18%, I think, in today's tracing session, up 1.8%. I mean, does that make you feel good about the future?
I'm of course happy that the market appreciates our report. I think we had a very strong quarter in many respects, but of course it's a complex macro environment, so we just have to keep on our toes and keep working in the future going forward.
So what do you think actually investors are really liking right now? I know you beat estimates. You have a pretty strong beat on EBIT as well. Is there, how's the trend looking like in the next 6 months, 12 months? Are you expecting to be on the same trend?
I mean, in this first quarter, we had a 56% increase in adjusted EBITDA. We had an earnings per share growth of 118% and strong cash flows. I think we're very happy with that. We're also, from a seasonality perspective, we are expecting a strong second quarter. Beyond that, we're very cautious about giving projections. I think the macro environment is very uncertain, so we are humble to the fact and want to deliver in those circumstances before we promise anything.
I mean, your business activity, for example, so you own companies across many industries in the Nordics, but you also have, companies in the UK, Germany, and Switzerland. What worries you the most about what some of these economies will go through? Is it disruption? Is it consumer and recession? Is it macro trends?
I mean, of course, each and every country and each and every industry is different. But I think from Storskogen's perspective, a key part of our business model is diversification. So our three business areas, they are actually, we have a negative correlation between trade and industry, for example. So at the moment, industry is doing really well, whereas our trade companies, they're suffering from weaker consumer confidence. So I'm not necessarily worried about any particular macro or micro trend. But of course, if we have a general global recession, that will, of course, affect us. So I would say continued inflation and high interest rates, I think that would be negative. But I wouldn't say I'm really worried about that.
You're also a serial acquirer, which, I don't know whether you accept being called that or not, but are you seeing more values? As there's a recession, usually values of companies go down, so you could find bargains. How much money do you have on future acquisitions?
I mean, we did more than 50 acquisitions last year. We have reduced M&A pace this year. We've done 6 acquisitions so far this year. I think, I mean, we are only buying strong cash flow generating companies, very successful. As a rule, the prices in the unquoted SME segment, it doesn't really go up in good times, and it doesn't really go down that much in bad times. So unfortunately, we don't see that many bargains in our market, but and actually we see a somewhat decreasing deal flow when times are tough. But I think we will gradually start to do more aggressive acquisitions later on into the year. But at this point, our primary concern is to reduce leverage, actually, and in a high interest rate environment.
I mean, just so that people understand, you have around 12,000 employees. You have 136 business units divided into 14 verticals. Given the high debt load and uncertainty in the markets, is there anything that you would like to sell off, that you would like to divest yourself of?
I mean, we're continuously reviewing our portfolio. If we find that companies are not aligned with our financial strategy, they could be underperforming, they could have high earnings volatility, for example, or not be coherent with our ESG agenda. I think in that case we would divest them over time. I think that's for sure. So we are, but not any particular area at this point.
I was going to ask you, is there any particular sector that you think would be, a good idea to get rid of?
I think industries that are structurally with potentially too low margins or very high cyclicality, I think those would be more in jeopardy, if you will. I mean, those companies have been great to own and been contributing to Storskogen. But as a quoted company, we just recently quoted ourselves 18 months ago. I think in a quoted environment, they suit us less good, so to say.
You also have, of course, a sizable bond maturities.
Specific.
Okay, yeah, I knew I was going to get more on that, Daniel. So I wanted to ask you about, some of the bond maturities that are coming up. They're quite sizable, certainly in 2024 and 2025. Given the jump in yields and the jump in borrowing costs, how are you going to, I guess, move and tackle this looming debt wall?
Yeah, I mean, we actually have a very strong liquidity. It's about 9 billion Swedish kronor in cash on hand and unutilized credit facilities. We extended our big RCF, revolving credit facility, and a term loan as well to 2025 with an extension option as well. So we're not particularly stressed. If you look at the upcoming, we have one bond in 2024 of 3 billion. We already more or less have cash at hand to repay that if we would want to. But I think for us, we would want a nuanced debt maturity profile, evenly distributed across a number of years. And of course, we're working to amend that. And I think we feel pretty confident, especially with the very strong cash flows that we are experiencing at the moment.
Great, Daniel. Thank you so much for joining us. Daniel Kaplan there, Storskogen Group Chief Executive Officer and co-founder. Coming up, Turkish voters head to the polls this Sunday. We'll get the latest from Istanbul ahead of a crucial election. That's next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Turkish voters head to the polls this Sunday for the country's general election. Well, the race is expected to be a tight one amid growing economic concerns. Now, for a preview, let's go out to Istanbul, where Bloomberg anchor Yusuf Gameldin is covering the story. So, Yusuf, a prominent presidential candidate dropped out. Where does this leave the race? How uncertain are the votes?
I mean, Fran, you have Muharrem Ince, who decided to throw in the towel, and this is after there was an alleged sex tape, also accusations that he took some bribes. He's firmly rejected all of that, but what it does do, it narrows the race to three contenders: the incumbent Recep Tayyip Erdogan, you've got the ultra-nationalists, and then also the credible threat that has emerged, and that is Kemal Kılıçdaroğlu. Two things I want to point out here that we haven't discussed as much throughout the morning. One is, regardless of outcome, what is the transition going to be to a new administration? If the vote is as close as we hear it's going to be, and with either side winning or whichever side wins, What's the handover going to be? Are there going to be attempts to contest the outcome? That is a concern on the one side. The other side is you have an economy that can't afford to wait, with $177 billion that have been spent to try and micromanage the currency. And then another front that I'm watching as well in some of the discussions I've had is Turkey's evolving role as a foreign actor rather, and what we've seen in terms of a shift that allows it to play a role and to continue to talk to Russia. The relationship with the United States has been very tense throughout this morning. Actually, we've had more accusations from Turkish opposition that there has been some level of meddling from Russia in Turkish political affairs. So that is something that weighs and ultimately is going to lead to a bit of a rethink, at least in terms of the United States. For the Turkish side of things, it is clear that the relationship with Russia is important. They supply natural gas, tourists, and other inflows as well. Fran.
Yusuf, thank you so much. Great reporting there on the ground. Our Yusuf Gameldin in Istanbul. Of course, he'll be covering all of the election for us throughout the weekend. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sources tell Bloomberg that at least 8 senior Credit Suisse bankers are leaving the firm for Santander. Mergers and Acquisition Chief Steve Geller is said to be amongst them. We are told the move reflects how Santander is expanding over in the U.S. Representatives for Credit Suisse and Santander have declined to comment. Now, the Wall Street Journal reports that Linda Yaccarino, NBC Universal's head of advertising, is in talks to become Twitter's new CEO. Elon Musk tweeted he is transitioning his role at the firm to executive chair and CTO, where he will oversee product, software, and also systems operations. Musk says the new CEO is slated to start in about 6 weeks. And Peloton shares plunged after announcing a recall of around 2 million bikes over safety concerns. Shares dropped to their lowest level since the fitness company's 2019 IPO. A flaw in the seat post was identified earlier this month, and Peloton says it will provide replacements that consumers can install themselves. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. European stocks for the moment are rising. We did have a couple of earnings that actually beat estimates. Luxury group Richemont definitely rallying to a record following estimate-beating results. Pound also edging higher after data showed that the UK economy grew slightly in the first quarter, and that's reducing the risk of a recession. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Tom McKenzie here in London, and this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power of the
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is
such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other.
The president's made clear that we cannot default on our debt. We can't default on the promises we've made to our creditors.
No one really believes that the U.S. will default, and they shouldn't either.
Actual default. I don't think it's going to happen because it gets catastrophic, and the closer you get to it, you will have panic.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Janet Yellen warns that the only good outcome in the debt standoff is for Congress to raise the ceiling. The Treasury Secretary talks with Bloomberg in an exclusive interview. Fixed income traders at SocGen beat their peers in a volatile first quarter. That made up for a plunge in equities trading revenue. And a crucial election in Turkey on Sunday. An opposition alliance tries to end Recep Tayyip Erdogan's 2 decades in power. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards is off today. And Kriti, investors, the markets finding some reason for cautious optimism this morning.
A little bit, but look, it's coming in the context of a weak week. There's been a lot of red on the screen when you look at the S&P 500, so it's only natural that we're due for some sort of bounce. That is kind of the sentiment you're seeing in futures right now, higher by 0.4%. That is the biggest margin that we have seen all week in either direction. So it really speaks to the idea that even though on the surface the S&P 500 does feel a little bit range-bound, essentially waiting for the debt ceiling talks and something to come of them, especially now that the meeting has been postponed to next week between Speaker McCarthy and President Biden. The markets are saying, look, maybe we need to trade on technicals. Maybe we need to trade on just kind of other liquidity forces that are now baked into the market. And that is just the stock market story, Tom. You got to look at the bond market as well. 391, that's a theme of stagnation, that theme of kind of sitting still in the water and waiting for some sort of direction in an era where the Federal Reserve is pretty much thought to have been done tightening. We're still looking at a 2-year yield that's at 391, hovering around that range between 391 and 405, really on the lowest end of the range right now. But again, sitting back and waiting seems to be the theme of the day. You're even seeing that in the Bloomberg Dollar Index as well, really at the whim of anything that is going on abroad. Even NYMEX crude not giving us much to work with here, down about 0.4%. Tom, it kind of feels like everyone's checked out for the weekend.
You do get that sense, don't you? Here in Europe, there's a little bit of focus on the earnings story because there's some optimism in some of the individual names, even as we gear up for that well-earned weekend, at least for most of us. Richemont, for example, we'll break that down for you shortly, but also SocGen as well. Here in the UK, some economic data coming out, really interesting given what we heard from the BOE, that raising of forecasts for growth for the UK. In the first quarter, we did manage to eke out 0.1% growth. It's pretty meagre, but the growth was there in the first quarter. A slight concern about the most recent months coming through for the UK. Across the European session, then you're seeing gains of 0.7%. So far, it's a pretty solid session, taking a beat, of course, in terms of a little bit of optimism. The geopolitics coming through from China and the US with those talks, and also the debt ceiling, of course, and those conversations being pushed on, and the needle moving, at least on the edges, the margins. 125 on the pound, that's a gain of 0.2% as we weigh up that GDP print, of course, on the back of that BOE decision yesterday around raising rates by another 25 basis points. Richemont, look at that, soaring 7.7%. The owner of Cartier, of course, doing really well in terms of sales in China. It is, again, the China story when it comes to luxury goods, and they've come out with a very solid beat, about 5 billion euros in revenue for the first quarter. And whether or not that the dynamic comes through and continues out of China is going to be crucial, of course, for the luxury space and Richemont as well. THG, very different story. This is a business listed here in the UK. They own dozens of websites focused on lifestyle and beauty. They were in conversations with Apollo Group around a potential takeover. Those conversations have ended, the stock plummeting 11%. This is well below its IPO price, trading at about 66 pence. It had been IPO'd at about £5. So well below that, the travails of this business, THG, continue. Critty.
Well, it's interesting. On the micro front, we are seeing quite a bit of movement. That's been a theme all week. But on the macro front, stagnation, waiting for some direction on the debt ceiling seems to be the theme, which brings us to our top story. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit. It was set for today. The delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. Treasury Secretary Janet Yellen discussed the topic in an exclusive interview with Bloomberg's Anne-Marie Hordeurn at the G7 summit in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
Anne-Marie Hordeurn joins us now from Niigata, Japan. Anne-Marie, 2.5 weeks until that June 1, early June deadline. What happens next? We all know it's catastrophic. What can really be done here?
So what Treasury Secretary Janet Yellen continues to repeat is that there are no good options besides Congress acting. But of course, when you speak to individuals in the global financial system, they're starting to prepare for contingencies. Now, she said there are a number of paths open, but she would not confirm or deny this idea that really took shape in 2011 at the Treasury, which is that they would make sure that debt would be paid on principals and on Treasury securities before they paid anything else. And this is something that potentially is a contingency plan, but she doesn't really want to voice or advocate for that now because in her mind, there is no good plan besides raising the debt ceiling so that the U.S. government could pay all those bills. Remember, this could become very politically fraught for the president, and if he needs to decide whether or not he's going to pay interest on bonds or Social Security checks.
Yeah, choices clearly none of them in the administration want to be forced to be making. The Secretary Yellen also speaking about the recent string of bank failures. Take a listen.
The banks that have failed have had some very unique characteristics that have made them vulnerable. The banks that failed tended to have substantial losses, mark-to-market losses on their hold-to-maturity portfolios. So although their regulatory capital wasn't impaired, their tangible equity was diminished, and they simultaneously had a very high proportion of uninsured deposits.
And Anne-Marie, you pushed the Treasury Secretary on this. You flagged the fact that she'd mentioned repeatedly that this is a stable US banking system, and she tried to ring-fence the regional banks once again.
Yeah, that's right. Whether or not it was the first bank that failed just 2 months ago or the fourth more recently with First Republic, the administration has continuously come out and said the banking system is sound and resilient. But here, obviously, she is talking about the pressure that is facing regional banks specifically. She would not rule out whether or not we could see another small or medium-sized lender collapse. But at the same time, she does think that they could have access to ample amount of liquidity, and by and large, she thinks the U.S. banking system is strong. We should note, it is not lost on me or anyone else here at the G7 that two of the biggest concerns about economic risk are stemming from the United States, the banking crisis as well as obviously the debt ceiling. And we just heard from the German finance minister who says he hopes that Washington takes a mature decision, because it is not just investors in America, politicians in America that are waiting for some sort of deal as we head towards June 1st, but it is globally a massive issue and serious concern because, of course, you know, treasuries underpin the entire global financial system. So it's quite something when the Treasury Secretary shows up at an international meeting and they're supposed to be talking a number of topics, but the two that are front and center are emanating from Washington.
Certainly putting a lot of pressure on both the markets and Washington as we get closer and closer to that deadline. 2.5 weeks away. Anne-Marie Hordern in Japan, we thank you as always. We'll, of course, bring you more from Anne-Marie's exclusive interview with Janet Yellen later this hour and throughout the day on Bloomberg Television and Radio. In other banking news, Societe Generale's fixed income trading unit outperformed most peers in a volatile first quarter. Clients reacting to interest rate hikes spurred revenue in an otherwise tough trading period. In his last interview as the bank's leader, SocGen CEO spoke with Bloomberg exclusively on the fallout from the U.S. banking turmoil.
The situation is very different. So yes, the situation can remain volatile with turbulences going forward, but I don't think there's a spillover to be expected in the European banking markets.
Shonali Bassick, our global finance correspondent, joins us now for more. Shonali, walk us through the details here.
Well, it's interesting to see SocGen really blow it out of the park when it comes to fixed income trading here. Because when you look at the European banking landscape, the U.S. giants are much bigger in trading, but they're doing quite well in fixed income trading. We know a lot of banks are moving into France, to Paris. It's becoming a much bigger global financial center. So on that hand, trading kind of blowing it out of the park here when it comes to rates trading in particular is interesting to see as these French banks gain more share in trading. However, we also know, according to Bloomberg Intelligence data, that SocGen is trading at the lowest price to book value of every really major European bank here. And so the strategic direction of the bank as it transitions leadership is really the story to watch for SocGen over time. What does this bank do? What does it mean? How does it change? How does it improve its profitability over time?
Okay, so from one of the major European banks to one, of course, the preeminent US banks. And that exclusive interview we had, of course, with Jamie Dimon, JP Morgan's CEO, of course, yesterday, telling Bloomberg, telling Francine Al-Aqua that regulators should consider a short selling ban on banks.
The SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales. And they should go, if someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, you know, about a bank, they should go after them, and vigorously. And they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it.
Shonali, is this a surprise? What do you make of this?
It sort of is a surprise because you did hear him even go against what his own bank is seeing in some regards when you look at what is happening in short selling. But what he is saying is something that is on the minds of many people. This is a very volatile banking system here in the United States. I would refer also back, we spoke to Jim Milstein, who is an executive at Guggenheim Securities, who has been advising the FDIC on a lot of these bank failures and sales here, who had said that the SEC should step in, maybe not with full sale bans, but disclosures here. So how the SEC moves on what is happening underneath the surface in trading of these firms is of key concern in a lot of different ways. I would also say they are looking at not just short selling, but how executives are trading stocks of the firms that they're involved in this very volatile time where disclosure is pretty paramount and irregular at this point in time as people watch deposit flows.
Shonali, of course, Jamie Dimon has also spoken about first undying confidence in the U.S. consumer, then talking about the economic hurricane. Now he's saying, look, a mild recession seems to be his base case, but he said he's more worried about geopolitics. JP Morgan has had a very fraught relationship with China. Is that changing?
Well, it's interesting because actually when you look at the regulatory concerns when it comes to the banking system, it's not the chief concern. It's geopolitics that is a much bigger one. That is everything from the changing trade relationships from the U.S. to Russia around the world, and also when it comes to Taiwan. He didn't mention Taiwan explicitly, but we know in the past year, U.S. lawmakers very explicitly asked him, Citigroup CEO, Bank of America CEO, about what they would do if geopolitics and concerns between China and Taiwan were to escalate. Now, again, regulatory-wise, you don't see a major crackdown on the financial system in the same way as you see in technology, and he pointed that out. But certainly, when it comes to the U.S. banking system moving further into China, it has been a fairly slow move, but one that is JP Morgan, Citigroup, a lot of these big banks have committed to over time.
And let's see if those relations maybe thaw just a little bit and where Jamie Dimon stands on the other hand. Bloomberg Sonali Basak, we thank you as always walking us through the crucial stories in the banking world. A hard pivot here from New York to Turkey. Turkish voters head to the polls this Sunday for the country's general elections. The race is expected to be tight amid growing economic concerns. For a preview, let's get out to Istanbul, where Bloomberg's Yusuf Gamal Eldin is covering the story. Yusuf, set the scene for our international audience. Talk us through the policy at stake this election weekend.
Well, it's all about who gets to be in the driving seat of one of the world's largest economies, $900 billion worth. And it's been a tough time, as you said, and here on the ground, the tensions is very palpable. On Sunday, the polling station, the voting stations are going to open at 8 a.m. in the morning. Quite a few things to run through in terms of some of the issues that are at the center of the local debate, be it political or economic. I think you look at the lineup of contenders, you've got the incumbent, he's been around for 20 years, Recep Tayyip Erdogan, no surprises there. The credible threat emerges this time around, which is why this is a little bit different. I've been doing this for a while now. This is Kemal Kılıçdaroğlu. And with the Muharrem İnce group now throwing in the hat, you only have 3 contenders and 2 main challengers, or 2 at least that appear to have crystallized, that are going to take this down to the wire. If we don't get a decision on Sunday, this could go to a runoff May 28. The lira hedging is now at a record. You have the actual spot trading that is also at a record low, and foreign investors have left waiting to see whether we get clarity or not. So that is what this is all about.
What about the geopolitics? Fold that into that as well, Yusuf. Obviously a member of NATO, Turkey, but increasingly under Erdogan, close to Russia.
I mean, this has been fascinating to watch because at the end of the day, Turkey is actually NATO's largest military after the United States. And what has happened since 2016, since the alleged coup attempt, President Recep Tayyip Erdogan has moved away from the United States. There's a deep mistrust. And by moving away from the United States, he's actually moved closer to countries like Russia. He's got the ear of the Russian president. And in some ways that has been useful, for example, with the grain deal vis-a-vis the Ukraine. But there's a broader reluctance, not just from Erdogan, but from opposition chiefs to sanction Russia. Natural gas comes from Russia. There are a lot of tourists that still come from Russia and inflows from other sources as well, and nuclear know-how. So this is not going to change anytime soon, and it's going to keep the United States and Europe watching this contest very, very closely over the next 48 hours, guys.
Okay, on the ground for us in Istanbul, Yusuf Gamal Eldin previewing the first round of that really important vote for Turkey. Sunday is the first round vote, and of course the importance domestically for Turkey, but internationally as well, as Yusuf was outlining for us. Coming up, we're going to speak with Beata Mante, Citi's head of European equity strategy, as investors remain focused, of course, on what central banks will do next in their rate hiking campaigns. Bank of England Governor Andrew Bailey spoke to Bloomberg yesterday.
We are approaching, a point when we should be able to, in a sense, rest in terms of the level of rates. But we haven't seen the evidence yet to give a stronger sense of the read of that. So that's why I'm very clear that we have to be evidence-driven.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them, it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Look, it's all about the debt ceiling on the macro front. And there's a really interesting chart that I want to show you immediately. For our radio audience, stick with me. Immediately, when you think that maybe the U.S. government may just default, you go back to 2011. You say maybe the go-to trade is at the end of the day to pursue, ironically, the safest asset in the world, which is U.S. Treasuries, and therefore yields should go down. Well, it kind of feels like as we start the countdown clock to that early June deadline, that is exactly what's happening. For our radio audience, stick with me here. We are looking at a chart of bid to cover ratios for the latest auctions. We're looking at 4-week auctions, 8-week auctions, even 30-year auctions. And it's kind of a messy chart. What you need to know is this very last panel right here, where you see a tick up in all three tenors. It really speaks to the idea that even though we are kind of counting down, there is that panic that is baked into the markets. People still want treasuries, but is that the trade that makes sense? Or do we go in the other direction? Do you go with the fundamental trade, which is essentially to short or to cover or to hedge against that U.S. default? Let's bring in a true expert. Simon White, Bloomberg macro strategist, joins us from London. Simon, if everyone is hopping into treasuries, does that mean the yield peak is in?
Well, I think it's quite possible. I think the chart you show there is very interesting. You know, you have bid to cover ratios this week on very short-term Treasury securities, so like bills, and very long-term bonds, like the 30-year. And I think there's two reasons for that. First of all, people are buying like 1-month bills. Now that's going over the potential X day when the US might have to quote-unquote default. It probably won't actually default, but there is some sort of risk there. And that's probably people just taking advantage of the fact that these bills are trading very cheap. Whereas in the longer term stuff, I think it's a safe haven thing. You know, perversely in the US, even though you have this potential debt ceiling thing, happened in 2011, 2013, even though that was the center of the risk, if you like, people gravitated towards it because there's no other opportunity. You know, if you're looking for a safe haven, even if it is a US debt problem, all you've really got is US debt. And so that's why people are looking at the longer term stuff as well.
So 375 on the 30-year, 340, so a 50 basis point move, or at least 50 basis point differential between the 2-year and the 10-year in the US. And you mentioned the bill gross trade around short-term T-bills. Where do you see those yields going then at the 10-year, 30-year level?
Well, I think this is an opportunity for a short opportunity for longer term.
So that window's going to close?
Yeah, I think so, because look, I mean, I think there's a number of things happening here. So safe haven or not, people are now focusing on the US fiscal situation much more closely. Now, the fiscal deficit in the US is running at -8%, so 8%, and that's even before we've hit a recession. And that's also the largest of all the major countries in GDP terms. So we've already got a pretty poor fiscal situation in the US to begin with. People are beginning to focus on that. Top of that, you basically have global interest rates are peaking, short-term interest rates are peaking. That actually counterintuitively means the 10-year tends to rise, the yield tends to rise, because that's the signal of a global cyclical upturn. So you're beginning to see these sort of changes in the cycle. And I think right now, yeah, yields are going to go higher.
Great stuff, Simon White. Thank you very much indeed from our macro team. Of course, for more market analysis, do check out MLive Go on your terminal. Stay with us. This is Bloomberg.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Coming up, Beata Monte, Citi's head of European equity strategy. We'll get her thoughts and analysis. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there to kind of upside.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Janet Yellen warns that the only good outcome in the debt standoff is for Congress to raise the ceiling. Treasury Secretary talks with Bloomberg in an exclusive interview. Fixed income traders at Societe Generale beat their peers in a volatile first quarter that made up for a plunge in equities trading revenue. And a crucial election in Turkey on Sunday. An opposition alliance tries to end Recep Tayyip Erdogan's 2 decades in power. A lot to digest there. I'm Kriti Gupta in New York with Tom McKenzie in London. Anna Edwards is off today. Tom, there is a lot to digest on the macro front. Geopolitics at the core of not just the election in Turkey, but of course what Jamie Dimon is saying is his biggest concern as well. Meanwhile, all eyes on the debt ceiling stateside.
Yet slivers, I should say, of optimism as those talks between, at least at the staff level, continue. We're a long way, of course, from any kind of resolution, and the Treasury Secretary just ramping up the warnings on that front. But talking the geopolitics as well, of course, around China, you do have the news reported by Bloomberg that there have been some conversations between China, Wang Yi and Jake Sullivan. 8 hours of talks. Maybe that's setting the stage for a meeting between the two presidents. Maybe that's going to ease the geopolitics and the tension between Beijing and Washington, at least at the edges. Across the European markets, you're also seeing a bit of a lift from the earnings front. So gains of 0.6%. And we can zero in on some of the individual stories. But before we do that, let's check in on the pound, because you're seeing a bit of strength coming through for sterling. 0.2%, 125. You had some economic data suggesting that for the first quarter, you did get a little bit of growth, marginal growth, 0.1%. That after, of course, the Bank of England raised rates by 25 basis points and increased their forecast for growth for the UK economy yesterday. Here's one of the earnings stories that's really important and really interesting. It ties back to the China story, but not on geopolitics, on the demand for luxury. So Richemont, the owner of Cartier, seeing sales just being propelled in the world's second largest economy. Whether or not that is sustained is going to be crucial, but so far the gain of 6.4%, investors rewarding the earnings beat coming through from Richemont, and one of their biggest shareholders also pushing back on speculation that LVMH may be looking to snap up this business. THG, a very different story. This beleaguered UK-listed company, it operates websites focused on things like beauty and lifestyle. They were in talks with Apollo Group. They've cancelled an end of those talks. The stock taking a big hit, currently down 9%. The travails of this business well below its IPO price. THG, listed here in the UK. Kriti.
Yeah, certainly a lot of volatility on the micro front. On the macro front, though, Tom, it does feel like a little bit of a snooze fest. But here's what happens in a snooze fest. it means that the market is far more vulnerable to technicals, to liquidity, to supply. And that's exactly what you're seeing S&P futures right now, higher by 0.5% on the background that, look, we have had losses for most of this week, especially in the pre-market trading session. So when you were looking at it from a macro perspective, we were almost due for some sort of bounce. And that's exactly what you're seeing, higher by 0.5% in futures. The bond market kind of singing to the same tune here. 390 on the 2-year yield. You're starting to see some of the gains, or I should say some of the losses in the Treasury market, some of the gains in the yield pared back even in the pre-market session. Right now we are unchanged, but the direction of travel seems to be a bid into bonds. That's going to be a theme you see as we get closer and closer to that debt deadline in early June. And of course, that's going to also yield the dollar story, or lead the dollar story, excuse me. Right now, the dollar at the whim of, like you just mentioned, the pound as well. But again, waiting to see what comes of Speaker McCarthy's meeting with President Biden, now pushed into next week. The ripple effects, of course, are going to come down to the one big question: is a recession around the corner? Is the inflation story over? And for that, I love to look at NYMEX crude trading at a 70 handle, right at the cusp of dropping into the 60s. Is that the direction of travel for commodities? And what does that say about the broader macroeconomic trend? Is a recession just around the corner, Tom?
Yeah, and what will the OPEC Plus response be to that falling oil price? As you say, $70 a barrel on WTI. They're going to be meeting early June. We'll look for that potential cut coming through from OPEC Plus. Potential. Let's bring in Beata Mante now, City Head of European Equity Strategy. And let's go back to the macro themes around the debt ceiling then. Janet Yellen speaking to Bloomberg, saying the only good solution is raising the debt ceiling. What have you been saying to clients? What have you been hearing from clients about their concerns about the debt ceiling in the US? And what is your advice around how to position around this risk?
So I think equity markets globally and in Europe have so many reasons to worry about. And of course, debt ceiling is just another reason, and it's an immediate reason that we have a date for, right? But other reasons that equity should be worried about is, of course, deteriorating macroeconomic data, high inflation, persistent inflation, especially wage inflation, and recession, as you've mentioned before, right? So I think all of these together mean that perhaps the market is ready to take some profits. So we have this view of range trading markets this year. So the downside, we think, is limited by the fact that the market at least thinks that we've discovered the central bank's put through the earlier banks crisis. But the upside is also limited by all these worries we've just spoken about.
But you can also make the argument that the softer economic data underscores the view from some traders that you're going to get cuts by the end of this year. And we saw the jobless claims picking up out of the US. We saw producer prices coming in softer than expected. That is good news for the Fed. Does it also give grist to the mill to those who say you could be down to 4.3% by the end of the year?
If what the market is pricing in terms of the Fed funds is correct, definitely agree with you. It's a good news. But city economists actually disagree. We think that the central bank, the Fed, will stay the course for now. We have another 2 hikes going forward. And from the ECB, we have 3 hikes going forward. So ECB going for longer than the Fed. But I worry that where the market could be most wrong about is actually pricing in cuts too early. We think we'll have to wait a bit longer than the market thinks.
Beata, talk to us a little bit about fund flows here. It feels like in the post-COVID era, we had 2 years of where big tech in the U.S. was the trade du jour, followed by an immediate kind of fascination with Europe and emerging markets, the idea that anywhere but the U.S. was a good bid. Beata, in the context of these debt ceiling debates, to what extent are funds still going to be flowing to Europe?
That's the problem, of course, and we've already started to see outflows for the last 4 or 5 weeks. We've been seeing outflows from Europe and actually also from the US. So it's a worry for the overall equity space and perhaps a sign that for the time being the flows could go to the other asset classes.
Beata, grow cross-asset for us here. What is leading the European equity trade and arguably the U.S. equity trade as well? It felt like it started off with commodities being kind of this inverse trade with equities. Then it was the bond market. Where's the sensitivity right now when it comes to other financial assets?
So in terms of European equities, of course, we are just coming out of the 20% outperformance of the overall index over the US. It started back in October, and everything cyclical has, and especially banks, have led the index. And I think with the banks crisis that we've seen out of the US early in March, something has cracked in this trade, right? So my view is that we are going to see the continued flight into quality, away from cyclicals, away from value and into quality and growth with some defensive tilt.
And you touched on banks. You downgraded banks at the beginning of these travails. What would you need to see? What would the catalyst have to be to turn more constructive on banks?
We worry that the banks in the US have a bit more volatile future to come. In terms of European banks, actually, fundamentals look pretty good. Earnings come through very well. Liquidity looks good. They are cheap. So I think European banks are underwritten by all these positive categories. However, I think that this recessionary worries looming over us, even if it is just out of the US, means that for the time being, banks will have to wait. There will be a time to buy back into the banks, but we need to see some of these worries disappearing or us moving a bit more.
So there's a little bit of value there in European banks, but you need to see a bit of those changes around the macro front to dip your toe back in.
Exactly, there is a lot of value. But
there's a lot of value, but you're not ready yet. Overweight UK equities, and yet the FTSE 100 very well last year, outperformed. This year to date, underperforming European and US equities. What is the case for UK equities?
So we get many questions about this call. It raises eyebrows of many people. Of course, last year it was the best market driven by the commodity strengths, but actually, I think, and I'm talking about FTSE 100 or MSCI UK index, it's a very particular index. So it is very heavy in commodities that drove the outperformance last year, but it actually has the biggest share of defensive sectors out there in the world, out of the major markets. And of course, in the time where defensives are quite expensive, these are international businesses that trade at big discount to their peers. So I think this is the attractiveness of the UK market going forward.
Beata, 30 seconds very quickly. What kind of metric do you look at when you evaluate the regionals here? Is it a purely valuation call now? Are we looking at the price to book ratio? How do you evaluate when the time to hop in to bank stocks is? What's the metric?
So there is no single metric, right, going forward. And really, one that I like the most is the credit conditions. You know, banks lending survey that, as we know, is coming down. So, of course, the banks are self-imposing a bit more risk of stand going forward, and they just don't want to be seen by the market as too risky. So I think that on its own is going to continue to drive the not huge underperformance, but underperformance of the banks for the near future.
Okay.
But these turning upside would definitely be a good sign.
Okay, Beata Mante of Citi, really great insights on the views around the banking space. Lots of value here in Europe, but not quite ready to lean into that trade yet. Overweight UK equities. Coming up, Janet Yellen says Congress raising the debt ceiling is the only good outcome for the debt standoff. Part of our exclusive interview with the Treasury Secretary is coming up next. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. U.S. Treasury Secretary Janet Yellen says there is no satisfactory solution to solving the debt limit other than Congress acting to raise the debt ceiling. She spoke exclusively with Bloomberg's Anne-Marie Hordern from the sidelines of the G7 meeting in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
But this plan was outlined back in 2011, and you were there at the FOMC meeting about it, and it said that Treasury principals and securities would be paid. Is this something that, at least for contingency plan, has been discussed with the president?
So my understanding, I was at the Fed in 2011, is that this plan was never presented to the president and never approved.
But would you present it now?
Look, we would, we are working full-time to work with Congress to raise the debt ceiling. That's where our focus is. We know that the only good outcome is one in which Congress acts as it has many times, almost 80 times since 1960, to raise the debt ceiling. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills that we've incurred as a consequence of our legislation, that we're not a deadbeat country. And if Congress fails to do that, it really impairs our credit rating. We have to default on some obligation, whether it's treasuries or payments to Social Security recipients. That's something America hasn't done since 1789, and we shouldn't start now. So we've not discussed what to do. If that doesn't occur with the president, our focus is on getting it done.
Because as you know, treasuries are the bedrock of the global financial system. And the asset managers I speak to, the investors, they don't have the luxury of not contingency planning. So at this point, should they assume that debt may not be serviced if there's no deal?
Look, if Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that that gets done.
U.S. Treasury Secretary Janet Yellen speaking in an exclusive interview with Bloomberg's Anne-Marie Hordern at the G7 in Japan. Tom, economic catastrophe either way, saying the debt ceiling is the only option. I'm glad Anne-Marie Hordern didn't ask her about the $1 trillion coin, for example. I'm sure she would have thrown cold water on it. But it is really a key point that Anne-Marie specifically makes. A lot of the market doesn't know how to position for this.
A deadbeat country, wanting to avoid being a deadbeat country. Yes, how you position around this, and every guest that we get on that we ask about this, the challenges on that risk and how to position that risk are clearly at the forefront of their minds. The politics, of course, at least today, the conversations that we're hearing from Washington is that at a staff level they're making some progress. The flip side to that, and this is something we get from others, is that the politics of today are that much more different. The right wing of the Republican Party, some would describe them as extremists, have that much more determination to push us to the limit, if not over the line.
Right, and even the deal, if it does in its current form somehow pass through, it still only pushes the kind of new debt ceiling limit to about March of 2024. So it's really just kicking the can down the road instead of finding a more sustainable solution. Tom, I'm curious though, stateside it feels like the panic is starting to build up, kind of like the negative anticipation before, say, Christmas Day. There's kind of that countdown. It feels like that with a negative lens. Do you feel that same panic in Europe?
The countdown to Christmas through a negative lens. I like the way you phrase that and characterize that. Look, I see there's still an element of us kind of waking up going, hang on a second, what, you guys are doing this again? You're putting us through this again? What, the 80th time? None of us have to do this. You set the budget, you get it through, you borrow the money you need. Yes, there is increased focus on this. Inevitably, we question ourselves sometimes, why are you running US stories at the top of the headlines once again? Well, because it is that important to all of us, not just you domestically in the US, of course. So let's hope they get it resolved. Plenty more, of course, of the coverage of Yellen exclusive throughout the day. Sitting down with Emery Hildern. Coming up, a look at the key events and stocks you need to watch. These equity markets are in positive territory. Gains in Europe of 0.6%. The S&P E-minis stateside pointed to upside of 0.4%. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg's Surveillance Early Edition. I'm Tom McKenzie in London, Kriti Gupta in New York. Now, a look ahead at what is on the docket for today. Bank of England Chief Economist Hugh Pill speaks at 7:15 a.m. Eastern Time. That's after he got into a bit of hot water by suggesting that workers should not be asking for pay rises. At 8 a.m., it is Brazil CPI. Base effects will slow the year-over-year inflation rate in April closer to the 3.25% target for the year. That's followed by results from the University of Michigan Consumer Sentiment Survey at 10 a.m. To what extent are U.S. consumers holding up as these rates continue to be pushed through by the Fed? And we get Russia CPI data. That's at 12 p.m.
Yeah, certainly a lot to digest on the macro front, but a lot to digest on the micro front too, Tom. Look, it's a Friday. People want to go home, but stocks are still trading, and there's a few that have already gained some momentum in the pre-market, specifically AT&T. This is a stock, Tom, that I find very interesting. It's one of those old guard tech telecom stocks, higher by about 0.4% in the pre-market right now. Look, they're talking about a fiber venture with BlackRock signing its very first subscribers. This is such a big deal stateside because, of course, we know there are patches of the country that still haven't hit 4G or 5G yet. So to really extend into a fiber network and directly compete with Verizon, it's a massive deal for AT&T at a time where they're bleeding subscribers.
Yeah, it's huge, isn't it? And it's one, I just wonder if it's a template as well in terms of how you push into those markets that, as you say, are underserved. And as you point out, putting them head to head with some of their competitors in that space as well. But Meta as well, this is fascinating in terms of the incorporation of artificial intelligence, all this focus around large language models.
It is, and pushing it higher by 0.6%. Meta specifically, though, said, you know, we think of it as a big tech name. They said, look, we are not going to be investing in AI in the same way some of our peers are, and yet they are still kind of doing it, but just not in the kind of we're going to dive in all signal ahead for the way that Alphabet or Microsoft has been talking about AI as well. Meta instead looking, that's going to help with our ad tools. It's going to help target the people we want to see. And that's kind of a big deal. They use that magic phrase, artificial intelligence. It boosted the stock. It works like magic, Tom.
Yeah, the genie glitter, at least, the fairy glitter over that stock in the back of AI. The consequence is really important, though. I've already met people who are using AI to create pitch decks, to create press releases, videos and stuff. So for advertising, really crucial in terms of how it develops and changes there. Tesla changing prices again, Kriti.
They are, and this is a really big deal for Tesla when we talk about just kind of scaling and bringing more affordable cars to the market, competing more directly with likes of Ford, GM, and other car makers around the world, by the way. But this time around, Tesla's talking about tweaking their prices, this time raising them instead of decreasing them. Something they talked about in their last earnings call was simply the idea that they aren't going to be able to make as much profit as they're trying to scale up. So instead, more volume, less prices to really build that brand value, to build that kind of really loyal base that a lot of Ford and GM has in middle America. And right now they're talking about raising prices by as much as $1,000, Tom. That will make a material difference to Tesla's bottom line.
Yeah, the margin's, what, 11% still? Much juicier than they are for the likes of Ford and GM over at Tesla, even as they slash those prices. You also, and we've also got a bit of a story around Twitter, change at the top there.
We do. And look, this also, now that Twitter is not a public company anymore, it does feed into the Tesla story. At the end of the day, that inverse correlation, the idea that Elon Musk's split focus is a negative for Tesla shares, that is a positive now this time around. As you see that overnight, Twitter is potentially going to get a new CEO, an NBC executive. Those talks are not confirmed yet, but it's certainly something that has been reported, which would put Elon Musk strictly in a kind of chief technology officer kind of role, according to his tweet last night, and perhaps return some of the focus to Tesla. That's something that, again, is boosting those shares this morning.
Hey, and you know what? We don't have enough female CEOs, do we, in Silicon Valley? So this is a new name atop of the list in terms of a big tech company and a female CEO. So that's good news. In terms of these equity markets, a little bit of optimism still holding on here, Kriti. Gains in Europe of 0.4%. Upside as well being flagged in the US. The S&P E-mini is currently pointing to gains of 0.4%. It's been a pleasure as ever, Kriti. That is it for Early Edition Surveillance. Is ahead, of course, with Tom, John and Lisa. We're going to hear from Goldman Sachs Chief Economist Jan Hatzius, among others. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture does.
Is it the OK is getting ready to make a decision?
Monetary policy acting with the lag, we have to assume there are more shoes to drop here and more banks to fail.
What I'm more skeptical about is the decline in inflation.
Fed cuts being priced in right now far too aggressive.
The move for all the central banks getting from 5 to 2 is where the real challenge lies.
I do think that we are going to be looking at, again, slowing inflation, a slowdown in the economy, most likely a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Came back just to talk about the debt ceiling. So exciting, isn't it?
You did not come back just for that.
Just for that. From New York City this morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market positive by 0.4% on the S&P 500. TK, a meeting between the President and the House Speaker delayed. We're told that aides will carry on speaking. They were meant to be meeting today. That's going to be pushed back.
Yeah, there's some politics there. There was a meeting between Anne-Marie Horton and Secretary Yellen in Japan. Maybe there's some substance there about the debt ceiling. I think people are pretty much exhausted about it. What I'm focused on this morning, John, is a problem that won't go away. And Mr. Diamond mentioned it yesterday to Francine Lacroix. The morning bank charts are really, really not good on a Friday.
The problem that won't go away, I think a lot of people feel the same way about the debt ceiling conversation as well, TK. Yeah. But I'll go with you. PacWest yesterday crushed, hammered. Lisa, here's the quote from the company. The news headlines increased our customers' fears of the safety of their deposits. We understand that deposits fell 9.5% last week. In the subsequent days, the days after, news reports suggesting they were in talks with investors.
This is the sort of conundrum underneath the regional banking crisis or kerfuffle or whatever you want to call it, that if you looked at Western Alliance, they came out and said that they've actually increased deposits at the same time. So is this a PacWest problem or is this something broader? This just seems to feed into the narrative that these banks can't catch a break at a time when there already is this sort of existential pressure from higher rates.
BKX has the same technical patterns. It's not as ugly as PacWest, no question about it, but a blended index of bank stocks, John, really is not quite good on a Friday.
In the pre-market right now, 471. We'll return back to that name a little bit later in the program. This is what we look like this Friday morning. Good morning to you all and welcome to the program. Your equity market positive on the S&P 500 by 0.4%. Lisa, yields a little bit higher by 3 basis points. Your 10-year 341. Yesterday on euro dollar, very close to a break of 109. Look out for that again this morning.
She did. When you were gone, she spent her entire time on euro.
Ramo, 109.11 on the euro right now.
He's making that up. I did not spend the entire time. And just in case you're wondering, at 10 a.m., everyone's favorite gauge, the University of Michigan Sentiment Survey, comes out. I'm actually not that interested in how much the headline number comes down. I'm much more interested in expected inflation rates because last time we got this, we saw an unexpected pop in longer-term inflation expectations. And to me, this question of, Are we normalizing higher inflation is something we really have to talk about more?
100% dead on. You look at the 5 to 10 year inflation expectations, and this is this word anchored, unanchored. You're 100% correct on that.
Especially because a lot of people are not that concerned anymore about inflation. Fed speaker is still concerned about it. And today we're going to hear from San Francisco Fed President Mary Daly. She is not going to probably be trying to talk about oversight, but that is what I want to hear about. She's giving a commencement address at USC. 7:45 p.m. Eastern time, we get Fed Governor Philip Jefferson and St. Louis Fed President James Bullard. We have heard from others talking about the need to continue to combat inflation. And this weekend, those G7 finance minister meetings continue over in Japan. We're going to hear from Anne Marie Hardern. But to me, how much is the focus for these financial stability, to go back to the other question, and that chart that Tom was talking about, the KBW Regional Banking Index, the lowest right now since November 2020.
AMH coming up in about 10 minutes. Looking forward to it. Just to confirm on the euro against the dollar, a break of 109 in the last hour or so. 108.99 is the low of the session. Joining us now is Chris Morangi, the co-CIO at Gabelli Funds. Chris, wonderful to catch up with you, sir. People are so frustrated with the debt ceiling debate, and it's only just got started. Chris, can you ignore it? Can you operate without even paying attention to it?
Well, you can't ignore it. Certainly for the next 2 weeks, hopefully not 3 weeks. It's going to be in the news, something we have to pay attention to. But we don't necessarily have to act on it. And one of the hardest things for an active manager to do is sit on their hands. And that may be the prescription. When the bedrock principle of corporate finance is that T-bills are the riskless assets, and that is the very asset that may be at risk. What do? It's hard to manage around it. We're doing more of the same, looking for good cash-generating companies that have good balance sheets. They're going to wake up the day after we go off the cliff, if we go off the cliff in that unlikely circumstance, and be just fine.
Chris, Mario Gabelli with us the other day. I didn't have time to get to him on this. Let me go to you on it. You guys love value. You love fundamental analysis, and particularly you love a 3-year time frame. Can you buy the banks here?
We've never been big fans of the banks for a number of reasons. One, you think they're largely commoditized businesses, borrow short, lend long. They tend to be black boxes, and every so often, probably more often in the last decade or so, been subject to these panics. So I think the bigger issue with the banks is not so much getting depositors comfortable that their money is safe. It's they're going to have to raise the money that they pay to depositors to keep those deposits. That's going to squeeze net interest margins and ultimately earnings. And that's a harder problem to solve when treasuries are where they are.
An even harder problem to solve is a lack of lending from these institutions that punch above their weight in terms of how much they lend to the consumer, to corporations in the United States. It's been one reason why people have been moving away from U.S. equities and then going international. How much are you following that and looking more at international companies, in particular those exposed to China's recovery?
Yeah, that's been obviously year to date been a fertile place for ideas. Obviously, the rest of the world has lagged the U.S. for much of the last several years, and there are some relative bargains there. You know, one could argue that obviously they're less exposed to some of the dynamics that we have in the U.S., whether it's the debt ceiling crisis or an upcoming election. So yeah, we're always looking for non-U.S. ideas. We tend to look globally by industry, so we're not necessarily looking for European companies. We're looking for companies and industries that we like, whether it's distilled spirits or media or, you know, certain areas of industrial like agriculture.
I love that. Distilled spirits, that kind of is independent from the credit cycle, which is kind of nice.
It's Friday.
Right? Yeah, it's Friday, so you go to distilled spirits. I am curious, though, what your biggest change has been over the past month, especially given some of the turmoil and the increasing rhetoric around the debt ceiling. Putting aside how much you're worried about it, just what's insulated from that potential volatility?
Well, I would say we just came through earnings season, and my views, at least, have been mostly confirmed, which is that the economy is slowing but not falling off a cliff, like the economic cliff, not the debt ceiling cliff. You know, we're probably going to go into a recession at some point, but it's going to be manageable. And you know, companies are taking action. We're seeing more cost actions. That was a theme of the fourth quarter earnings calls, and trying to protect margins. So, absent a significant tightening of credit, which may or may not happen depending on the debt ceiling issue, we think we'll probably be okay this year.
And distilled spirits, let's say it's a company that owns Beefeater, Chris Morangi, like Pernod Ricard. You got a 15% dividend growth. Is that why you're looking at distilled spirits? They got enough free cash flow around and they actually have dividend growth? All of it off of Beefeater and Beefeater 24?
Something like that. Yeah, listen, they're obviously very long-lasting brands. They're going to last well beyond this debt crisis and many others. and there's global growth. Some of it's from China, and some of it's from other areas of the world, but they generally have pricing power and durability, and that's what we like.
Chris, wonderful to get your view. Chris Marangi there of Gabelli Funds going into the weekend talking about, Tom, distilled spirits.
Distilled spirits, and what's great there, particularly on a Friday going into Saturday and brunch, John, and you know, a Tang mimosa is great with Mum Champagne from Pernod Ricard. A Tang mimosa can be quite good.
Literally the worst thing I've ever heard. It's disgusting. It sounds like it would explode if you tried to combine
This is really serious stuff, and this goes to luxury, and what he talked there about is durability of brands and the fear that's out there, John. Some of the fears that we're going to recalibrate on this weekend, including the debt ceiling, is people are looking for stability of cash flow and products of stability, and that's where you hear Gabelli talk about these brands that just seem to endure. We make jokes about it, but it's amazing how they endure.
Or they're looking to have a drink. What was the champagne you recommended?
Mum's.
That
Mum's, very good.
That might be an improvement. That might be an improvement.
That might be an
champagne,
improvement.
just adding some.
Well, the proportions are important here. I must admit, Mum's, you know, it's a splash of Tang.
This is a breakfast show. Come on.
All right.
Well, that's what Tang's for, you know. Get the day started like the astronauts.
Bramo, keep up. One Federal Reserve official has this to say: should inflation remain high and the labour market remain tight, additional monetary policy tightening will likely be appropriate to attain a sufficiently restrictive stance of monetary policy. Governor Bowman is going to be talking about this, Bramo, a little bit later.
This is frankly one of the biggest issues that people have been talking about. Why is the market pricing in cuts when that seems to be completely off the table, at least later this year? Fed officials pushing back. What can they say? They have said this before. Markets don't care. In fact, they're pricing in even more rate cuts by the end of this year. So how do you sort of translate their rhetoric into market action other than they've simply lost credibility in a way that really gives people any guidance that they have insight?
The observation under fire this week was Mike McKee, 1 minute out after the earnings. He set up a vector of service sector inflation that is disinflation. John, to Bowman's comments, it's barely disinflation. It's just sort of kind of like barely rolled over.
Would we agree it's heading in the right direction?
Yes, that's the vector.
Can you fold jobless claims into this as well? The highest since late 2021.
We did yesterday when you weren't here. We saw the markets move.
Thanks for that, TK.
You didn't see the markets move.
Thank you. I think that was my first day off of the year.
It is.
Just to confirm.
I'm glad that you had a nice day off.
Thank you. Appreciate it.
It's really
I can talk about, do you want me to talk about my time off? Do you want to save that for later in the show?
Flesh it out for
You think that we didn't talk about it while you were gone? Exactly what you were doing and exactly your trajectory?
Fantastic atmosphere. The San Siro is absolutely rocking.
That's
Just
a stadium.
So special. So special and great to be there. Terrible scoreline.
Is it a true derby?
First 20 minutes was brutal.
It's literally the worst game
God.
ever.
It was
I
just
watched it.
brutal.
I felt
First
for
20
you.
minutes was
John,
tough.
seriously, is it equivalent to a derby in London? I mean, is it the same cultural thing?
So much better. A London derby is nowhere near how special a Milan derby is. Nowhere near.
I mean, I saw
the history, the clubs involved in the game, and just the tension, the atmosphere.
How much hate mail are you receiving
I've been
right
to a
now?
lot of these London stadiums. They are like libraries because a lot of the major fans, the real fans, are priced out of the game now. You're talking about people who pay £100 plus for a ticket. You know, the organisation of the fans at Milan, in the Curva Sud, which is where the hardcore fans, so to speak, sit, and the things that they were doing, it's amazing. You've got to be there.
Did you take your shirt off?
I didn't, but some people did. I didn't.
Where are these questions coming from, Tom? I'll ask a question that perhaps you can answer.
Actually,
okay, hold on a second. Just a question you can answer. What are the snacks like? What do people eat?
I didn't eat. They were drinking and
This
smoking.
doesn't surprise me.
I didn't watch the game. I was watching Juventus.
It was beers and cigarettes.
That's
I
don't know.
It was like non-stop. And let me tell you, there was a lot of cigarettes given the nature of the scoreline.
I mean,
there's a lot of cigarettes.
I missed it. I was watching Juventus Sevilla 1-1. I thought
you enjoyed that yesterday.
Yeah, Sevilla. I think they're great.
I was half asleep through yesterday afternoon. We've got return leg next week. Wish us the best.
You have to score 3 goals
to win. Yeah.
And they score no goal. You have to win 3-0.
Or score 2 and take it to penalties.
Oh, okay.
So we'll see. But thanks for
Still
indulging me.
doable. That's good.
It's good to make it happen.
That's good.
Put it on the Amex. Peter Cheer of Academy Securities.
Good morning, Reto.
Is going to join us in the next hour. Mike, if you're listening, we didn't put it on the Amex.
No, but Reto, if you're listening, we did.
Equity futures on the S&P positive 0.4% from New York. This is Bloomberg.
Gotta love
Fridays on Surveillance, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. The delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. And McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing in the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk had said he'll become Twitter's chief technologist. The founder of SoftBank Group, Masayoshi Son, is now personally on the hook for about $5.2 billion on side deals he set up at the company. Now, that's after SoftBank's Vision Fund venture, Capital Arm, ended the fiscal year with a record $32 billion loss. The world's largest technology investor was battered by losses on unlisted startups in its portfolio. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York.
Connection lost.
Real-time analysis. Weekdays. Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Good outcome is one in which Congress acts. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills. If Congress fails to do that, it really impairs our credit rating. We have to default on some obligation. That's something America hasn't done since 1789, and we shouldn't start now.
A fantastic conversation between Janet Yellen and the US Treasury Secretary speaking to Anne-Marie Jourdain in Japan at the G7 meetings, going into what we thought was a meeting, Tom Keene, later on today between Speaker McCarthy and the President of the United States. And Lisa, we find out that that meeting has been delayed.
But the way it's being spun is that the delay is actually positive for talks. That basically the theory is that staff level negotiators are making some progress. So they don't want to torpedo it with a lot of political rhetoric at the higher end, which is the reason why perhaps some people say this is a good thing and other people coming out.
And to be fair, I believe someone involved in the meetings has a funeral to attend. I mean, these people are human. They got things to do on a Friday afternoon.
Wasn't aware of that, Tom. Who's that?
I don't know who it was, but I believe in the reporting somebody has a funeral to attend, which they didn't go into details on. But the answer is, okay, so they wait over the weekend. What's going to change by Tuesday? Nothing. I mean, yes, it gets you closer to Yellen's X date and all that, but I just don't see it.
There is a conclusion, I think, out there that this gets worse before it gets better. It needs to get worse before it gets solved, and that framing's a little bit different.
Well, it needs to get worse where?
In the market.
Exactly. Well, there you go. And right now, what do you do if you can't get an edge? And what do you do if basically every single time you've ever traded on this before, you've gotten burned?
To so many of Americans, Japan is Tokyo. There's a whole nother Japan, and part of it is on the West Coast overlooking the sea to Korea and Russia. That's where our Anne-Marie Jourdain is. She is our Bloomberg G7 finance minister's correspondent after her most interesting interview with the Secretary of Treasury. Anne-Marie Jourdain, the secretary, is 76 years old. She has bulletproof economic academics as well. And what I really heard today is she's going to stay the course and serve out her term. Is that true?
Yes, that is true. She said this a number of times. She confirmed that with me today. I asked her a little bit of a tongue-in-cheek question at the very end if she'd consider another 4 years if President Biden were to win, because obviously he has relaunched his next bid for the White House for 2024. And she laughed, but she says she enjoys doing the work and she will continue to see out this term. Obviously, her work right now, whether it's in Washington or here in Nagata, Japan, is the debt ceiling. On the sidelines, this is what her peers at the G7 are very concerned with. The risks to the global economy, they're all emanating from the United States right now.
Anne-Marie, you know that each White House has a process of debate and dialogue. Where does Secretary Yellen fit into the debate and dialogue of the Biden 1600 Pennsylvania Avenue?
Well, when it comes to the debt ceiling, of course, the Treasury Secretary is the individual that is going to continuously update us on the X date. She said in my conversation that as we get closer to that June 1st, or as early as June 1st is what she's outlined, that potentially Treasury could run out of the extraordinary measures they've been taking since January, that she will update Congress with a more precise time frame. So her team is going to be obviously communicating all of this first and foremost to the White House. And then, of course, we got a little bit into what happens if there were to be a default, if we go over the X date. Treasury Secretary Janet Yellen was at the Fed in 2011 when the Fed went through these scenarios of what Treasury was doing. And it was under the assumption then, and I've read the transcript, it was under her assumption then that Treasury would service the debt first. She says that she has not yet spoken about these paths yet with the president. It's going to be politically fraught for this administration if there is no deal, and they need to decide to pay bondholders or pay recipients of Social Security.
Meanwhile, John was saying that it has to get worse before it gets better. In other words, people have to care more before they can resolve anything in Washington, D.C. Over at the G7 finance minister meetings, how much do they care? How much is this a focus versus people looking past this and saying the same thing that people in the markets are, which is, we've seen this movie before, it always gets resolved?
There's a lot of concern and angst amongst other financial ministers at the G7. And we heard from the German finance minister. He's saying he hopes that Washington makes a mature decision. They are all also on the edge of their seat waiting to see how this plays out. And there is concern. When you think about the makeup of this Congress, only about 33%, NBC recently did analysis of this, 33% of lawmakers were here in 2011. They witnessed that downgrade. They witnessed the pain in the market. A lot of these lawmakers are fresh. And Kevin McCarthy has a very difficult line to walk. I think many people are viewing that the negotiations stopped, that the meeting stopped today, is postponed to early next week. They do see that as progress because that means on the staff level, they are working through a number of items before they want to sit down with the principals. But next week's going to be incredibly busy. And for the Treasury Secretary, she will be meeting with bank executives. She said recently she's been speaking to business leaders, but she hasn't spoken to bank executives since January. And she wants to learn from them what is going on. And potentially she wants to put some pressure on them to start calling other members of Congress. Because for her, she does not want to even speak out loud the contingency plans. She says there is no good deal unless Congress lifts the debt ceiling.
And Marie, just quickly here, putting those ideas together, the concerns about the banking sector, not just with respect to them getting more excited about the debt default ceiling, but also just with some of the regional banking crisis. How much is the U.S. on a back foot relative to where it has been in the past, these G7 meetings?
Well, the U.S. always wants to lead, especially at a G7 like this. They want to lead when it comes to China. The G7 meeting is really the prep work as well for the ministerial meeting that will also be attending with President Biden in Hiroshima. And one thing we know they want to work on is this economic coercion against China. Secretary Yellen has spoke about the work that they're doing potentially on outbound investment. There's supposed to be an executive order. But this administration, the way they confront China, they want to do so in a multilateral approach. It's very difficult to make sure you're corralling all the troops when you come here and they're asking you questions. When is the U.S. going to raise the debt ceiling? How do we know that the treasuries that are the underlying bedrock of the global financial system are going to be paid and secure? It does put them in a very precarious place.
AMH, wonderful conversation. Fantastic job this morning. Thanks for joining us. Anne-Marie Jourdain there. Out of the G7 meeting over in Japan, I think, Lisa, you're right to lead on that question. I think to some extent it does undermine U.S. leadership at this kind of level, particularly when the United States appears to be the source of risk at the epicenter of it on several fronts. The debt ceiling debate one, the regional banking crisis, and I think a lot of people would prefer we did use that word, even if, Mohammed, you are watching, I'm sorry, you don't want us to. But on two fronts, there's two right there, and it's a problem.
Well, and that's the reason why a lot of investors are moving assets out of the U.S. Here's my question. How much is this the source of unease for people, that the U.S. might not be as reliable? How much is this the excuse that they're using at a time of fractured international relationships and a real tension between who to form alliances with, the China kind of alliance or the U.S. kind of alliance?
I think each nation has their battle. And you know, coming out of the pandemic, there's the challenges. I mean, John, the United Kingdom this week has been absolutely bizarre, the number of people that got wrong, the gloom of United Kingdom.
Probably the right word, bizarre.
You know, and it's better as well. And in France, look at Macron, look at the protests in the street, and
brutal.
Yeah, and China with its own calculus. I mean, this is just a bizarre time, and for us to have a highly repeatable. I mean, how many times since World War II have we gone through this ballet? Off the top of my head, I'm going to say 14 times.
78, I think.
Is it? Are you serious? I don't doubt it. I mean.
I sense when Lisa says a number that she's serious, and when you say it, you might not be. She might cheat guide to this show.
Wally Adeyemo said that 78 times.
Diamond said yesterday, are they riveted by it? And he said no before he went into his statesman stuff at the end, like he did in the annual letter.
Do you want some light humour? Do you remember when Trudeau said he wanted to be the dean, or there were reports that Trudeau wanted to be the dean of the G7 because he was the longest-serving leader? And no one. Can you imagine being a leader on the international stage and you're like, you know, I should be the dean, and everyone just laughs?
Yeah. Wait, no, guys, what's going on?
No, I'm the longest-serving leader of the G7. I should be the dean of the G7. And everyone's like,
Yeah, well, yeah, where's the dean right now? Does he want to be?
Who's your tailor, and why are you choosing grey suits? Yeah, that's what.
That's what you have to ask
That's what
him?
I'd be asking. That would be my lead question. That's why I'm not interviewing him.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Let's get you to the weekend. Live from New York City this morning. Good morning. Welcome to the program. Your equity market just about positive on the S&P 500, positive by 0.4%. On the week, lower marginally, trying to take a bite out of that on the S&P. On the Nasdaq, positive by 0.2%. Yesterday, some drama in Pac West, but isolated drama, I would say, did not bleed through to the rest of the market. Looking elsewhere, 2-year, 10-year, 30-year, looks a little something like this in a Treasury market. The 2-year right now, the yield is 3.90 on a 2-year. The 10-year, 3.41.21. Yield's a bit higher at the long end by 2 or 3 basis points. Again, no drama. Really the takeaway of the week, things heading in the right direction, maybe for the Federal Reserve. Claims starting to break out a bit. Inflation moving in the right direction, perhaps. And maybe you can draw the conclusion that they are done for the month of June. Others, though, Governor Bowman out there talking up the potential of going again. We'll get to that in just a moment. Let's get to foreign exchange. A break of 109 on the euro against the dollar a little bit earlier in the session. Right now, 109.12. Barely above that level, 109.12, and almost totally unchanged just for you, Lisa.
Thanks.
Again, but we have broken down this week a little bit, Lisa. Weaker euro story, dollar making a comeback.
It's actually been interesting. I've got to be honest. That's the one pocket of interest because everything else is basically range bound. I got to say, this market's in stasis. Let's be honest. It's basically
you saying I didn't miss much.
No, God. I mean, come on, you knew that. It's been really tough.
Let's get to the quote from Kelsey Barrow of JP Morgan Asset Management, weighing in on all of this and saying the following. Here's the quote. Recently released economic data should reinforce the Fed's bias to stay on hold at the June FOMC. More importantly, Tom, the forward-looking indicators suggest the road to recession is already paved. While the Fed can't contemplate rate cuts now, the market can still anticipate them occurring later in the year.
It'll be interesting to see. And of course, you go to the, as Mike McKee mentioned yesterday, you get the dots moving around at the next meeting. I believe it's June 14th. And so, you know, the Fed chat just doesn't go away as we go into the year.
You love the dot plot, don't you?
I can't stand it. I wish it would be eliminated.
Dots moving around.
Tomorrow.
What is this, a disco?
No, dots moving around, and who knows where Bull is going to land. We'll have to see on that. Kelsey Barrow with us right now, fixed income portfolio manager, JP Morgan Asset Management, briefing Mr. Diamond yesterday as he spoke to Francine Lacroix. I look at the bond market and what I would say in equities, foreign exchange, and commodities. Commodities very weak. Bonds always send a message. What's the message being sent by fixed income right now?
Well, I think the message being sent by fixed income is there is slower growth and slower inflation ahead. And, you know, we continue to look at the yield curve and look at the signal that the yield curve is giving, which is a very inverted yield curve. You have the short rate at 5% now, and you have the 10-year at 3.4%. And it's saying that, you know, things are going to slow down. So historically, what happens, our favorite yield curve is the 3-month bill rate versus the 18-month forward bill rate. Now, that is about 200 basis points inverted at this point. It's the most inverted back to the 90s. Historically, when that starts to get inverted, it's about 12 months to recession. Now, that inverted November of 2022. That puts you in about Q4 for recession.
You and the team have got first rate cut when? September?
We do, yes.
September. Do you have any idea of what they come back to, or is it still too early to make those kind of calls?
we don't necessarily think they're going back to the zero lower bound, but we are positioned long duration, which means that we have to feel that the Fed is going to be more aggressive than what's already priced into the market. So, you've probably heard the expression that, the Fed takes the stairs up and then the elevator down. I like of thinking about it like chutes and ladders, if you've ever played that children's game. Essentially, what we expect is that when the Fed does cut, they are going to be cutting fairly aggressively. And it's not because of the inflation story. We actually already see the inflation trends, the disinflationary trends, fairly well entrenched. We expect to see them over the course of the year. What's going to have to happen for them to actually cut rates is going to be to start to see cracks in the labor market. So you mentioned continuing claims. Continuing claims really, I think is showing an important trend. So if you look at continuing claims year over year, it's up 25%. That's never happened outside a recession. That's going back all the way to the 1960s.
But is that enough for cracks? I mean, honestly, this is really the question. A lot of people are saying, okay, this is what the Fed's been looking for. Maybe it's a little bit above. It still is pretty low relative to history. It's coming off an incredibly historically low base. How much is this enough of a crack, or does it have to be an acceleration in the regional banking crisis? Does it have to be commercial real estate? Does it have to be private equity?
Yeah. So what we're trying to do right now is we're trying to build a ledger. And there's things on both sides of the ledger. There are things that are saying the expansion can continue. And I think, the biggest thing there, is some of the data still in the labor market. We're still growing jobs around 200,000. That's well above the break-even rate. And as a result, the unemployment rate is still falling. But the number of things on the other side of the ledger that are suggesting that we should be slowing is just building and building and building now. And it's really allowing us to, increase our confidence that as bond managers, what we want to be doing is staying long duration, adding curve steepeners to portfolios on opportunities, where the curve may tactically flatten, and staying very up in quality in terms of our credit quality bias.
This is something that we saw with the fund flows over the past week. Global bond funds had their 7th straight week of inflows, the focus really being on developed market debt. Equity flows were interesting, and high yield I'll put in there. There were outflows of the U.S., there were inflows for the rest of the world, particularly China. Do you agree with this assessment? The U.S. is the weak spot, but globally, risk is a little bit more appealing.
Well, I do think that the stories are not the same, particularly on the central bank side, on the inflation side. You have Europe, inflation is really not showing any improvements. UK, not showing any improvements in terms of inflation. They are a little bit behind in terms of the monetary policy cycle. But I'd actually point to something more global, which is the commodity market. We were looking at the copper-gold ratio yesterday. That's actually back down to where it was 2 years ago. So, I think that the commodity market is telling you that there may be a little bit more stress globally in terms of demand. Those investors are saying, I'm not sure there's as much demand for all of this industrial product.
That tells you more about lower growth. Is that the call there? Is that what you're seeing?
Yes.
So lower yields at the long end, rate cuts to be priced in at the front end. Where does the debt ceiling fit into all of that? When you start talking about curves and mention T-bills, I'm like, how much of that at the front end of the curve is just driven by this mess right now in Washington?
So definitely there is distortions in the T-bill market as a result of the debt ceiling. I mean, you have 5 trillion, 6 trillion nearly in assets in money market funds. And they're all being moved around to try to adjust for this potential stress, this X state that Chair Yellen is, or Treasury Secretary Yellen is putting on June 1st. In our mind, ultimately, this is just another stressor at a point where, the system is fairly fragile. And what we're thinking about is kind of these unintended consequences. And there's a lot of operational risk that people don't understand that's going on in the background. The Treasury market is the backbone of the financial system. It's not just that, we talk about is the yields going up, is the yields going down. It's used as collateral. It's used as the safe haven across the world. And so if you have a bill that is going to mature during the X date, and we do run through that X date, there's a lot of questions about how things are going to work. And you mentioned, Jamie, here at Bloomberg yesterday, he's talking about the war rooms. That's what everyone is looking at now, is setting up those war rooms.
Take us inside your war room. Can you describe what that day might look like? I won't ask you for the probability that we're going to see that day. That would be unfair. But describe what you think that day might look like. I own an at-risk maturity, whatever that one might be. That day comes, we go through it. What happens? What does that look like?
Well, I do think that the money market funds are preparing for this, and that's why you're already seeing the distortions in the market. So, you know, the investors that are needing to adjust are already making those adjustments now. But I do think, of course, the broader sentiment in the market, if we were to pass the X date and not have the money that we needed to continue to pay bills, would be a fairly stressful situation for the broader markets. I think credit spreads would be widening. I think equity markets would be falling.
The Treasury's rallying?
And I think treasuries will be rallying, similar to the experience we had in 2011.
That's where I want to go. The U.S. aggregate total return index needs to go up 12% in price to get back to where it was before all this storm and thunder. Great. How long is it going to take for people to get price up, yield down, so they recover from the bond debacle of the last 2 years?
Well, the good news is they're already getting some of that.
They're
right?
getting some of it. I'll give you that. But come on. Is it quarters, or are you and Bob looking out years to see a price recovery in bonds?
Well, we've looked at how bonds perform once the Fed has paused, and bonds handily outperform cash once the Fed has paused. So we are looking at a situation where, you know, this is the time to get invested. This is the time to lock in the yields, get them now, and benefit from the capital appreciation. Once the Fed starts hiking, we expect that in Q4.
So by duration on what we believe is the last hike, seems to be the call, right?
That's it.
Kelsey, wonderful to get your view on things. Kelsey Barrow there of JP Morgan Asset Management. TK, going into this mess down in Washington, D.C., and I hate to disappoint you all, it's just getting started. You know, we're literally in the foothills of this, Tom. We've had one round of conversations in Washington. Right. The next meeting's been delayed. This is just getting going.
Yeah, you get to go the process. We mentioned this yesterday very briefly, I think, and probably not enough, and we'll mention it much more into June. There's going to be a time on a given Monday, Tuesday, where they're going to tell these clowns that by Thursday, Friday, your constituents aren't going to get their Social Security check. Whole dialogue changes. Right there. Changes. All the politics drifts away. Your constituents aren't going to get the cut check or deposit into their bank from Social Security or name another institution. Whole dialogue changes.
Which is really sort of the subtext to what Janet Yellen was saying. It's either not paying, not making good on full faith and credit in the U.S. or Social Security checks. Guess which one they're going to go for. Social Security checks would be the political angle, but not the financial angle for the U.S. They're going to make good on the full faith and credit. They are not going to necessarily make those Social Security checks.
You know, and I've been dying for you to get back, John, because I want to talk about the shock of the United Kingdom, positive GDP and that. But the answer is there's always surprises out there. And to your point, John, on process, there will be surprises within this debt ceiling debate.
Always are. Do you know what I was surprised by in the last 10 minutes? Chutes and ladders. Is that what you called it?
Yeah.
It was snake and ladders.
No, it's a JP Morgan.
Really?
We were tough for kids. We were tough for kids.
Okay,
snake and ladders.
Really?
Were you scared of snakes? Is that why they renamed it over here?
No, no. It's just that it's a childhood game. You go a ladder,
slide.
Shoots. Yeah, slides.
And
which is
also
why it's like physical.
But what's great about this is that I've heard Ferroli do this at JP Morgan too. I think Ferroli once mentioned the game of Risk.
It's a slide.
No,
well,
you slide down a snake.
But you can't slide down a snake.
You don't want to land on a snake.
But then you slide. It doesn't make any sense.
Take you out.
But literally, that's just not physically.
They just make us tougher in the UK. That's what it's about.
It just doesn't make sense.
You know what's great about this? Diamond mentioned Parcheesi yesterday.
What did he say?
He was talking about his annual letter, and he said, you know, he's looking at global risks and our Western alliances, and he brought up Parcheesi.
I am scarred by both of those games, having played them for hours upon hours during the pandemic, during rainy days with the kids, trying to keep them off screen time. And then I was like, here you go, guys.
How does Monopoly go down at your house?
Oh, I hate Monopoly.
Because at mine, it was brutal.
The side deals?
It was brutal. We'd run a book on the side. We always would.
How long would it last?
It could go on for a long time until someone flipped the board. That's usually how the game ended.
It's always how it does.
Never own the greens. Pennsylvania Avenue will kill you. Pro tip.
Thank you, Tom.
Coming up next, Evan Ryan of JMP Securities on the banking sector. Your equity market this morning, positive 0.4%. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Aides for President Joe Biden and House Speaker Kevin McCarthy continue to hammer out details on the debt ceiling after a meeting between the two leaders and other congressional members set for today was rescheduled until next week. Sources tell Bloomberg the postponement is a sign that staff talks are showing progress. Lawmakers are trying to avoid a default on payments. Finance chiefs from the world's rich economies are set to propose a new partnership on supply chains. Bloomberg's learned it would be open to other nations and will require them to have minimum standards on human rights and environmental policies. The G7 finance ministers and central bank chiefs are meeting in Niigata, Japan. Donald Trump is appealing the verdict of a New York jury that found him liable for sexual abuse and defamation. E. Jean Carroll claims that the former president raped her and then defamed her by calling her a liar. Trump lawyer Joe Tacopina says that the jury should not have been allowed to hear the so-called Access Hollywood tape. More bankers leaving Credit Suisse in the wake of its forced sale to UBS. The latest departure involves 8 senior bankers moving to Banco Santander. Now among them, Steve Geller, the head of investment banking and capital markets M&A. The moves are seen as a sign of how Santander is expanding in the U.S. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We need to finish the bank crisis. We've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. So, whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, not be surprised constantly, because some of these things have been known about for quite a while.
Really nice exchange with Jamie Dimon, the JP Morgan Chase chairman and CEO, together with Francine Lacroix over in Paris, France. Just a fantastic exchange. If you can find it on Bloomberg.com or on the Bloomberg terminal to watch it in full. Live from New York City, welcome to the program on TV and on radio. This is Bloomberg Surveillance. Your equity market still just about positive, just off session highs. Equity markets right now positive by about 0.4% on the S&P. Yields just a little bit higher too, up by 2 or 3 basis points on a 10-year, 3.41. Earlier on this morning, the euro against the dollar, a break of 109, 108 handle very briefly.
We did get a 108. I didn't know.
We had a 108. I can confirm that. The low of the session, 108.99, just off that level right now, Tom. That currency pair just about unchanged.
John, I want to review 2-year yield. We had a 405, and then boom, down to 385, I think 386, and right now 3.90 on the 2-year yield. And that goes to what we heard from JP Morgan moments ago, this idea of global slowdown, oil coming in a little bit, and copper off LME to me is something worth watching.
And some data too, jobless claims. Jobless claims just starting to break out now. Historically, you can say at these levels, not a big deal, but I think we're interested in the direction of travel and a change, and you put that together with CPI. then has contributed to a move lower in yields in the last 48 hours or so.
Maybe Jamie Dimon was the most important interview of yesterday. Right now, I'm going to suggest for those of you into the weekend on our banks, Devin Ryan is the most important interview of the day. He's with JMP Securities, a Citizens company. These people are West Coast, and they're very, very good at banking and technology. Devin, I want to take a broader view. Lisa and John want to go narrow. It would be real simple. I look at the future of your world, and what I see is a struggle for scale. I don't understand how smaller banks get margin efficiency. Forget about net interest margin and all the econobabble. Is this going to be a battle for scale in the next 2 to 3 years to provide shareholder return?
Hey, good morning, Tom. I think you're right. I mean, scale in banking has been important for the last decade. I think it's becoming more important, and that's why you've seen consolidation. We've had thousands and thousands of banks consolidate, but we still have over 4,000 banks today. And so there needs to be more consolidation. Unfortunately, some of the recent developments, I think TD, First Horizon, a little bit of a negative for the consolidation case, it's more challenging.
Right.
And so absolutely, it's a key point. But I think the key here is, let's not forget what's driving this action. I think we're in a little bit of a negative feedback loop right now with deposits and uninsured deposits. And that's really key that the industry figures that out, because you're seeing declining share prices driving deposit movement, even when there's really not anything dramatically changing fundamentally.
Lisa, this is really important. Didn't come up with Mr. Dimon yesterday, but everybody of a certain vintage has tattooed to their brain the phrase E.F. Hutton. E.F. Hutton went down in flames with George Ball because they couldn't find scale, and particularly they missed technological investment, and one day the party just stopped. And I really wonder, if we go from 4,000 banks to 3,000 banks, is that going to be enough to keep scale so people keep investing?
And this is something that we are seeing with some on the margins, trying to parse out the ones with scale, the PNCs, the U.S. banks of the world, rather than some of the smaller cohorts. I'm curious, Jamie Dimon did blame short selling as part of the problem, saying that the U.S. government should investigate short scale sellers to some degree. Do you agree?
Yeah, I think, selling, whether it's regular selling or short selling, the industry is mired by a lot of uncertainty right now. And, banks are supposed to be boring, and that's why a lot of investors invest in them, that there's kind of a slow and steady return. And so whether it's sellers or shorts, I do think the industry is effectively being attacked. And there are solutions. As I just mentioned, we need to get the uninsured deposit issue ring-fenced, and there's solutions to do that. And so, potentially banning shorts is something that could relieve some near-term pressure. There's other provisions within Dodd-Frank that would allow short selling to be more transparent. And so that's something else that could be proposed here and pushed forward relatively quickly. But I think that is kind of not getting at the root of the problem here in the banking space. It's really, in my opinion, uninsured deposits, and they need to find a solution for that. And there are solutions that are available to to Congress and to regulators.
But even as we put that on the table, it doesn't seem as though this is necessarily a crisis of confidence of being able to get your money back, right? This does seem like there has been some sort of insurance policy that is backstopping where people's money is going. There is something bigger going on. And I do wonder what you say to this idea that perhaps we've gotten to a place where, yes, it is going to shrink. And yes, maybe private equity is going to take a bigger role as they try to push to have some sort of loss sharing agreements with the government, be more involved in some of these sales.
Well, again, I think it's a complicated situation, but the law sharing, the government stepping in, I think is a temporary solution. We need to find a solution that puts the banks on healthy ground. The small and mid-sized banks are key to the economy, make up over 50% of commercial loans, residential real estate loans, almost 80% of CRE loans. And so I think having a broad and healthy banking system that's not consolidated into 4 companies really should be a goal of regulators, should be a goal of legislators. And I think they do care about that. But you need to get, again, kind of going back to the same point, the root of the issue, which I think right now is this uninsured deposits. Of course, there's some yield-seeking behavior. Of course, there could be credit concerns, but that's a healthy conversation on banks. But that's not the key driver right now of this recent turmoil, in our opinion. It's much more the uninsured piece, which is driving the stock prices down, and that's the negative feedback loop that we spoke about.
Taking a step back, Devin, there's a theory out there that the banking system issues that we've seen in the U.S. is one reason why people see that the U.S. is less attractive as an investment proposition, and they're going elsewhere. Do you think that there's validity to this, that the banking fissures are actually weakening the U.S.'s international profile?
I disagree with that. I mean, listen, the U.S. system is the deepest capital markets in the world. Companies and individuals continue to try to come here and put capital into our system. So I don't see that changing. In near term, this is a hiccup. And as I mentioned, there are solutions that, have existed before. There's programs the government has put in place to fix some of the issues that are re-rising now. And also, we are in a slowing economy. And it's a slowing economy in the U.S. It's a slowing economy internationally. And, financials in that backdrop, banks in that backdrop generally are not the first place that people look to allocate capital. And I think that is playing into the recent stress. But that's not, again, the key thing here. The key thing, in our opinion, is around uninsured deposits and that negative.
Devin, allow me to jump in because you've said that a few times. Is that the problem at PacWest? PacWest have got more than 70% of deposits insured. Is that really the problem at banks like PacWest?
Well, I think the answer is yes, just in that we've already seen the money move. And so once you're in the headlines, the negative feedback loop starts. And so even though the fundamental story really isn't changing, there's not a new update from month to month, as the stocks have already moved and you've already seen the deposit movement in an accelerated way, investors or shorts continue to push on those individual names. And so what we've seen in recent failures is there's no relief for equity holders. Equity holders are wiped out, right? So until equity holders have a way to kind of push back or there's a bounce back in stock prices, vulnerable names keep getting pushed. And so you need to address, again, I think the root issue so that we take some of these names out of the headlines and you don't go to the next bank or the next bank after that. And I think that's key. Certain banks have already had so much headline pressure that it's a challenging moment. But we need to make sure that we don't go down the line here. And I think that is addressing some of these issues that again, can be addressed.
Devin Ryan at JMP Securities. Devin, thanks for that. Thank you very much.
Thank you.
Certainly that was the origin of these issues, the stress of the last couple of months. I think the conversation, Lisa, is whether that's shifted and morphed into concerns about something else.
Profitability among those things, which doesn't really get helped with the insurance. I mean, that's a scale issue, but it's also an issue of rapidly rising rates and a whole bunch of assets that were priced out at a very different rate with possibly negative real interest margins.
Somebody had a chart out just in the last 12 hours, 3-month T-bill, and again, it's all debt ceiling touched, I know, but there's a point where you look at this moonshot in short-term yields. I mean, what does it do to the average bank removed from all this? They didn't sell jumbo mortgages for 1 or 2%. There's a point where you get overcome by events.
Well, you've got to acknowledge that yield-seeking behavior is a part of the dynamic of the last month or so, without a doubt. I don't know why short selling always becomes the bogeyman. It's such a distraction.
No, I totally
It's
agree
always
with that.
such a distraction.
Okay, what do you think the trading desk said to Jamie Dimon after that? Whoa, hold on a second.
Credit to him, he did back it up by saying that he doesn't think that that's the major issue right now.
And in fairness.
And ultimately, that was poor management of some institutions.
Fair. I think it's going to be interesting to see whether they actually go through with that. They always say this.
I know.
It never works out.
It's the bogeyman. It's like, short sellers did it.
Yeah.
It's always, some mean person in the corner.
It's true.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
With monetary policy acting with the lag, we have to assume there are more shoes to drop here and more banks to fail.
What I'm more skeptical about is the decline in inflation.
Fed cuts being priced in right now far too aggressive.
The move for all the central banks getting from 5 to 2 is where the real challenge lies.
I do think that we are going to be looking at, again, slowing inflation, a slowdown in the economy, most likely a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Solution: you pay Congress in T-bills this month. It's that easy.
They would
At-risk
love that.
securities, and then let's see if they deal with things and you get paid on time.
You're getting real yield.
Beautiful.
Suddenly that would be a positive thing.
Well, only if the government pays, right? There is an incentive to get over the line.
I mentioned this in the last hour. I think this is absolutely critical. They're going to go, I'm sorry, you're in the X district of Ohio. Your constituents aren't going to get their Social Security check. Problem goes away. Just
Instantly.
like that. Instantly.
From New York
Instantly
City
goes
this
away.
morning. Good morning to you all. Welcome to the program on TV and radio. This is Bloomberg Surveillance. Your equity market just about positive on the S&P 500 by 0.4%. In the foothills of a big debate about the debt ceiling. There was meant to be a meeting today between the Speaker of the House, McCarthy, and the President of the United States, Joe Biden. And Tom, that meeting has been pushed back, and we are informed that staff-level talks are ongoing.
Staff-level talks, and they're important. There's a lot of complexities here in that, but I think they're wide apart. Greg Valliere, who's attuned to this as anybody at AGF Investment, says, you know what, it's just what it is. There's no agreement at all, and they have to wait for a catalyst, and the catalyst comes from the calendar. They got to tick ever closer to June, whatever.
Whatever it is, towards the X
We're
date.
nowhere near that.
Might be June 1. Who knows? Yeah. We're going to do a ton of scenario analysis that may turn out to be absolutely pointless, Bramo. Let's see if it is different this time.
Wait.
Is it different this time?
Well, no. I mean, that's basically what everyone's saying.
How much ink is going to be wasted over the next couple of weeks on scenario analysis of a bunch of things that just don't
Are
materialize?
you trying to get me not to show up to
No,
work?
just
I mean,
come on.
honestly, this is really what everyone's dealing with, which is a reason why you're not seeing that risk premium built into equities, because people are like, why waste my time? Why waste my paycheck on your crisis that you are going to resolve at the last minute? Why make me part of your theater?
Here's the worry. The VIX is 16 level, 4161 SPX, 33,500 Dow. The NASDAQ 100 to me is an act of God, 13,500. John, equities have been like a rock given all the scenario uncertainty.
Nothing's happened.
Yeah.
Basically, it's such a tightly defined trading range of the year so far.
It is
3,800 to 4,200 on the S&P 500. I'd go one step further. Have a look at the two-year yield.
Exactly. That's
the
where
two-year
we're
yield's not really done much either.
It's
This
been
market
collared.
hasn't done much.
It's been collared. You missed this yesterday, but I did the chart, and it's like 380. If you get a 379, 378, maybe that gets you outside the zone, yield lower, price up. We're not there yet. We're still in the zone.
It's not a comfortable stasis, though. This isn't a relaxing time for investors. And this is what I've really noticed. It's not that people are saying, okay, we're happy with our investments. They're sitting on their hands. They're waiting for a catalyst. And that's what makes me think we could be in for some extreme motions once there's a catalyst, or else we're going to do this for the rest of the year.
We're playing chicken with the S&P 500. It's just, it's ridiculous, but we're doing it again. On the S&P at the moment, Bramo, we're positive 0.4% on the S&P this morning.
And we're waiting to play perhaps Chutes and Ladders if there is some sort of catalyst. Today, 10 a.m., we get the University of Michigan Sentiment Survey. I am looking at the headline number, which is expected to come in softer, but possibly more important, we are going to get the longer-term projections, given the fact that last time they went up for the 5 to 10 year sector. To me, this is interesting. People are getting used to higher inflation, and that has got to be really concerning. Today, perhaps we get a sense of just how concerning that is. We get Fed Speaker, San Francisco Fed President Mary Daly, who will be speaking at a commencement address at USC. I am curious to see if she addresses what happened at her own bank and the oversight there with respect to Silicon Valley Bank. I mean, that's what everybody wants to know. We haven't heard a lot from her. At 7:45 p.m. Eastern, we have 5 p.m. Eastern, we have Fed. We're seeing there is raising issues for global financial stability, and how much Janet Yellen really has to speak to that.
Peter Chair with us around the table, the head of macro strategy at Academy Securities. Pete, good morning. Let's start with this one. Who's more complacent right now, this market or politicians in Washington?
I think the politicians in Washington, because this market, I think, is trying to figure out, do we get some sort of soft landing? Does this work out? Do we get through a bunch of these problems or not? And I think that's where we're on. There's potential for a large gap either direction. I think the people in D.C. have kind of lost the focus. There's plenty of other things we should be focusing on other than the debt ceiling, and that's just a time sink at this point.
We've got copper rolling over. I look carefully at the Bloomberg Commodity Index. It's good mathematics, and it's not a pretty chart. Your firm has a wonderful Pacific Rim study ongoing. What do you see there? Is it real slowdown?
Yeah, I think China is having some troubles, but I think even beyond that, I really sticking to this theme that we're going from made in China to made by China. Where across the globe, China is now trying to compete with our products, compete with our companies more than they ever did. It's something we're hearing from companies. We're running into people who are losing contracts denominated in the Chinese currency. I think that's a long-going play. China's still struggling, but it's going to be at our expense as well.
With the military exposure of your firm, can you invest in Taiwan, even with the United States committing to 3 and indeed 4 military bases in the Philippines? Is Taiwan uninvestable?
Yeah, so I think our firm has a pretty strong view that China is not going to invade Taiwan anymore anytime soon. The defenses of Taiwan are very strong. China's learned a bunch of lessons from Russia. Having said that, there is this erosion of confidence and how we're going to be able to deal with Taiwan over time. So I think we've got to be careful there.
Right now, a lot of people are cautious. We are seeing this sort of volatility come down, people getting a sense that they're just waiting for Godot, waiting for some catalyst, waiting for a sense of which direction we're going to pivot in. What are you looking for to really represent that catalyst?
So I think people have been patient. They latched onto the AI story, so that's been what all the bulls have gravitated to, and it's an interesting story. There's definitely some run room there. For me, the catalyst is what happens with the banking. Do we really see this slowdown? And when we look at that the SLOOS report, which we never really pay that much attention to.
We do now.
We do now, apparently. But I think really the important thing there was it's a demand side issue, right? There's lack of demand for loans. It's not just that banks don't have deposits. So I think we're seeing the economy slow down. Jobs data, a lot of it's still good. You're seeing little bits and pieces, like we're starting to see a tick up in unemployment claims. How good is that when every headline really is about layoffs? So I think there's a slow bleed. It's slowly playing into the economy, and I'm looking for either confirmation for that or that somehow we've avoided that problem.
Okay, so what is that problem, right? Because things are slowing down, and this is by design. And this is sort of the difficulty where people are saying, that's happening. And it's a good thing. Yes, we're seeing a rise in unemployment claims. This is exactly what the Fed wanted. Yes, we're seeing deceleration. Okay, great. And guess what? Companies are actually more profitable because margins are increasing. They're passing along those prices. When is it a negative?
I think it's already a negative. I think one of the things is we're addressing something that was really a supply chain shock, and we're trying to use monetary policy to address a supply chain shock. So that was a problem. So we're doing the wrong things, and I think we're forgetting about all these lags, right? It takes months and months from the person who gets let go by the time they get their severance package and all these things to hit the economy. I think the rate hikes from last November haven't even really hit the economy, right? People rolling over their car loans. Everyone I talk to who's looking at releasing a car after their 3 years, they're shocked by the price. They didn't have to deal with that a year ago if their lease wasn't coming due. So I think that lag is something we've all forgotten about in this real-time economy.
One of the quiet charts of the week were bankruptcies in the United States. I was thunderstruck how they're elevated here.
It's a process. I think we're all waiting for this event. Boom. It's a process. And you can put the pieces together. The other issue that I think a lot of people have got right now, Pete, is that we had excessive monetary easing for so long, for an extended period of time, way beyond the time that we needed it. And then the Federal Reserve had to play catch up, not front loading. I hate that language. It wasn't front loading, it was back loading. They were late. And we're trying to work out what the price is we've got to pay for that as market participants. Is it just a 30% move on the NASDAQ last year, or is there more to come?
I think there's going to be more to come, and I completely agree. They were very late, which is ironic. Even as they were discussing rate hikes, they were still doing large-scale asset purchases into January 2022, so they missed a lot on that. And when I look at the banking crisis, or whatever you want to call it, to me it's very simple. Basically, during COVID, banks went from 13 trillion to 18 trillion. So in 2 years, they took in $5 trillion of assets, which is much more than the 500 billion they normally take in, at the exact worst time to find good investments. So it would not be surprising to find that some percentage of the banks were very conservative and dealt with it well, and some maybe got a little bit aggressive. And I think that's what's playing out right now. This no longer has anything to do with uninsured deposits. It's about what did banks do with the money when they took it in, and what are they going to pay people to keep the deposits? Because I don't think anyone's really worried about their deposits defaulting. It's now, am I getting a fair rate on that? And what does this bank own on the back of that?
Well said, Pete. We could be facing, what, years of some of these banks just being quite unprofitable for a long time.
Yeah, I think that's right. I think it's going to be a unwind period. And my big concern, it's a tail risk. I don't think it happens, but the tail risk is as one comes through and their balance sheet becomes available for sale, it drags prices down, bringing another one into that leg, so that domino effect. So I think that's what we've got to be working on. The Fed's got to be very careful about hiking rates. They've got to be very careful about causing pressure on bond prices, because that will, basically create that domino effect.
We'll be talking about this for years. Years. Mortgages sold at 2%. We'll be talking about this for decades. People aren't going to sell their houses.
Well,
we know this.
The running joke's been, for a lot of people, certainly last year, your best asset was your mortgage. So it's like crazy to think about that.
Who's going to sell their house? Who on earth is going to sell their house unless they're forced to move for a job or something out of their control happens? Who is voluntarily going to sell their house with a 30-year mortgage on it with a rate of 2 to 3%?
And so that's been one of the ironies of this whole thing, right? The home builders are doing well because they can build a new house that someone has to move in, because there is this supply shortage because of this weird phenomenon about mortgages.
Well, and then there's this question about financial engineering, where people are going to basically just pass along those mortgages. I don't know. Taking a step back, I just wonder how much this is normal, right? That you get a washed out in banks, and how much is different? How much is this something that is a unique distortion?
I have no idea what normal is anymore. What's normal?
We don't know what normal is.
We've had a distortion for like the last 10, 15 years.
This was a calculus exercise. The first and second derivative of the rate change, and Peter was way out front on this, was truly historic. If you get yields coming back in a Steve Major way, in an Ed Hyman way, in a David Rosenberg way, does this self-adjust price up, yield down? No one's looking for that. No one's looking. You talk 2 to 3% mortgages. What if you get back to a 3.6% mortgage?
And I would just add the one thing, right? We never experienced these large-scale asset purchases or QE until 2008. I don't think we have any idea how those really affect asset prices or not. So I think people like to try and convert, how much QE is or QT is a basis point. I don't think we have any idea, and I think QE and QT go much more directly to asset prices.
Right.
And you keep looking at the Fed balance sheet and the stock market.
Steve Rasciuto's heated about this at Mizuno.
Steve's
he
great.
says, just stop it now.
You know what normal is? It's when you entered the industry on Wall Street. Whatever date that was.
Exactly. That's true. Very true.
That's what you believe. Or when you first got your mortgage. I was speaking to someone at the airport the other day.
Totally.
And he was, let me tell you about the 80s. just like what I had to pay in my. It's always the same.
Can I say thank you?
Sure, of
I
course.
had no idea about snakes and ladders. I had no idea.
Oh, there you go.
No idea.
It makes no sense.
It's history. It goes back to India, the Raj, all that.
Did they slide down snakes back then?
No, but they're scary, and that's why they changed the chutes in America in
Shoots are not
1943.
too scary for the kids.
1943.
They make them soft here.
That's
what's happening.
Pharaoh shows up. I learned something every single Friday.
They're going soft.
I'll send the
Hey,
Bravo
you know
boys over
what?
to
You
the
were
Farrah
here 2 days
household.
this week. You should come in.
This is what Governor Youngkin was talking about.
Oh my gosh.
This is what he was talking about.
Shoots and ladders?
Hey, you know, what's happening in education these days.
Shoots and ladders. Stick some snakes on them.
That's a conversation for another time. Peter Chair of Academy Securities, thank you, sir. Equity markets positive 0.4%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. And that delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk has said he'll become Twitter's chief technologist. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first
First quarter results impressive.
Revenue beat is amazing.
with exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
The only good outcome is one in which Congress acts. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills. If Congress fails to do that, it really impairs our credit rating. We have to default on some obligation. That's something America hasn't done since 1789, and we shouldn't start now.
We'd have to default on some obligation with very little transparency on what that obligation might be. Janet Yellen, the U.S. Treasury Secretary, speaking to AMH in Japan at the G7 meetings. Live from New York City this morning. Welcome to the program and good morning. Your equity market positive 0.4% on the S&P 500. A lift to close out the week. Let's see if this sticks going into the weekend. Futures positive, yields higher by 3 basis points, 341.96 on a 10-year. Tom, has there been a discussion between the President of the United States and his Treasury Secretary about which obligation that might be?
Yeah,
what is the hierarchy? What are the contingency plans they've got in place?
To the conversation last hour, John, I think you're dead on. We don't really know the process between the Secretary of Treasury and this president. I'm really unclear on the back and forth and how it works, given all the other advisors in the White House. With Ron Klain, it was easy. Ron Klain ran things. But right now, I'm really not sure.
They are clearly unwilling to be fully transparent about this. For negotiation purposes, from my standpoint, this is why they don't want to talk about so-called hypotheticals. It would be ridiculous to me, just the idea that you don't have a Treasury Secretary and a President that have had this discussion, Lisa. I can't get my head around that. That would be irresponsible as a policymaker not to have these contingency plans in place, or at least not to be having these discussions weeks away from what you believe might be the X date.
I'm sure they are. If they're considering using the 14th Amendment of the Constitution to potentially just keep on paying and keep on going, they are having these discussions. They are making these contingency plans. They don't want to talk about them, though, and that's we're going to basically have to be used to that. The political theater that happens outside, and then the real talks that happen in the room.
A brief on-site and into the weekend with us, Anne-Marie Horton, our Bloomberg Washington correspondent in Niigata, Japan. This is on the west coast of Japan, away from Tokyo, but with a focused G7 finance ministers meeting. What I'm absolutely fascinated about, Anne-Marie, is we have a Secretary of Treasury exceptionally experienced in economics and labor dynamics. She basically invented the word slack within the modern economic jargon. We also have a president with years and years of legislative experience. That's a powerful combo. How will President Biden and Janet Yellen, when you get back to Washington, how will they move this process given all their experience?
Well, we know from Secretary Yellen what she spoke to me about here at the G7 is that when she gets back, she will be meeting with banking executives. What was interesting, and says recently she only spoke to business leaders in different sectors of the American economy. She hasn't spoken to banking executives about the debt ceiling since she first put out that letter in January. And she wants to learn from them about their angst. Obviously, we know Jamie Dimon yesterday told Francine Lacroix that he has set up a war room. And then you have the President of the United States, who was only going to be there for half the week, because then he's coming here in Japan to meet with leaders at Hiroshima for the G7 ministerial meeting. So the negotiations right now on the political front are happening with his staff and the legislative staff of Speaker McCarthy. That is really who is going to be able to hammer out this deal. And that's why likely part of the reason this meeting today, that was supposed to be today, is postponed. They think they are making some progress on the staff level before they sit down with all the principals. But as you said, Biden really likes to tout himself as this epic deal maker. Spent years in the Senate. He was the one that worked with Mitch McConnell when he was vice president to get a deal done. And the Treasury Secretary has great relationships with those on Wall Street. Can they finesse this? Her putting some pressure on bank executives and him potentially being able to get a deal done? We have to wait and see.
In your discussion today, Anne-Marie, between yourself and the Treasury Secretary, did you get a sense in any way, shape or form of what the contingency planning might look like if we go through the so-called X date?
I didn't, because we pressed her on this a number of times, because there is this assumption that she herself was in the room for that in 2011 that Treasury would prioritize debt payments. They would make sure that Treasury principal, securities, all of that was being paid. When I asked her about this, she has yet to discuss with the president those contingencies. Something will have to default, she said. But it is unclear at this moment if that is going to be whether or not Treasury is going to service the debt, which would obviously be quite catastrophic for the global financial system, or things like social service recipients, individuals that are on Social Security, individuals that get a paycheck from the government. For this president, it's going to be very politically unattainable for him to want to pay, say, Chinese bondholders and not those Americans that are waiting for their Social Security check.
Anne-Marie, one of the discussions, in addition to the debt ceiling, in addition to financial stress, has been China. And just quickly here, there is this feeling in the market that perhaps there's a little bit of a mending of ties between the U.S. and China with a number of meetings and outreaches. What's your sense about Janet Yellen and whether she plans to go to Beijing, who she plans to meet with, and what the timeline is?
So I think off the heels of this meeting we've learned about from Jake Sullivan and Wang Yi in Vienna, 2 days they sat together, potentially can open up the sequencing, as Secretary Yellen described it to me, of U.S. officials going to Beijing. She says that she will go at the appropriate time. She told the Financial Times a month ago that she was waiting for her counterpart to be replaced in China. It was Liu He, and now it's Hu Lifeng. And the issue is the counterpart has been in place for weeks, and she has yet to even speak to him over the phone. So there's been no contact yet from, on the Treasury level, the highest individual in Washington and then the highest individual in terms of finance in Beijing. But she still says she plans to go. But I thought it was interesting they have yet to even have a phone conversation. This is part of the angst you hear from other countries. They want to make sure that the two largest economies in the world are communicating. And at this moment, those conversations have been fraught, but potentially on the heels of this Vienna meeting with Wang Yi and Jake Sullivan, that can open up doors for more conversations between Secretary Yellen. Also, Gina Raimondo, the Commerce Secretary, says she plans to go, as well, of course, Secretary of State Antony Blinken, who was supposed to go but then was postponed because of course, that alleged Chinese spy balloon.
MH, just to wrap things up, TK mentioned this in a previous hour. Got a bunch of political leaders with problems at home. Not just the President of the United States, as Tom indicated, also the French leader, Emmanuel Macron, with the riots in Paris over the last few months that he tried to distract us from that speech. Do you remember that?
Yes,
that interview, rather, with Politico. Yeah, great interview. We'll talk about that another time. MH, what can they agree on at the G7 level? Who's in a position of strength?
Yeah, it's a very interesting point because you have the German finance minister coming out and saying that he hopes Washington makes the mature decision. Everyone here is concerned about the debt ceiling in Washington, and for them, that's one of the biggest economic risks to the global financial system. So at the same time as the United States is trying to shore up their allies as they go after China in a number of economic ways, the latest is going to be about outbound investments is what they want to focus on in Hiroshima. It's difficult when what is front and center and top of mind of every single leader here is whether or not the U.S. is going to be able to pay its bills in a month.
MH, great to catch up. Tremendous conversation. Anne-Marie, one of the hardest working people I know, in this business. Just fantastic. With Janet Yellen a little bit earlier this morning.
I mean, you can point out the romance of flying to the other side of the world for 6 hours or 8 hours or 12 hours. I've done it. It's no fun. I mean, the romance, there's just brutal.
Nothing romantic about it, Tom.
Brutal. Absolutely brutal.
Is that your idea of romance?
No, she's all right. I think she's got us
explains a lot.
She's off all next week.
Is that it?
No, it's like great. It's like, I'm in Japan, and airport, car, hotel, car, airport. I went to Japan.
Squeeze some Yellen in between.
Yeah.
Nice.
Looks like work.
Jan Hatzius at Goldman coming up next. Looking forward to that conversation. The Goldman Sachs chief economist just around the corner on TV and radio with your equity market positive 0.35% on the S&P 500. Yields just a little bit higher, up 3 basis points. Your 10-year 341.77 from New York. This is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Bramo's theory for a hot real estate market in New York City. Honestly, I wish we could share this on air. That is amazing. Would you like to share that now?
I'm actually not alone in this. It's household formation. People are sick of living with each other after a pandemic, and so they're moving out.
They're like breaking up and
breaking up.
We call that divorce. Thank you, Lisa.
Let's move on. We have a great guest. We don't need to go there.
TK, you're right. We've got to get the mics on at the commercial breaks.
No, I want to do like sports, big, little, and you know, they can see me mixing my thing.
Nice. Thanks for that, Lisa. Okay. The equity market on the S&P 500. Welcome. Looks like this on the S&P, positive 0.3%, up by 0.16% on the Nasdaq. Just a little lift here going into the weekend. Looking at the bond market, 2-year, 10-year, 30-year, shaping up as follows. Claims breaking out. Inflation in the right direction for some, bringing yields down over the last couple of days. Your 2-year down to about 391 this morning. Yields higher by a basis point there. Up 3 on a 10-year, on a 30-year too. Up a similar amount. The curve steepening just a little bit, with the emphasis on a little bit. In the FX market, the euro, a break of 109 against the dollar a little bit earlier this morning. We do that again. 108.90 right now, Bramo. We're negative on that currency pair, 0.2%. A bit of euro weakness out there through the week.
Yeah, and actually we're seeing more broadly a bit of dollar strength, perhaps just because that trade got so crowded. What I'm looking at in terms of the movers are what's accounting for the gains so far, year to date. It is almost entirely artificial intelligence mentions. I mean, essentially, that is the argument of Societe Generale, that basically, if you stripped out some of the gainers due to artificial intelligence, there would be a negative returns on the S&P 500. NVIDIA, up 96% year to date, just to give you a sense. Microsoft, up almost 30%. Google, or Alphabet, 32%. And basically their theory is this is entirely due to this excitement around ChatGPT and how much artificial intelligence is going to totally change the universe. I find this fascinating that without this, U.S. stocks would be down. I find this actually really compelling given that this has been the one hot trend of the year amid a complete dearth of anything else.
We've heard a couple of analysts say that Google is just doing the better job of PR around AI relative to some of the other players, or rather Microsoft is doing a better job relative to Google, who hasn't done a good job at all. Don't you find that just ridiculous that it's about who's doing a better PR job right now?
It shows that people are going to trade on hope. Americans going to keep doing what they do. I mean, honestly, this is part of the enthusiasm of creating something new. And Google, actually, to their credit, recently realized that perhaps they weren't doing a good enough advertising job. And so they came out and they started to do a better advertising job and saying that we have really good kinds of tools that we can implement.
I have the same skepticism, but my brother's a fancy pants computer guy. And he says ChatGPT has gone. He says changes the game.
Best performance stock on the S&P this year.
Changes the game.
Meta up by 96% yesterday. After that, NVIDIA, as Lisa points out, up by 95.5%. We're going to do Fed speak, Tom. Governor Michelle Bowman saying the central bank will need to raise interest rates further and hold them higher for longer if inflation doesn't cool. Jan Hatzius and a team over at Goldman still calling for a pause at the next meeting and saying, here's the latest from them. The CPI report is supportive of our call for a pause at the June FOMC meeting. The shelter step down, Tom, looks increasingly durable Inflation breadth softened somewhat further, and the strength in used car prices is likely temporary.
Just in the last 48 hours, this has changed because of the misguess on housing in the United Kingdom. Completely different story, but it shows you how humility is in order here. What's the key point you have on a humility at the moment, Dr. Hatzius? You look at the things you've made right, the things you've made wrong into the first 5 months of 2023. What's the humility you're writing about this weekend on inflation?
I would say mostly things have evolved the way we thought, at least in the labor market. For me, the labor market's really key, and the rebalancing that we're seeing there, I think is very encouraging, with job openings coming down and the unemployment rate still staying very low. So it's a very benign form of rebalancing. In terms of the tactics of Fed policy, I would have thought a pause in March would have made sense, and we thought that was the likely outcome. But I think, now a lot of humility is in order as we go into the next few months. There's obviously a lot of event risk, but I would say we're reasonably well set up in terms of the disinflation process that's underway.
The power game that's out there that you have to battle every day is on the x-axis, and to me, the markets are in short term. They're looking for drama to Labor Day, drama to October. Does Goldman Sachs extend out the x-axis, the healing out of the pandemic? Is the things we're talking about for October 23 really the things we're going to be talking about in June of 2024?
Well, I think by June of 2024, I would have, our baseline has the rebalancing in the labor market completed at that point, and inflation, down from, right now we're 4.5. By next year, I think we'll be below 3%. So I do think we're going to be in a very different place. In terms of the funds rate, though, I would expect that we'll still be, close to here, or in fact, where we are right now. I mean, our baseline forecast is that the funds rate stays at 5 to 5.25 for the next year or so. And, risks to that, certainly on the downside. I think it's much more likely that you go from 5 to 3 than that you go from 5 to 7.
Okay.
But I do think the market is overly aggressive in building in rate cuts.
Let's explore that a little bit further. This was a question I got from a Bloomberg subscriber just moments ago, as soon as they knew that you were appearing. They said if stocks rally big over the summer because of the Fed pause, the economy holds up, the debt limit issue is sorted, what does the Fed do in the fall? How would you think about that? Just a piece of scenario analysis. What would that mean for you?
Well, I mean, directionally, it would point to, a higher funds rate, and obviously the market is below the current level in terms of forward pricing. So, holding would already be, would already have some impact in terms of an impulse. But you might need, additional hikes. That's certainly a possibility. I don't think it's, particularly likely. If we see ongoing adjustment, if we see adjustment in inflation and the labor market, then there's also going to be a little bit more tolerance for easier financial conditions and stronger growth. But there's a limit to it.
If forward pricing adjusts upwards towards the Federal Reserve, would you consider that a tightening of policy somewhat? Is that how you'd think about it?
It depends on what it's driven by. If it's driven by a stronger economy, then no. If it's driven by, Fed messaging that they're less willing to cut, relative to the market's expectation, then I would view it as a tightening.
People are waiting for something big to happen because they're impatient and they're looking for a trading opportunity. And I'm curious, what is the next shoe to drop? Is it housing prices crashing?
Well, housing, I think, we had declines in house prices in the second half of last year. We actually have seen some stabilization in 2023 so far. So I wouldn't really expect, barring another major shock, for example, the sort of thing that John was talking about, significant further upward pressure on the funds rate. I wouldn't really expect a sharp drop in house prices from here. There's still some, I think, erosion happening. Some of that is also because the official indices lag behind reality somewhat, but I wouldn't expect that to be a big shock.
Was the banking crisis basically resolved and now it's just sort of the slow bleed of the reality of higher yields, or is there something percolating there that you're keeping an eye on as also a potential catalyst, especially if what John said does come to pass, where people price out some of those rate cuts?
I mean, our view is that the banking turmoil is going to be a drag on growth. We've said about 40 basis points or so, half a percentage point or a little less.
How do you come up with that, Jan? Can I ask? How do you and the team come up with that 40, 50 basis points number?
Well, the primary approach was to basically look at past changes in lending conditions in the Fed's senior loan officer survey, making assumptions about where that goes, and then feeding that into our model, which also includes financial conditions, and then getting sort of the extra effect over and above what you'd normally expect in a tightening financial conditions environment. That's how we came up with it. I would say that so far what we've seen in these surveys has been less pronounced. There's been less of a tightening than we expected. And now the question is it just delayed, or are we just seeing a smaller impact? I think that's a little bit too early to tell, also because obviously some of these banking issues are not yet resolved. There's still pressure in the market. So the last chapter probably hasn't been written yet. But right now, we're still estimating that 40 basis point number.
What's more pernicious for this economy? For it to be a slow burn, a slow tick, tick, tick of reduced lending, of tightening credit standards, or a sudden shock?
Well, a sudden shock is more pernicious because a slow burn, there are a lot of other factors in the economy that can offset the slow burn. Policy can react to it. So, clearly something that happens very suddenly in large size is much more difficult to manage if you're an economic policymaker. So I'll go with a quick shock here.
Long ago and far away, there was a guy named O'Neill and Dudley. They were at Goldman Sachs with Ed McKelvey, and there's this young whippersnapper out of Wisconsin-Madison in Germany who made his name on mortgage equity withdrawal. John Farrell brought up in the last hour the new housing dilemma. We have an America of 2.6% mortgages locked in, and they're never, ever going to sell. What does your team say about the housing economy of America? This is where you got your fame, Jan. What does your team say now about all those people out there locked into mortgages of their dreams?
So first of all, I would say, the housing bubble was really central in the pre-08 economy. Obviously, it hasn't been central in the recent economy. It's been important. There has been a big boom and somewhat of a bust. And mortgage equity withdrawal did pick up in 2021 to levels that were appreciable, I would say. Not dramatic, but appreciable. And mortgage equity withdrawal coming down since the peak of that cycle has been a drag on growth. I'd say specifically on the lock-in from 7% 30-year mortgage rates versus maybe 3% or 4% that people took out the mortgage rates at. I do think that is part of the sort of slow burn that Lisa talked about. I mean, I do think it probably at the margin reduces mobility somewhat. The research on those issues has been somewhat mixed, so that's why I'm putting this in somewhat cautious terms. But I do think it probably is at the margin more negative for mobility, until more time has passed.
Are you avoiding debt ceiling conversations at the moment with clients? Do they want to talk about it?
I talk about what clients want to talk about, of course.
Is that top of mind?
That's the Solomon method of economics.
Is it top of mind? Yeah.
It's top of mind for a lot of people, and undoubtedly over the next few weeks until whatever the X date is, it will remain top of mind. It probably will go right up to the wire, just looking at the political dynamics, and it's still unclear how exactly it's going to be resolved. Our baseline is that there's going to be a resolution very close to the X date. And that ultimately you do get some spending cuts or some spending caps, but we don't expect anything as large as what we had in the 2011 situation.
We'll have to see what that means for the outlook as well. Jan Hatzius at Goldman. Jan, thank you. Just getting some headlines on the debt ceiling. Senate Majority Leader Chuck Schumer says Republicans must take default off the table. We've heard these messages before. Staff to continue meeting on debt limit negotiations. Of course, we heard a little bit earlier, overnight, that there's going to be a delay to the meeting between the President and the Speaker of the House. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says the only satisfactory solution is for Congress to raise the debt ceiling. Yellen spoke to Bloomberg in an exclusive interview.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Yellen is in Nagata, Japan for a meeting of G7 finance ministers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Actual default. That is potentially catastrophic. And you can go through a million ways, but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic. Markets get volatile. Maybe the stock market go down. The treasury markets will have their own problems.
That was Jamie Dimon, JP Morgan Chase chairman and CEO, on the potential for a default, but ultimately this gets addressed. It gets addressed. Why? Because the market will start pricing in the potential for a default. That's how it works, Brammo. Get a bit of tension, some pain, and all of a sudden politicians get their act together.
I hate this. You know that I do.
Oh, everybody
I feel
does.
visceral
Find someone
about
that loves it.
I mean, well, I don't know. Then if nobody loves it, why are we doing this? Why can't we have a more constructive discussion? Again, I'm not saying there isn't a reasonable discussion to be had about where people spend the money, where the nation spends its money and its budget. But to hold the U.S. basically hostage as a result of this in this sort of political shenanigans with talks having one tenor and then the public message having another is frustrating.
Political point scoring. Just a default position. You believe that you can get more support by fighting the people on the other side. Tom, I think actually over this matter, no one wins. I think everyone looks ridiculous
Everyone
not
looks
solving
ridiculous.
this issue.
Totally agree.
Could not agree more.
Totally agree. Just can't say enough about it. What are we going to do about Twitter? I mean, where's Twitter like...
Getting a new CEO, I hear.
No, I know, but where are they going to be in 6 months? Where are they going to be in 6 years? I have no clue.
Well, hopefully we'll hear from the new CEO, and they'll share that.
But have we nailed down a new CEO? I'm not sure we have. I mean, it's just like...
There are rumors.
Rumors. It's speculation.
It's more than speculation.
Well, didn't Elon Musk say that he'd hired someone and then it's The rumours are the talks. I don't want to say I hate the word rumours. The reports are that it's someone from NBC, correct?
That it's the head of advertising,
Great.
which would be a really interesting move. And it's actually a pretty big get, potentially, at a time where he's looking for legitimacy after a lot of people have really questioned his leadership.
If we've given you enough confusion there to provide clear talk, Bloomberg Quick Takes Alec Webb joins us from London on the Twitter Derby as well. Give us some clarity here, Alec. I look at where we are with Twitter, and I think everyone in their own way is exhausted by the last year of Twitter. What's a new CEO going to do if there is a new CEO?
Yeah, as you say, it's been reported by the Wall Street Journal and Puck that Linda Yaccarino, who is the head of advertising at NBC Universal, is in talks to take over as CEO. Elon Musk would stay on as chief technology officer. It sort of seems as though essentially she's the person who sits down with the advertisers and says, come and advertise on our platform. Presumably may do some building of the actual advertising product, but ultimately Elon Musk is still going to be running the lion's share of the company. We've seen there's been a mass exodus of advertisers since he took the reins, concerns about content. He himself has been in the room with advertisers, been reporting from Bloomberg that didn't always have a brilliant effect in some of those meetings. So it's certainly an interesting possibility if she does indeed get the job.
John, I don't know about your feed. In my feed, it went from better ads to garbage ads, and now there's almost no ads. I don't know if it's me or what.
I tend not to pay attention to the ads in my feed.
There's like no ads.
That For You column, though, I just get a lot of people fighting. Just seems to be fights.
I get animal videos.
You get animal videos?
I don't know what that says about us.
What does that say about me? Just people fighting.
And I get little puppies and cute little, people hugging and things like that.
They've got you wrong, haven't they?
Oh, hey,
they
watch it there.
Have the fights.
Oh, yeah,
and stuff
that's
like
right.
That. That's very Bramo-esque. Alex, are you suggesting that Linda Yaccarino is going to come on board and be the head of ad sales with a glorified title?
It sort of looks a little bit that way. You don't forget that clearly Twitter is a massively influential company, but the business she runs at the moment generates in excess of $10 billion a year. Twitter, pre-Elon, had revenue of about $5.5 billion a year. She's running a far bigger advertising operation at the moment. And actually, NBC Universal's ads product isn't just for NBC Universal platforms. If you're in Apple News and you see an ad on there, it is served to you by NBCU. So actually, that's a kind of competitor to Twitter. There are some things that Twitter can do in terms of improving its ad product. You complain about, inverted commas, the quality of your ads. That's really something advertisers think about rather than consumers. But it doesn't have great advertising targeting because it doesn't know as much about you. It doesn't know as much as Meta does, as Facebook does. So if there's going to be a piece of that she's coming in improving the data quality, it's maybe concerning for users, it's better when you come to thinking about the revenue per user, the amount of ads you can serve them, and the targeting of those ads.
Alex, you getting a sense of what the vision is for Twitter? I mean, Tucker Carlson basically getting a show announcing he's going to have a live show on Twitter that's going to be live streamed at a time when that was actually controversial for the Fox era with respect to advertising based on some of the things that he said. And then you have this stalwart advertising head at NBC Universal coming in. Is there something going on that gives you a sense of what the future of Twitter could look like?
I mean, baby steps, perhaps. Let's assume that Elon Musk himself has a very clear vision of what Twitter's going to look like. That is not immediately clear. There's a lot of talk about the X app, this sort of super app, which will be an equivalent somehow to what WeChat does in Asia. We're a very long way from what WeChat is able to do. If you're going to get to a super app kind of product, you need to have loads of developers building their own apps for your platform. It's a gateway to a bunch of other apps. Now, if you're a developer and you're faced with a choice of building something for Android, for Apple's iOS, or maybe for whatever Facebook's coming up with in the metaverse, these are products that have potentially hundreds of millions, if not billions of users. Going for the 200, 180 million perhaps users on Twitter, less appealing.
Alex, you're expert at the digital ad dynamics. The dynamics of the last 90 days, as a general statement, are just outright bloody. There's no other way to put it. Do you suggest a longer timeline to digital advertising challenges, or is it of a shorter duration?
I mean, look, there are a lot of short-term challenges right now. They have come straight off the back of huge changes in the digital advertising ecosystem. I hate that word, but the digital advertising market, in terms of cracking down on privacy, it is in a little bit of flux. That is why Facebook has been trying to get into the metaverse, because it can control that space. I think that ultimately right now it is the worst point because of the macroeconomic conditions. There are things that can be improved going forward, so it's not as though this is an idea that we're going to be around for a very, very long time.
Alex, thank you, buddy, for the update. Alex Webb there of Bloomberg on the latest from Twitter. I would make 2 points. One, the current leader of Twitter has been pushing a subscription-based model and is now reportedly hiring someone who runs ad sales at NBC Universal. I think that's potentially quite interesting. There's a clear shift there. Mm-hmm. Two, the challenge of creating a platform or developing a platform and producing content, if they go down that route, I've got no idea if they will, in a world where people just desire echo chambers, particularly here in the United States. And I would bring up the outrage over having the former president of the United States on CNN, and the amount of outrage there is off the back of that, to have the former president, who more than 70 million people voted for in the last election, go on a major network in the United States. And of course, there are bound to be lies and falsehoods, if you want to choose that word. That's to be expected, but ultimately that's a former president with more than 70 million people in this country voting for him. And the amount of people who are outraged with CNN for taking him on air is just amazing to me.
The larger point here is really well taken, and that's what my mind was going. If you're going to create content and you're going to focus on advertising, how do you cater to the inevitable angering that you are going to create of the advertising base? Think about Bud Light and what happened there.
Totally.
I mean, think about what happens when you have a Tucker Carlson or say, take your pick on the other side of the political spectrum, making statements that get people annoyed. How much do you get involved and really become a pseudo information network akin to a broad cable network?
Yeah. I thought the Atlantic magazine had a nice distinction here in the last 24 hours of uproar about this, and they said it wasn't that the former president was with anyone at CNN. It was the format of a town hall meeting, clearly with an audience pre-selected for him.
Are we saying it's outrageous there were people there that had voted for the president?
Well, they they should have done what the Atlantic was suggesting, is do the same thing, but just have it be him and the reporter to get more information out of it. I don't have any opinion on it. I could care less, to be honest. But what I do think, there's an elephant in the room in all this, John, that was really underreported as we talked to Alex Webb there. Time magazine dropped their subscription program this month. And to me, this is Mark Benioff and our good friend Keith Grossman. Full disclosure, folks, a good personal friend. Keith's moved on to crypto things. But that Time magazine dropped their subscription model is the news unreported in the digital space in the last 30 days.
And that was the first point I made, Tom. I wonder what this means for Twitter Blue. It's hardly a ringing endorsement of a major product push from Elon Musk and Twitter.
I'm going to listen to Brian Weiser and other experts on this. I got a fountain pen and I dip it in the ink.
Nice. Old school.
Old school.
That's the way it should be, TK. Old school.
Cool.
Cameron Dawson and New Edge coming up shortly. Your equity market positive 0.3% on the S&P 500. Live from New York City this morning. Good morning to you all. This is Bloomberg.
From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and
it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
What has prevented monetary policy from biting on the economy was all of the fiscal injections.
Real incomes are going to expand this year. So if that is what's happening to the underlying pocket, then why should they not spend that?
Mission is not accomplished on inflation, but that's a good reason to pause.
We are at or very close to the tightening cycle for a lot of the major central banks.
Investors are pricing in rate cuts, and that's not something that we see. The Fed is not there. They don't have the ability to do that with inflation where it is.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On a Friday, it's Reset Friday here on radio and television, staggering into the end of May. Debt crisis out there. Comments from James Dimon, comments from Janet Yellen. It's been a busy week, John.
Only the middle of May. Trying to stack it towards the end of it already, Tom. Not even 2 weeks into this mess.
It feels like we're 4 weeks into May. I mean, particularly when you look at the volatility of the two-year yield as the metric here. It's up and down and up and down.
Start of the month. Brahma was trying to wrap up the year.
Yes.
Wasn't she?
We're like 10 months into May. I mean, that's what it feels like.
It's exhausting, and I'll be honest, I heard that from Jamie Dimon yesterday. It's just, everything is a battle every day, including the banking crisis we've touched on today.
There's always something to worry about, whether it's the banking crisis and the debt ceiling debate. We've seen this one coming a mile away, haven't we? Just been there on the horizon. We're like, ignore it, ignore it. Then Yellen comes out June 1. X-date maybe, you're like, ignore it, ignore it. The talks start and you're like, please stop, stop. Yeah. Tom, we're in the foothills of it. It's just starting. It's just starting.
PacWest 4.70 just opened ugly in this 8 o'clock Wall Street time hour. 4.57 is where we were moments ago. I mean, it's still there, whether it's the debt ceiling or it's the banking crisis. I think that's the lead message.
So let's pick up on that name, Tom. So PacWest got hammered in yesterday's session off the back of their own indication that deposits started to roll over, off the back of stories out there, including ours here at Bloomberg, that they were in talks potentially with other companies, investors. They confirmed those talks. Deposits dropped by 9.5% on the week. just seems that we've gone from one thing to the next, but really still haven't moved away from that issue around these banks. You start to see the stock break, 460. I said a couple of Mondays ago, this was a double-digit name. It's still at 460 right now in the pre-market, Tom, and that makes people nervous.
And a lot of people calling for the end of the crisis. I did not hear that from Mr. Diamond yesterday with Francine Lacroix, but there's a lot of people, you know, generally in the zeitgeist saying, well, that was harsh, it's over. Baloney, it's not over. I see no evidence whatsoever it's over. I mean, Lisa, I'm sorry, it folds into the confidence of the nation, including the debt ceiling debate.
There is a lack of confidence one way or another, and Jan Hatzius was talking about that sort of slow burn, and this is my question around the moment, which is, if we're in a slow burn, how does this market deal with it? It is used to big catalyst events. It is used to following the Fed, doing whatever the Fed's bidding is over 10, 20 years. All of a sudden now, we have a muddle, we have uncertainty, we have economic data, we have specific corporate earnings, we've got corporate stories. This is an unusual market for someone who has grown up under the auspices of monetary policy and only that and big catalytic events.
I love a Bramo run. Sometimes they just feel so rehearsed.
They're just
like, I know they're not. I know there's no script, just to confirm, but they feel that way sometimes. Let's whip through the price action for you just briefly, going into the opening bout. 1 hour and 27 minutes away. I missed this. This is why I'm back just for one day before the weekend.
That's so sweet.
Yields up by 3 basis points.
BS,
not how
cool.
people describe me. BS, maybe close to the truth. 341.77 on a 10-year, Tom, in the FX market. 108 on a euro against the dollar, 108.93.
I look at the 2-year yield, 3.92%, John. I mean, where's the critical level there? I think we've got to go lower, maybe 3.85, 3.84. We're really not there.
The euro side of this is the one to watch for me. I find it really interesting. We've got people lining up to say the ECB is going to go further, that the economy is robust, the epicenter of the risk is all right here. It's in America. Banks, debt ceiling. And then you start to see some data come out of Europe. It's factory orders, and you're thinking, oh, interesting. Then Mess comes out and says a couple of things about global trade. Okay, let's keep an eye on that. If you get more of that euro story can break down quickly. That's one to watch.
Yeah. Very interesting to say the least. What we know is if you go back to the Orlando Sentinel from a few years ago, you can talk about a sterling ballerina and a ballerina career that was legit. And what the parents said to Cameron Dawson is, have a fallback. Her fallback has been sterling strategy for Bank of America, among others. She's at New Edge Wealth right now, their chief investment officer. Tell me about the ballet we're in right now. You know, ballet, that's a tough business. Your body falls apart. Is our economy, is our financial system falling apart right now?
Well, the interesting thing about ballets is that they always either end in a wedding or a death. And so I think that's what we're looking at with this cycle, which is that are we going to have a recession or not? And that's why this market has been flat, because we're in this world where we know the risk of recession is high, but we're not seeing the whites of the eyes of it in hard data. And that's why we continue to have this sideways chop.
Do you operate with the assumption that we will get one this year?
This year, I think, is the operative word. It could lean more into 2024. I think the interesting thing is just at the precise moment when economists and the bond market are expecting a recession to hit, those cuts to hit, is when the equity market has earnings starting to reaccelerate and rebound. And that's a really big schism for this market.
Have you got this tradable window then? What do you do with it between the last Fed hike, if indeed it was the meeting before, and the recession that you'll start to see in some of the data, payrolls, etc.? What do you do in that window?
You probably trade on technicals, things like momentum, and you trade on positioning and sentiment. Those kinds of things can drive the market in the short term, and it's really in the medium term where the fundamentals start to matter. So when we look at that 4,200 level, there is this risk that we move higher. And I say risk because people aren't positioned for it. That is the pain trade, that we don't get above 42. And it may not be justified by the fundamentals in the medium term, but the technicals, the sentiment, positioning could get us above that and really make it a very big pain trade.
What happens, though, if we don't get a catalytic event? If it's just sort of, you know, little data points that you can justify with the narrative that you desire, and this is what we've been getting for a lot of this year, and we're going to continue getting for a number of months based on what a lot of people are saying. Do markets just stay in this range?
It reminds you of 2006, 2007, because the writing was on the wall that things were certainly starting to weaken, yet markets shrugged them off because you didn't see the whites of the eyes of the weakness. The Fed had paused, and it wasn't until 2008 that we started to see unemployment tick up and really the Fed start to react to that. So there's a long precedent for these cycles simply taking a long time. It's like watching paint dry, which is why we have to think of this in two time frames, the short term being driven by those momentum indicators, indicators and medium term by the actual fundamentals.
The boiling of the frog until suddenly there is no frog that is alive and hopping. There's a question about, this is not 2008, and people are talking about that based on the global banks that have plenty of capital. But is this leading to some sort of fissure, some sort of seizure that is going to lead to massive valuation drops, or is it not? Or is it going to be something that's more akin to the recessions of yore?
Well, I think it starts from your point, Jonathan, all the time about how we shouldn't always just index to 2008. Because just indexing to the extreme is not helpful. The reality here is that we're likely going to see some slowing in loan growth, and that typically coincides with slowing in economic activity. It should be expected that banks, small banks who have been annualizing loan growth at 8% for the last cycle, will see that slow in response to that. That will have real economic impact, and at this point, it's not being priced in.
I'm with you. I agree with you, obviously, because you agree with me, and you can come back any time to talk about it. People will want to benchmark to something, though. What should you benchmark to? What is the parallel right now for you?
I think it's somewhere in between the 2018 experience where we didn't have a recession and the Fed was able to ease and there was no inflation, and that extreme of 2008. Remember 2016, we got very, very close to a recession. We flew very close to the sun, and we were able to avoid it in that scenario. I think that's probably a good parallel for us to say, where could the earnings risk be? We think that we have some recession, it just won't be as deep as 08.
One of the great realities of Florida right now, your Florida, is everybody's been there for 3 cups of coffee and think they're experts. You own the high ground on Florida. Is the economy boom there legit, and it is a symbol of an optimism in America that we underestimate?
I've always considered Florida beta on the economy because there is so much discretionary spending in Florida, and it tends to have more pronounced boom-bust cycles than most other states. And always when you're in a boom, there's always this notion that this time is different. It's never going to end. But I'm hearing people leave places like Miami because they're getting priced out. They can't afford it. That may be the first indicators that some of this high beta flying parts of the economy are finally starting to feel the pinch of price pressures.
I mean, I mentioned the ballet at the beginning, and I look at the damage out there, and my whole thing is corporations will adapt and adjust given cards dealt. That's what I see right now for a part of the Standard & Poor's 500, not all. How's that trend going to play out this year?
Well, certainly that's what we saw in the first quarter. That's how earnings came in better than expected. We saw corporations adapt and adjust and defend on the margin line. The thing that will be interesting to watch is that if inflation really does roll over and it falls, that means revenue growth is going to fall.
Nominal GDP comes in, revenue comes in.
And that usually leads to margin pressure, regardless of what you do on the cost side, because you lose the incremental margin dynamic.
John, Honeywell with a banner across the Bloomberg years ago, all of a sudden they were doing an 8% organic revenue growth. No one had ever framed that. And when they come back to 6%, not to pick on Honeywell, that's going to be the game changer.
This was great. Cameron, thank you. Cameron Dawson of New Edge Wealth. I should have done ballet. My posture's awful. Is that where your posture comes from?
Well, it's
Very
all in
upright.
the core. Any discipline, whether it's martial arts or if it's ballet, is all from the core.
Martial arts or ballet, one or the other. How's your core doing,
It all hinges off of that.
I saw Suzanne Farrell and Peter
Proper
Martins
morning
at their
television radio,
absolute
this
peak,
is.
and I still carry it with me, how spectacular it was.
Magical.
Magical.
This was magical, TK.
That's my ballet talk there. That's
Sure.
my entire ballet talk. You just heard it.
Up next, Ed
How's my
Mills
core look,
of Raymond James. Oh, it's perfect. Super tight. Super
Good,
tight
have some
like TK. Ed Mill of Raymond James on the debt ceiling. That conversation coming up shortly. Here's a snapshot of the price action for you on the S&P 500. Equity futures positive 0.3%, up just a little bit. Yields a bit higher as well by 3 basis points. 341.59. We're light on data today, aren't we, Bramo? What have we got? Nothing?
Nothing. Oh, no, we've got University of Michigan survey. How can we forget?
My favorite.
It's going to be amazing, especially given the inflation read going
I
out.
so won't be running out the building at 9:56 and 30 seconds. I'll wait for that. I'll wait for that.
Yeah, you're full of honest statements
it's my favorite data point.
What else do you have
Love
dripping with sarcasm?
So much more.
I think it's interesting. I'm going to be watching it.
Good. You can tell me all about it on Monday. Your equity market on the S&P up by 0.3% from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. The delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk has said he'll become Twitter's chief technologist. UK tech tycoon Mike Lynch has been extradited to the U.S. He faces a criminal fraud trial for the sale of his autonomy corporation to Hewlett-Packard Enterprise. Lynch is accused of dressing up the software company to induce HP to buy it for $11 billion. A year later, HP wrote down the value of the deal by $8.8 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Was going to keep rate World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Janet Yellen sitting down with the brilliant AMH over in Japan at the G7, the Treasury Secretary, leaving the spotlight on Congress to get something done. There was meant to be a meeting today between the President of the United States and the Speaker of the House, Mr. McCarthy. That's been postponed. We're told that there's nothing to worry about, to see here, because staff-level talks are ongoing and will continue into next week. TK, I guess we'll see.
In our last block, we talked about mid-May, late May, and that. I'm sorry, this is a late May story. If June, first week of June is when the panic sets in. I mean, that's the, to Cameron in our last block, that's the ballet we're in right now. We have to wait and see to get the calendar date set.
Fair to say this equity market does not capture panic in any way, shape or form on the S&P 500. Still in and around 4150. Equity futures positive here, Tom, by 0.3% going into the weekend.
And you have to see on that. Again, I'm looking at a VIX under 17, and it's basically a miracle given all the angst that's out there on a Friday. Right now, we're going to speak to an expert on angst in Washington. Edward Mills is Washington policy analyst at Raymond James, steeped in the cynicism of the white marble of Capitol Hill. Ed, thank you so much for joining. We're focused on the Secretary of Treasury in Japan. I want to digress from that to the imagery all of us have seen, listeners and viewers, of the Mexican border and the shift from COVID immigration policy to after COVID immigration policy. Just as a digression into the weekend, does anybody in Washington care about the stunning images we are observing?
So, Tom, absolutely, they care. The question I always ask is this going to change anything from a legislative perspective? We could see some sort of Title 42 kind of specific piece of legislation. However, I don't think the politics are there for comprehensive immigration reform. Anytime we do have a crisis, we see an uptick in conversation. But right now, the politics, as I mentioned, especially in Republican primaries, don't tend towards a comprehensive solution, which is really the economic impact, because a lot of the conversation is kind of what does that do for labor force participation? What does that do for some of the JOLTS job data where we see a lot of open jobs? Comprehensive immigration reform is usually part of that conversation.
We're looking for comprehensive debt ceiling reform as well. What does the Ed Mills calendar look like to the end of May? Does anything get done rather to May 31st, or is that just not going to happen?
So I'm not sure May 31st really is the date, Tom. I do think that near term, what we're going to be focused on is what happens before President Biden gets on Air Force One, goes over to Asia on Wednesday. There might be a little bit of a freak out if there's not a deal to be had then. But I really dug into the numbers of the Bipartisan Policy Center's X date. And what that tells me is that, June 1st, is an important deadline, but somewhat of a soft deadline. And that's what I hear people in DC telling me. If we can get to June 15th, which is the next quarterly payments of, kind of the IRS, we might be able to get to June 30th. And if we get to June 30th, there's $145 billion of government retirement funds that get freed up, which could get us well into July. So DC's kind of on this two-track process, trying to create a crisis to see if something can get done now, but recognizing that there might be more leeway on the back end. And so this might be a little bit of a pull forward of negotiations because people aren't quite sure June 1st really is the date in DC.
All that I'm hearing, Ed, is that basically we're going to be talking about this for 3 months at least as people try to ramp up some attention and not really hit that X mark. We were talking earlier about what the prioritization of payments will be should we get there. Janet Yellen was saying she doesn't even want to talk about these hypotheticals. I'm sure that they are talking about it. What are the chances that the U.S. would pay Social Security checks over the full faith and credit U.S. Treasuries?
So, Lisa, that's a really good question. And I think that if we're in that scenario, two things will happen. One, we will have a market correction that is going to be a forcing mechanism on D.C. In the past, that's been part of the reason how they've been able to get this done. Number two, I don't necessarily know if the Biden administration would send out the Social Security checks over paying the interest on the debt, because that could be a huge leverage for them. If we're in a world where certain seniors are not getting the payments from Social Security that they have been promised, that's a political crisis that could resolve this quickly. And I do think from the Biden perspective, that's part of where he thinks he has a strong hand, trying to make sure that this is as clean as possible. But McCarthy can't give him that deal. That's why we have a problem right now.
Ed, this is an incredibly frustrating conversation, in part because I know that there are policy workers, staff members who are working on the nitty-gritty in a very practical, sort of technocratic way. And then the discussion is, what can we give to our policymakers? What can we give to the politicians to go out there to say, it's a win and the other guy is terrible? And how much is that really the sort of duality of what's going on in Washington right now?
Lisa, that's how Washington works. I think that the good thing about this debate so far, and I agree with you, this is one of the most frustrating parts of my job, one of the things that I least like to talk about because it's so unproductive generally and just really kind of gets people sour on Washington, D.C. But with any negotiation, when you're really stuck between cut spending, raise taxes, you have to expand the pie. And so part of that expansion, Lisa, is there an opportunity to expand economic growth? Is there an ability to do energy permitting reform? We have the Inflation Reduction Act. That's step one. Unless you get energy permitting reform, a lot of that clean energy in legacy energy and the transmission of that in our infrastructure doesn't really work. You need to do that. And so maybe instead of cutting spending or having a percentage cap, maybe we can focus on what is the deficit reduction over the next 5 to 10 years. That's a political thing that Democrats can come to agreement with. Biden likes to talk about how much the deficit has been down under his presidency, still much higher than I think anyone would want to see, but that's an easier part of the conversation rather than committing to an X percentage cut or X percentage growth that comes with even harder choices down the road. It's a political off-ramp that each side is looking for to avoid default, and because they're not looking for default, that's where I still believe there will be a solution.
Ed, you've got to help me keep Bramo on the rails. Lisa's losing it. We've got a few more weeks of this to go.
I can't take it.
Ed Mills of Raymond James. Ed, thank you, sir. Thank you. You are not happy about this, are you?
You know, it's just frustrating because there are very real issues that should be discussed.
Of course.
I hate that they get overlaid with all of this posturing that tries to cater and dumb down the conversation in the public. And that upsets me because we have a lot of very real issues and a lot of very real people who have to deal with it. And it's for both sides. Why can't there be an honest discussion of the details and trust that people are going to pay enough attention?
TK?
I'm going to go, John, back to yesterday. I know you're going to wander off here, and on a Friday, I want to wrap up with what I thought was a stunning quote of the week. No, are you? Yeah, where you're going to wander off, right?
I was going to stay, Tom, but I'll leave.
Okay, well, you can do either
I'm joking.
one.
I was going. I was going.
But
got the promo ready. I was
going.
going.
John, what we heard from Hugh Pill yesterday of the Bank of England was absolutely stunning. John Writing was eloquent about it being a throwback to Keynesian United Kingdom. The built-in austerity of dialogue in the United Kingdom is, to me, it's just enduring. It doesn't go away. He wants people to spend less money. He's begging people to spend less money in the United Kingdom.
To stop asking for pay rises as well. And
it's a joke, but it's not. It's completely un-American.
You said something earlier this morning that stuck with me, and I think you're right. Everyone right now has their own problems.
Yeah.
The UK, the US, France, take your pick.
Yeah.
Many of them.
It's the time we live in.
Here's the promo ready for you in the next hour on Bloomberg TV. Luke Higmore of Aberdeen, Subhadra Japa of SocGen, Chris Harvey of Wells Fargo. That conversation coming up in the next hour on Bloomberg TV, taking you into the opening bell with equity futures up by 0.3%. From New York, this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Good morning, everyone. Bloomberg Surveillance on a Friday morning. We recalibrate into the weekend. Your reading over the weekend is simple. This American economy forward. Lisa Bramwitz and Tom Keene, John Farrell getting to the next hour. Chris Harvey will join John Farrell. Really interested to see what Chris Harvey says about the repricing of equities. 41.54. I'm going to round that up to 4,200 because I can do that. Futures up 10. And the VIX under 17. Wow, could you imagine the VIX a 15 print? No one's framing that.
Some people are saying that it doesn't accurately reflect some of the actual volatility, and so people are talking about that. But I will argue that you see bond volatility coming down as well.
Coming down a little bit. The two-year yield, don't tell me that in the last 24 hours, 3.92% in the two-year yield as well. We're going to get you prepared for the weekend with the careful thoughts of Kathleen Bostjancic. She's chief economist at Nationwide. She has a wonderful holistic view of the American economy. We're going to go there right now. Kathy, you say just simple, follow the bond market. Explain this to our audience that's in Bostjancic 101. Why follow the bond market instead of the stock market to try to make a judgment about which stock to buy next?
Good morning, Tom and Lisa. So I say follow the bond market in terms of the outlook for the overall macro economy. The bond market is much more sensitive to incoming economic data than the equity market. It certainly matters for the equity market, but earnings are key for the equity market. And the bond market tends to sniff these things out more quickly than the equity market. I would say there's almost this sort of embedded optimism in equities relative to fixed income or the bond world, and it's more than just the inverted yield curve. It's just looking at the risk overall, like looking where 10-year yields are trading relative to where we're going, and what are the inflation expectations and growth expectations embedded in there.
Friday noise out, import prices, export prices. John Riding, when he was at Bear Stearns, said, Tom, you got to follow import prices. They matter. They're giving me a little whiff of disinflation here. I mean, I don't want to oversell it, but maybe that's secondary data coming out moments ago. And there's a little David Rosenberg saying he sees the inflation cycle broken. He published that 20 minutes ago. So, that's sort of the mood here.
There seems to be a consensus that inflation is trending lower. It might not be in a straight line, but there is not consensus about how quickly it's going to trend lower and whether or not it's becoming entrenched in the psyches of the American people and frankly globally. Kathy, how much are you viewing that as a big concern? That there's almost an acceptance that prices are going to go up at a much faster pace than has historically been the case for the past few decades?
Well, that's really the risk, Lisa. That's what the Fed frets about most, is that gets embedded into inflation, what they call inflation expectations, and businesses and most importantly, consumers start to act as if, well, this is the new norm, where we're not going back to a world that we struggled to get 2% inflation. Now we're looking at something, if we get to 3%, we're lucky. So that's the risk. We haven't seen that yet in the statistics. We'll get the University of Michigan data, consumer sentiment data later this morning, and we'll see what the inflation expectations are as consumers weigh in. So we haven't seen that. That's the good news. And we are seeing some elements of disinflation. Problem is, it's not happening very quickly. And then that increases the risk that eventually, just as you say, people start to accept this and it becomes the norm.
Kathy, I want to get your view on what Cameron Dawson was talking about, that this reminds her of 2006 and 2007, with this sort of calm, this relative ease with the backdrop of a Fed that has raised rates quite significantly and somewhat slowing economic growth. Do you think that that's true, that this is basically building up to something that people have basically shrugged off and gotten complacent about?
Yeah, it's a very different backdrop, of course, but yes, similar in the sense that, again, the bond market's been flashing these recession warnings for a while, and I know everybody's getting tired of, talking about it and saying it's kind of like waiting for Godot, where's this recession? But that's what happens, and then eventually it hits earnings, and then the realization in the equity market that, we are headed for a downturn, and it's going to be rather hard, not necessarily a deep, protracted downturn, but it's not going to be a soft landing. And there's just these delays. I mean, it could be anywhere from, a few months to almost as long as 3 years before the inversion of the yield curve and the economy turns down into a recession.
Kathy Bunch-Johnson, Nationwide has such a 50-state view, and of course all the heritage of Ohio and the Midwest as well. How are we colored being within 3 zip codes in New York, or 2 zip codes in LA, or maybe 3 zip codes in Miami and Washington? Just the whole city-centric view versus what you see coast to coast.
Yeah, it's a great question. Well, I think that right now, across the country, you are seeing some similar characteristics. There is a really tight labor market, and there's concern, right? Whether you talk about farmers in the Midwest, or you talk to manufacturers in the Midwest or on the East Coast, there's this concern of uncertainty, and that's really the biggest issue, right? And that the understanding is when the Fed raises rates, things tend to slow down in the economy, or maybe things break, as we saw in the banking system. So I think there is this concern, just broad-based, no matter who you talk to. Like I said, the farmers are also asking, what's the outlook? And we're concerned, and we're seeing some things, and it's many issues, right? It's the labor force, particularly. They keep coming back to when is that going to change, and when are we going to see maybe some reprieve on the wage front? That's a big issue.
And this is important. Dennis Gartman chastises me because I don't look at commodities enough, and I'm talking, folks, about the softs across the Midwest. I mean, it's not copper, Kathy, but what do the farmers of America say here when I see corn moving from $8 a bushel down to $6.32? I mean, even within agricultural America, there is this disinflation going on, isn't there?
There is, and there's, you hope that as we get disinflation, and if they lose some pricing power, because that's part of it, right? And that's eventually, I think, going to feed back to the equity market and earnings. You hope that the wage pressures, and that's what they're really facing now. It's not the input, it's not even the commodity prices. It's really the wage pressures and the lack of workers. There's also a call for, what are we doing on an immigration? We could use the workers and some, help there.
And Lisa, what's important here, and it's embedded into what Kathy just said in wages and in petroleum, within agriculture, yes, there's disinflation in corn. I know you're nailed to the cornflakes price in whole paycheck, but the answer is we're not back to where we were pre-pandemic. We got a long disinflation way to go to get food prices back to normal.
And people have accepted it. And this is something that I've noticed. Is
That's
that
interesting, yeah.
Profits at companies are actually expanding, and that was CPI coming in hotter than PPI. The input prices are actually disinflating faster than the prices that people are being charged in grocery stores and in just at the mall or wherever.
I mean, you were hysterical 3 or 4 weeks ago over how many tomatoes were in a tomato can. Are you counting cornflakes in a box of cornflakes? They're putting less in, I believe.
Everything that you get, shrinkflation just absolutely drives me nuts. It's like, if you're going to shrink, if you're going to give us less, you might as well just call it. But Kathy, given the fact that we are seeing all of this, are we seeing the pushback that you would expect? Or is it, basically this discussion that we're still working through the stimulus money and it's still sloshing around the system in a way that many people don't realize?
Yeah, I think it's the latter, Lisa. At the same time, I have been surprised by the resilience in the labor market and the consumer, but their estimates, San Francisco Fed came out earlier this week. There's just still $500 billion of excess savings that related to the pandemic that's still on consumers' balance sheet. And it's not just the upper income households will have that. So that's going to continue to fuel things. And remember, we still have the travel revenge, right, spending. That's going to take place throughout the summer. I think come the fall, though, let's assess things and let's see where the consumer is, how they feel. They certainly don't like higher prices, but if the labor market starts to continue to crack, they're going to have less ability and less willingness to accommodate, higher prices. And I think that really is the key at this point, is what happens with the labor market.
Kathy, just want to wrap up with this question around Fed speak, because we get a lot of it. And it used to move markets quite considerably. And it kind of doesn't as much anymore, because a lot of it is we just don't know. And each view is very much a view based on certain data that very well could change. Are you gleaning less and less from the rhetoric from the Federal Reserve?
Well, I still pay very close attention and try to read as many of the speeches and comments that are made. But I think your point is well taken, that the markets have really turned a deaf ear to them, and that's why we continue to have that disconnect between the Fed's forecast and what the bond market's forecasting. And the bond market's still looking for rate cuts, relatively soon in the second half of the year, where the Fed Reserve has a forecast, and the commentary is, if anything, it's hawkish. They're actually saying, we're not sure we're quite done tightening. Right. I mean, we do think they are. We think they can pause. But, the inflation numbers, they eased a little bit, but they're not coming down very sharply. And that's still uncomfortable for Fed officials.
Kathy, thank you. Kathy Benchansik with us this morning here. Just a very nice overview to get you into the weekend and your belief in the American economy. Somebody mentioned, I think it was Atlanta, GDP is still 2.x%. I mean, it's nowhere near a recession. That number. Can we do some optimism right now?
I don't know.
Apple, few people are aware of the company, back up to 170x or whatever. How much is a $3 trillion Apple? $191 per share, give or take a little bit. I took that off the Bloomberg terminal, but these 20 stocks, maybe they're 40 stocks, they keep performing. And up you go from 173. You go up $20, that's 11%, I'm going to call that.
One of the most interesting aspects of this year actually has been interesting. I want to give a break because I've been saying about how difficult it's been, and it has been. But at the same time, the gains of certain stocks really masks some of the turmoil under the hood. And I think that's what's interesting, is the leadership of these names, whether it's artificial intelligence, whether it's just simply the iPhone and the robust sales there. There is a question around whether that can continue and everything else can depart. Sort of the consolidation around the biggest, the strongest, the most innovative. Well, everything else falls out of bed. How long can that kind of divergence continue before there's larger pain? Or is this just sort of the muddle of 2023?
That's a set of worries that are out there. And this goes back, folks, to early morning. I was barely conscious then. The basic idea, Lisa, is that it's exhausting doing this every week. I think I was exhausted last week, and I can't remember, but I think I was exhausted the week before. This has actually been a little calmer, and all we're doing is looking at the shutdown of the U.S. government.
It's been a lot of potential risks, potential catalysts, and actual relative capital markets.
Coming up is a special treat. He is private. He is with the Hong Kong Shanghai Banking Corporation. If you care about gold, this is the world's authority. James Steele, next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Aides for President Joe Biden and House Speaker Kevin McCarthy continue to hammer out deals on the debt ceiling after a meeting between the two leaders and other congressional members set for today was rescheduled until next week. Sources tell Bloomberg the postponement is a sign that staff talks are showing progress. Lawmakers are trying to avoid a default on payments. Meanwhile, Treasury Secretary Janet Yellen says the only satisfactory solution is for Congress to raise the debt ceiling. Yellen spoke to Bloomberg in an exclusive interview.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Yellen is in Nagata, Japan for a meeting of G7 finance ministers. Donald Trump is appealing the verdict of a New York jury that found him liable for sexual abuse and defamation. E. Jean Carroll claims the former president raped her and then defamed her by calling her a liar. Trump lawyer Joe Tacopina says that the jury should not have been allowed to hear the so-called Access Hollywood tape. The founder of SoftBank Group, Masayoshi Son, is now personally on the hook for about $5.2 billion on side deals that he set up at the company. That's after the company's Vision Fund venture capital arm ended the fiscal year with a record $32 billion loss. The world's largest technology investor was battered by losses on unlisted startups in its portfolio. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
If gold can establish itself above 2,000 really for the first time in its history, that'll be the first victory for commodity bulls, since that sort of post-COVID run up 2-3 years ago. If you look at gold versus pretty much all fixed income, whether it's long duration, short duration, high yield credit, high quality credit, gold has actually outperformed over the last 5 years. So I think gold has been in a stealthy bull market.
Michael Scholl, Market Field Asset Management, and Christopher Verone at Strategas as well, really underscoring their focus on gold right now. We've underplayed it here, but it's easy to miss with a triple top near 2,000. But the fact is, we need to start focusing on the lift in gold. Lisa, it's been under-talked about on the show, completely my fault. We're going to have to start focusing on it through the rest of the year.
And the interesting thing is, even though we don't bring it up anymore, a lot of guests are increasingly saying, well, we're putting a little bit more into gold, and that seems to be increasing, especially with some of the uncertainties out there. Even the debt ceiling, right? Potentially a catalyst. This is what James Steele of HSBC was seeing with respect to potential upside in gold. He wrote, gold is holding well above 2,000 US dollars and gives the impression of being likely to press higher and challenge the record highs at 2,075 US dollars. The debt ceiling issue and the possibility of a standoff in Washington continuing to the point of a U.S. default may be winning focus from the frailties of the U.S. regional banking sector in the eyes of gold investors. So I guess a shift in potential crises from banks to debt crisis.
That may be the short-term crises, but then there's the underlying on gold. James Steele is authoritative on this with his work at The Economist way back, and then owning the high ground and research at Refco before a long tenure at HSBC. He is their chief precious metal analyst. He publishes the world's stops in gold. I want to go to the big picture right now, the demand of gold. You're expert on this. Who's moving it up? Is it central bank buying? Is it a secret cabal in Asia that's buying? Why is gold going up? Who's at the margin, the demand?
No, there's no secret, Tom, although the gold market can be opaque. And I think sometimes it's not as visible as other markets.
Lisa, he knows every gnome of Zurich. I know he knows. He's got a little HSBC book with their names all written down. Continue.
In pencil.
And but we have had absolutely standout central bank demand all of last year. Phenomenal, well above, almost double the previous record. And that's continued through to the first quarter of this year. And we've also had very, very strong retail bar and coin demand, which has lasted up until early this year. Now that's beginning to tail off a little, but I would describe the 15-month rally that we've seen as a combination of physical demand from the retail and bar coin sector and standout central bank. What's been interesting about it is that this market has rallied in the last 15 months in the face of liquidation from the exchange-traded funds up until recently. We went down several million ounces last year. And that's unusual because it does tend to show that the institutional sector didn't trust the gold rally. And I suspect that's because they looked beyond the rising inflation to the anticipated response from central banks and thought that rates are going up, gold will go down. But the retail market did not make that connection, and they simply
this is your charm in that you're not looking at the Fed parlor game. You're looking at the actual fundamentals, almost the Marshallian microeconomics of gold. If we get through the triple top, if Gartman sees 2,400, 2,500, what is the James Steele scope and scale of where demand will take gold? Are you looking out going, 2,600? Or are you looking for an early 80s regime shift of gold on a hyperbolic basis moving higher through 3,000?
Well, that's where, and you really touched it as far as our analysis on where gold can go. Near term, the situation looks quite bullish between a combination of geopolitical stress, the regional bank issue, which goes away and then comes back again and gives gold another boost, and then we drop back, and the debt ceiling impasse. And all of that can take us up in the near term, no doubt, possibly to the point and beyond the record high earlier this year of 2,075. But then as you go on, and if you look at it over many months, you have to take into perspective what the physical market is going to do, which is somewhat 50% of all the physical demand in the world is located in India and China. And a 10-gram bar, which is the favored bar in India, is over 60,000 rupees. That's very, very high. And that's very expensive. And gold is purchased by not necessarily wealthy individuals in India, quite the opposite. And we've already seen imports into India for the available data for the first 2 months of this year contract. I suspect it will also contract in China, although we had a COVID lockdowns, post-COVID lockdown spree. Now that means if that physical gold, which normally would have gone to India and China, it has to have a home. So the investment side has to keep buying.
That's the Bramwell household. She's got Kruger Rands piled up in the furniture.
They come in handy.
I think that it's more like, gold-plated tin. Yeah. I think there is a question, though, as we talk about the supply-demand dynamic, what the market is going to do, how much of the demand on the market side, removed from the physical side, is sort of people fleeing crypto assets that were once sort of the replacement for commodities that no longer are.
Well, gold, I think, in a general sense, and it was touched on by the speaker before me, the taped, that the gold has had a resurgence in popularity, in part because it consistently shows itself to be a good safe haven, and it consistently shows itself to be a portfolio diversifier. And other things come up, and crypto may be a very good thing to buy, and I wouldn't say a positive or a negative about it, but it's not a portfolio diversifier, and it's not a safe haven. It's shown by its volatility that it's not. And so therefore, we never really saw much a movement in market share towards crypto. It seemed to be treated separately and not impinged too much on gold.
You were talking about China and India being huge drivers of a lot of the demand. Is there any discussion about pricing the commodity not in dollars?
Well, in general, for many commodities or for transactions, there's been discussions here and there. And that may touch on the de-dollarization argument in general, which may be an element in central bank buying. You know, we're not in the camp of de-dollarization at all. US dollar, in our view, will remain the reserve currency for the foreseeable future. But that's not to say that every single central bank in the world wants to keep the same percentage of dollars that they have now. That they had and a very good way for a central bank to get a little bit out of the dollar, but not commit, say, to euro or yen, is to buy bullion.
See, that's you know, again, it's like, you know, Goldfinger in Fort Knox. I mean, you know, he advised on that movie a few years ago. I got to ask you, I'm getting a huge response, James Steele, to you being with us. Give me the gold-silver linkage right now. You're right about this. Does silver have any value here relative to gold?
Yes, it does. Actually, we're quite positive on the silver market up to a point. You approach $29 or $30, and you
place setting.
You suddenly get a lot of recycling. There's a great deal that can go back into the furnaces and come out as a bar in a 30 to 60-day period. But the difference, the beauty of silver is that half of it is for industrial demand. And just those areas, now our view on industrial demand for this year is reasonably sluggish. But we do think that silver demand industrially will perform at over twice the rate of global industrial production growth, and that's because it's being used all the new things.
I got 30 seconds. Do you have visibility on what China's doing with gold? You mentioned it's opaque. Do we have a knowledge of what China's doing in the buying and selling of gold?
Well, we do know what the imports are going in. That's quite visible, and the demand there has been quite exceptional. The data there is quite good. They do have a predilection towards buying gold. There's a cultural affinity. And I suspect that the barrier will be price.
Somebody emails in and says, what's the markup when you buy gold at Tiffany's? I mean, should we ask James that question?
I've never done it, so I wouldn't know.
It's very...
I'm sorry.
They just opened their new store. They want to know, you know, what's the markup on gold at Tiffany's?
Any jewelry in the West, in the OECD, is a very, very high markup because you're paying for the artistry and the overhead. And this is the difference between jewelry in Asia and the emerging world, where the markup is much lower. That's why it gets translated, gets translated into the shops right away.
It's great. James Steele, it's been way too long. Thank you so much for joining us here on Gold and Zero. He is with HSBC. Did we survive this week?
I don't know. Are we still alive and kicking?
We're going to be here. We'll be here next week. Join us on radio and television as well. This is Bloomberg. Good morning.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Biden-McCarthy meeting delayed as aides make progress. Yellen putting it on Congress to address the debt limit as one Fed governor keeps the door open for more hikes. We begin with the big issue. It's just getting started.
The debt ceiling debate.
It's mostly a political game. Nobody wants to make difficult decisions on spending cuts or tax increases.
It's very hard to move anything forward or stop anything.
It would be catastrophic to not raise the ceiling.
This really is an issue that needs to be resolved in the next few weeks.
It's going to get resolved, but it's going to get really noisy in the interim.
This is something that we're very focused on.
Definitely there is distortions in the T-bill market as a result.
There are a lot of people pounding the table about T-bills around the X date.
You have 5 trillion, 6 trillion nearly in assets in money market funds, and they're all being moved around to try to adjust for this potential stress.
We're all just waiting, we're watching.
This is going to go right down to the last minute.
Everybody is sick to death of this already. Joining us now is SocGen, Subhadra Rashappa, Aberdeen's Luke Hickmore. Subhadra, first to you. I know everyone's exhausted by this, but it's only just getting started. When you speak to clients at the moment, what are you telling them?
Well, I'm telling them that that regardless of all the stresses that you're seeing in the bond market, ultimately the Treasury and the Congress, as well as the president, have to work towards a resolution and get the debt ceiling passed on time. Having even a technical default is not an option for the U.S. government. So, that said, I think that it's going to get down to the wire, as your guests were saying earlier on. You're starting to see stresses in the bond market. Treasury bills that are maturing in early June are starting to cheapen out quite meaningfully. And also, if you look at the extraordinary measures that Janet Yellen has been posting on the Treasury website, there's not a whole lot of room for the Treasury to get past perhaps the first week of June. So in this sort of context, I think that time is of essence, and Congress has to act relatively quickly to raise the debt ceiling.
Luke, in America right now, we're kind of up to our neck in it. Knee deep, if you will, sinking and fast and sick of it. Luke, from an ex-US perspective, for someone outside of America right now, how do you view these issues as they bubble away once more?
Well, one, I'm glad it's not the gilt market for a change. We went through our stress last year, But we're as worried about it as everybody else. We feel it's going to get sorted like everybody else. We feel we're going to go through the volatility before it happens. But I wonder, with that pushing up at the front end of the yield market, that's going to attract deposits even more than we've seen already, and possibly one of the reasons why PacWest was so weak yesterday. Does this suck more of the lifeblood at the smaller regional banks as it just gets better and better value to go into the money market in the front end of the curve?
Luke, are you suggesting that one issue can just bleed into the other?
Yes, for sure. And, you know, that impact that we're going to get through the rest of the economy and everything else, it feels pretty intense at the moment, doesn't it, Jonathan?
It's a massive, massive issue, Sabadra, and I think a major question for a lot of people would be this one. A treasury something I run towards, seek safety in, or something I run away from?
That's a very good question. It really depends on what issue you're running into or running away from. I think people are running away from any sort of security that would mature in early June or even June and July, because of the fact that money market funds especially are concerned about investing in securities where there could be a no payment or delayed payment, if you will. So they're definitely avoiding those securities. But on the long end, I think what you typically tend to see in an environment like this is that investors flock to the safety of long-end treasuries, because treasuries are still your safe haven asset. Even over the last week, even though we spent enormous amounts of time talking about the debt ceiling, the belly of the curve, the 5-year, 7-year, 10-year part of the curve has seen tremendous amounts of demand and inflows, and that part of the curve is trading very, very rich on the yield curve. So you're talking about a demand for some securities in the treasury curve and not others because of the debt ceiling.
This is the one issue that we've got to address, Luke. If things get dicey, they get messy, I'd have one question for everybody. Are you a buyer of the US 10-year or not?
Buyer of the US 5-year over the 10-year. If you have to buy the 10-year because there's nothing else you really fancy, that's fine. There's no cross-default clause, as I understand it here. If a T-bill goes, you're still money good on your 5-year and your 10-year, and you have to believe it gets sorted out over that time span.
Luke, out of interest, why the belly of the curve? Why the 5-year?
I think that's the point, that you start seeing the curve re-steepen up. So if we get to the point, as we expect, and many do now, that yields are falling end of the year, interest rates are coming down, that curve goes from inversion back to steepening. I'd like to be in the 5-year to get the best out of that and avoid a lot of the volatility right at the front.
5-year this morning, 337, yields up by about a basis point, no drama there. 10-year up about a basis point, just sub 340 there. A little bit earlier this morning, we caught up with the Treasury Secretary, Janet Yellen. She's basically doubling down on her message and sticking to script. Take a listen.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. The only good outcome is one in which Congress acts. If Congress fails to do that, it really impairs our credit rating. We have to default on some obligation. That's something America hasn't done since 1789, and we shouldn't start now.
AMH joins us right now. Anne-Marie, you spoke to the Treasury Secretary in Japan ahead of this G7. Did we learn anything this morning?
Well, she was pretty blunt that if the debt ceiling isn't raised, they will default on something. The key question, though, Jonathan, is what will they prioritize with the cash they do have left on their balance sheet? And this is something she didn't really want to get into because obviously this is very political. But she did say at this point she has not had this talk about prioritization yet with the President of the United States. And we're less than 3 weeks now to what she first outlined as the beginning that we could potentially see a default as of June 1st. And when it comes to that timeline, she also said it's very uncertain precisely how much cash Treasury has, and at some point when she gets new information, she will be updating Congress.
AMH, fantastic exchange. Really enjoyed the exchange this morning, the conversation between Anne-Marie and the Treasury Secretary, Janet Yellen. Look out for that on Bloomberg.com and on the Bloomberg terminal as well. Just to get you up to speed on some news, confirming, I think, for many of you what you already knew and saw in reports elsewhere, the Washington Post saying that Elon Musk has picked NBC Universal's Linda Yaccarino to be the new Twitter CEO. Some confirmation from the Washington Post this morning. That just crossing a wire. moments ago. We'll try and pick up on that story a little bit later for you. Back with us on the bond market in this debt ceiling drama, Subhadra Japa, Luke Hickmore. Subhadra, we've talked often over the last few weeks. I've benefited from your insight. You've maintained this bias towards lower yields through the long end. Is that a bias you retain even this morning?
We do, but it feels like at this point the market has gotten a little ahead of itself. We've seen a pretty dramatic decline in yields. You look at the fundamentals, we got inflation this week, core CPI is still running around 5.5% year over year, and the labor market is relatively strong. So if you kind of separate yourself from what's going on in the debt ceiling, it feels like the market is pricing in too much by way of cuts for this year. The rally in the belly, perhaps because of the debt ceiling issues, again, feels like it's a little bit too much. And in this sort of context, I'm a little bit more cautious about in recommending longs. We're neutral on rates here. We could perhaps see a leg up in yields if we do get a resolution on the debt ceiling. So we're cautious here, but I think the broader trend for the remainder of the year is going to be tightening credit conditions, which would mean that yields should start to gradually decline over the remainder of the year.
Well, Luke, you're looking for a move, 280 on a 10-year by year end. Is that still the move you're looking for, Luke?
Yeah, I'm happy with that. Maybe, 280, 290. It'll be below 3. That's the big call, I guess. And I kind of agree with your other guest here today that we're in a range. We're at the bottom of that range. The market will trade it and we'll move wider and higher in terms of yields in the short term, I'm sure, if we get past the debt ceiling. But that doesn't get away from that recession still hitting us in the second half of the year. And even if it's not a recession in the purest sense of the term, it could feel like it as nominal growth starts to come down, revenues get hit, and company profitability could be actually quite hard to come by as we go through the second half of 2023. So, yes.
Well, especially when nominal growth has been so high for so long. A sub-3 285 call makes sense if you're expecting a severe slowdown. Now, Subhadra, I want to go back to your recession call in 2024. You made that about a year or so ago, Subhadra. How are things panning out to what you expected?
Absolutely. It's pretty much going as our economists had penciled in and expected. Our economists also have the unemployment rate around 4% for the end of the year, not 4.5%. So broadly speaking, I think the labor market is still relatively strong and resilient. Growth has been relatively strong as well. So in this sort of context, at least as of now, where corporate profit margins are still relatively healthy. So I think for the most part, most of the metrics that we had penciled in are tracking as we had expected. So I think we're still looking towards a early 2024 recession. Really what brings that timeline forward is if we do see a tightening of credit conditions, if the banking sector comes under a lot of pressure. We got the senior loan officer survey this week. I mean, loan demand is starting to decline. I think the tightening of credit conditions could pull forward that timeline for recession to later this year, as Luke has penciled in. For now, we're still holding on to our early 2024 call for a recession.
That move in claims notable this week, that's for sure. Your equity market right now positive 0.26% on the S&P. We're about 20 minutes out from the opening bow. Subhadra Japa, Luke Hickmore are going to stick with us. Let's get you some movers. We can get you some stocks ahead of the open. Here's Abby.
John, let's start out with the shares of Tesla. Those investors like the idea that they're going to get potentially more attention from CEO Elon Musk. This, of course, on the news that Twitter is going to have a new full-time CEO in about 6 weeks. And we did, of course, just have that breaking news that the Washington Post is reporting that it will be Linda Yaccarino, the chairman of advertising and partnerships over at NBC Universal. She's been there for more than 10 years. Making her an interesting choice is she could have political implications of making the Twitter platform more neutral as opposed to the way that it could be viewed right now in terms of a little bit of, I guess, conservative leaning. I don't know. Maybe I'm getting into hot water here, but she would be an interesting choice. And Ella Irwin, who also had been floated, it seems as though perhaps she's not getting the post. PacWest up a little bit today after dropping huge yesterday on last week's fall in deposits of about 10%. And then finally, Fox down 2.4%. We do have Wells Fargo downgrading shares to an equal weight from an overweight after earnings earlier this week, plus strategic uncertainty probably having to do with lawsuit situations, ongoing lawsuit situations not related to Dominion, and then, of course, the exit of Tucker Carlson and his announcement that he's going to be doing a show on Twitter.
Abby, thank you, putting some stories together for us. Pac West, still half the level, less than half the level it was at just a couple of Mondays ago. That one just cannot get up off the mat. Your equity market right now positive, just about. Coming up on the program, a June hike back in play.
I would have thought a pause in March would have made sense. A lot of humility is in order, and we might need, additional hikes. That's certainly a possibility.
Fed Governor Michelle Bowman putting rate hikes back on the table. That conversation up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Inflation is the big problem.
All of these central banks have shifted to focusing only on concurrent data.
Inflation, that's what matters.
At some point, they need to make the shift because they're waiting for these lags and it doesn't work.
They're now moving towards a pause.
They could pause here.
I do think we're in pause territory.
Pause and let's wait.
I don't know how much of a difference 25 basis points makes at this point.
We do think they're going to pause.
The Fed is heading towards a pause. That's the growing consensus on Wall Street. Chairman Powell fueling those bets in his latest news conference.
If you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there.
But now another Fed official suggesting more hikes could be in the pipeline. Governor Michelle Bowman pouring cold water all over hopes for a pause, saying this: should inflation remain high and the labor market remain tight, additional monetary policy tightening will likely be appropriate to attain a sufficiently restrictive stance. For more, let's get to Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. Well, it is not just what you quoted her saying there, but what Michelle Bowman went on to say that really is significant. It seems there's quite a bit of disappointment at the Fed of the CPI numbers we just got. Bowman said inflation, quote, remains much too high, and measures of core inflation have remained persistently elevated with declining unemployment and ongoing wage growth. She said, the numbers that came out last week have not provided consistent evidence that inflation is on a downward path. So in other words, she's ready, perhaps, to raise rates again if we get the same numbers in June for the May in CPI as we did for April. And it's significant because Michelle Bowman is considered one of the more centrist governors and one who is perhaps most likely to take her cues from the chair. So if she's suggesting that it is on the table, then that is probably the case for the rest of the Fed as well.
And so is the next inflation print make or break, Mike McKee, from your standpoint, based on what we're learning from Fed officials?
Well, it'll be what they say, the totality of evidence. And we do have another CPI report, as you say. We also have a PCE report, which is their indicator at the end of this month. And so those two combined with the labor market report we get at the beginning of June, those will be make or break. And I expect we'll hear from other governors and Fed bank presidents who are going to suggest that, yeah, we're not necessarily done yet. This could turn into yet one more hike if we don't see the numbers between now and then that we're looking for.
And then we'll just price in even more cuts after that. Mike McKee, thank you, buddy. Always great to catch up with Mike. Subhadra Rajappa, Luke Hickmore, with us to weigh in on this. Subhadra, do you sense that Governor Bauman might have some company, like Mike McKee suggested?
Yeah, absolutely. I think that the way market participants look at Fed policy action, they think of it as either monotonically increasing or monotonically decreasing. They don't really have a scenario penciled in where the Fed might pause and then have to hike again because of inflation. This is a very unique situation where inflation is also not monotonically decreasing. It could be in fits and starts. We do see a rise in inflation when these sort of regional banking issues subside. Then will the Fed hike again? It's unclear. And the case is not very well defined if they should pause and stay on hold for the remainder of the year if inflation actually starts to tick up. So I think that there's definitely a very underpriced risk in the bond market is for a Fed pause and then the Fed resuming hikes later on this year.
I just don't see people changing their minds. Two voices that I respect with two different opinions. Bank of America, Mike Gapin, Citi, Andrew Hollenhorst. Bank of America's Mike Gapin said pause in June. Inflation data comes out, says pause in June. Citi said hike in June. Inflation comes out, they still say hike in June. Luke Hickman, what's going to change people's minds?
So I think data dependent, right? And as Mike said, it's the totality of what's going to be going along. And today's UMISH is just in the mix as well about what consumers are thinking about inflation going forward. All of the data that we get between here and the Fed meeting is going to make a difference to people's views. It may not make any difference to the Fed, and in a way, I'm not sure it really matters for markets. If we get one more and then stop, I'm just as relaxed about that as I am as if we stop now and then start cutting sooner or later in the year. I think the pace of change has really picked up in this cycle. Really quick hiking, probably a short pause, and a quick cutting as well through latter part of this year, early part of next year.
Well, Luke, you talked about the totality of the data, so let's talk about it. Not CPI, not payrolls, banks. This is your line on some of the banks. Bank equities. Avoid bank equity perhaps for the next couple of years. Luke, that bad?
Yeah, I think it could be. The provisioning's good, the capitalization's good, none of that matters. Profitability is going to come under pressure. There's hundreds of years of history of going back at a crisis, looking what the regulator does, how tough do they get? The last one in the GFC, they got really tough. I don't expect it to be that bad this time, but what they will do is hit them in their pocket directly, make deposits more expensive, hit their margins, and it makes it hard for the banks to rebuild capital when things are difficult. So I really struggle to see how it's going to be an enticing place to be for equity investors for the next couple of years until we can get past this next kind of recession slowdown, a wave or potentially increase in non-performing loans as we go through a downturn and get to the other side of it.
And could well make it difficult to lend as well, Subhadra. Yeah, so with that in mind, just to put a bow on it, final word, Subhadra, how much of this banking stress is going to do the hard work for this Fed?
So we think it's about maybe 50 to 75 basis points of hikes is what this banking crisis is amounting to, and that's probably why the Fed is thinking about pausing a lot sooner than people had anticipated earlier on this year. But I completely agree with Luke. I think it's going to be a tightening of credit conditions. We've seen this playbook before. But it's also going to be a story of haves and have-nots, where some of the larger banks that are seeing deposit inflows are well capitalized, have a lot more liquidity, are going to be in a better position in this time around, as opposed to some of the smaller regional banks that not only are being burdened with a lot of regulation, but also don't have the same capital and liquidity in place, and are seeing and continuing to see deposit outflows. So it's going to be very interesting how this credit crunch plays out in the next several months.
Spatra Japa, Luke Hickmore, to the two of you, two of the very best. Thank you. Thanks for being with us. I get the call. It's just happening much more slowly than we anticipated. We've hiked rates from 0 through 5 very quickly in a little more than 12 months. I think a lot of people thought we'd do more damage to the labour market than we have. Unemployment's still in and around 3.5%. Banking stress the last couple of months. I think a lot of people thought bang, event. We'd see it through tighter lending standards in the slews. Didn't see it in a major way. You're seeing it, but a continuation of the trend that was already there. It's just taking a lot longer than some people thought it would. Coming up on this programme, the morning calls in later. This market is heading for a double-digit correction. That's the call from Chris Harvey of Wells Fargo. That conversation 7 minutes away.
We can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Minutes away from the beginning of the final trading day of the week. Equity futures positive by 0.3%. Let's get you some morning calls quickly. Here's your first one. Wells Fargo downgrading Fox to equal weight, seeing limited upside with no catalyst on the horizon. Your second call from Argus downgrading Estee Lauder to hold, expecting a slow recovery in China to keep inventories elevated. And finally, Wolf Research downgrading Disney to peer perform, warning that subscriber numbers might not meet the company's targets. That stock just about positive 0.2%. Coming up, preparing for a correction. Chris Harvey of Wells Fargo expecting political and economic risks to start weighing on equities. That conversation up next, your opening bout, just around the corner.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe. Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Seconds away from the start of the final trading day of the week, live from New York City this morning. Good morning. Equity futures just about positive by 0.3%, just about negative on the week through Thursday at the close, and looking to take a bite out of those losses at the opening bell. From New York City, there is your opening bell. Switch at the board and get to the bond market. Yields look like this, just a bit higher, a touch, by not even a basis point. Your 10-year, just south of 340, 339.36, a break of 109 on euro dollar. Some euro weakness starts to get interesting this week. A break of 109 to 108.89. We're negative 0.25%. Still some Fed officials out there talking up rate hikes, but will the data go the other way in the next few months in Europe? With everyone on the other side of the boat seemingly focused on the United States, is Europe something you need to keep an eye on? Elsewhere, looking at crude, WTI, $71.40. We're positive 0.76% there. About 30 seconds into the session, equities positive by, let's call it 0.25%, quarter of 1% higher on the Nasdaq, up by 0.2%. One stock to watch at the open is Fox. The company's ad revenue boost failing to offset legal costs and the fallout from Tucker Carlson's exit. The CEO saying this: there's no change to our strategy. We're adjusting our programming and lineup, and that's what we'll continue to do. Abby has more. Hey, Abby.
Hey, John. Well, this is an interesting one because they actually put up a pretty decent quarter, especially relative to the peers. Top line growth of about 18%. Now, on the bottom line, though, profits shrunk by about 21%. That has everything to do with that Dominion lawsuit that they did settle a few weeks ago. They were also unfazed by a more difficult advertising backdrop, in part because of the Super Bowl. We do, of course, though, today have Wells Fargo downgrading shares, and the stock is down for a fourth day in a row. In fact, on the quarter, it's down about 10%. Its worst quarter in about a year or so. So there's this perception around, I would say, so many different issues around Fox. That lawsuit was settled. They have another one that they are contending with, I think, that they're planning on fighting. And then, of course, there was the exit, the firing of Tucker Carlson not so long ago. Tucker Carlson has come back out saying that he plans on launching his own show on Twitter. So the idea of contention or strife perhaps weighing on these shares, the idea that there could be an unknown. But when you actually take a look at the numbers, yes, we do have that lawsuit that weighed on the profits for the past quarter, but it's not clear if that's going to be the case. I think most analysts, in fact, would say that the fundamental business for Fox is pretty solid in terms of the revenue that they have put up, and that they may be able to do that. Plus, they have Tubi, which apparently is doing well. So lots of different mixed signals to take a look at around Fox, but take note of the fact that, again, down for a fourth day in a row, and on the quarter down 10%, the worst quarter going back about a year or so, John.
That's an ugly quarter, Abby. Thanks for that. Not too much drama on the intraday price this morning with negative 0.5%, and about 50 cents. This is where the drama's been, the financials. The regional banks looking to stabilise following another volatile week of trading. PacWest plunging 22% on Thursday after reporting its most recent deposit results. Kaylee Lyons has been on top of this for us over the last couple of months. Morning, Kaylee.
Good morning, John. Well, on those deposit results, they said that last week deposits dropped $9.5 billion after the news that the company was exploring its strategic options. Big drop in the stock yesterday and really struggling to gain traction on this Friday morning session. The stock has been fluctuating between gains and losses really since pre-market trading opened. Right now, up about 1%. We'll see if it sticks. And remember, this is still a stock that remains down the better part of 80% on a year-to-date basis and is still set for a third consecutive week of losses. As for some of the other regional banks we've been paying attention to, Western Alliance, KeyCorp, they both were more insulated from some of that selling pressure yesterday, fell between 2 and 2.5%. And this morning they also are positive, but only to the tune of about 1% at the moment. Interesting to see that actually it is the larger banks that are underperforming slightly in this session. JP Morgan, Bank of America, and Citi all essentially unchanged on the day. And we do know that it is the bigger banks that the FDIC would like to impose that special assessment fees on. We got that proposal yesterday. They got a big hole to fill in the deposit insurance fund, and they want to put the big guys on the hook for it, John. We'll see if we get more regulatory clarity in the coming week. There's going to be 2 key hearings in the Senate Banking Committee next week, one with the executives from the failed Silicon Valley Bank and Signature Bank, another with Marty Grunberg from the FDIC, Fed Vice Chair Michael Barr, and other regulators next Thursday. It's going to be another big week for banking news, I would imagine, John.
Kelly, do you get the sense that we're taking our eye off the ball, just a little bit distracted by the debt ceiling stuff when this is still ongoing?
Yeah, it's a really good question because obviously that is the primary objective of Congress at the moment, is to get that debt ceiling lifted. And I would note, John, that it is now more than 2 months after the failures of these banks, and they're just now getting to the testimony of these executives. It doesn't seem like there is much forward progress to be made on some kind of congressional legislative action on the banks at the moment. It may be something that has to come just from the regulators themselves, John.
Kelly, thank you. 2 months. Unbelievable. I know everyone loves to hate the 08 comparison, so let's love to hate this from Michael Hartnett at Bank of America. Here's the line from him this morning. The S&P 500 up 11%, the Nasdaq up 15% in the 2 months after Bear Stearns failed in March 2008. The S&P 500 up 7%, the Nasdaq up 10% in the 2 months after SVB failed too. There's a call in his note this morning I'll return to and catch up with Chris Harvey about of Wells Fargo in just a moment. I wanted to get one more stock. Tesla, getting a lift after raising prices on most of their US vehicles. The company's third round of changes in less than a month. A tweet from Tesla CEO Elon Musk also boosting sentiment this morning, writing the following: excited to announce that I've hired a new CEO for Twitter. She will be starting in 6 weeks. Ed Ludlow joins us on the West Coast now. Now, Ed, I've got this from NBC Universal, their latest press release this morning. Linda Yasarino to leave NBC Universal. Are we just waiting for Twitter to say Linda Yasarino is joining Twitter?
Yes, we are just waiting for someone to say that Linda Yaccarino is joining Twitter. NBC Universal says her departure is effective immediately. The Wall Street Journal reported on Thursday that Elon Musk has selected Yaccarino as the next CEO of Twitter. The Washington Post and Puck have also reported, citing sources, that she is the new CEO of Twitter. That's supporting Tesla shares as it did in Thursday's session, with the idea that Elon Musk will be more focused on his other companies outside of Twitter, although he did say in that tweet that you showed, John, that he will be focused on the technical and product side of Twitter as CTO. 2 other big factors playing out in Tesla shares this Friday. The first, as you noted, raising prices here in the US more modestly by $250 on the Model Y, more significantly by around $1,000 on Model S, but the base price nowhere near where it was to start the year. We'd also note a recall of 1.1 million vehicles in China. It is a soft recall. They've identified an issue with regenerative braking that will be fixed via over-the-air update, so not a recall in the traditional sense. But either way, stock up 2.6%, highest level in around 3 weeks on Tesla. And again, we can use it as a somewhat of a proxy for Twitter, the private company.
Reasons to like it this morning. Ed, thank you. On the West Coast, reasons to like it for Dan Ives of Wedbush, who has liked this company for a while. He says this will benefit shares of Tesla, writing the following: Musk's reign as CEO of Twitter has finally come to an end, and thus will be a positive for Tesla stock, starting to finally remove this lingering arbitrage from the story. We maintain our outperform rating and ultimately view this as a major step forward. Tesla this morning trading positively. As for the equity market, the broader equity market, well, here's a call from Chris Harvey at Wells Fargo, sounding the alarm on equities, saying this: market gains continue to be dominated by Uber caps, masking the fact that 48% of S&P 500 stocks are down year to date. We remain near-term bearish as the focus shifts from Q1 earnings to a macro fraud with economic and political risk. Chris Harvey of Wells Fargo joins us right now. Chris, buddy, always great to catch up with you, sir. Let's start there with that call. Can you tell me, when you speak to clients, are they more concerned about the next 3 months or what's coming in 2024?
I would say they're more concerned about what's happening today, tomorrow, in the very short term. They're skipping over what's going to happen over the next 3, 4, 5 months, and then they're looking at 2024. It's one of the oddest things I've seen in a while. And the other thing that clients are doing is they're telling me they're bearish, but when you walk down the bearish scenarios, they dismiss every single one. Debt ceiling, that'll get resolved. Student loans, not big enough, don't worry about that. Earnings season, better than expected. Fed's done. Banking situation, that's a one-off. And so it's very, very odd that what you're seeing is people discounting, or people just looking very short-term, very long-term, and discounting the macro to a large degree.
So, Chris, what's behind your call then for a correction of what, 5 to 10% on the S&P?
Yep. Yeah, so coming into this year, our year-end price target is 4,200. It's 20 times 210 number. We more or less got there a couple days ago, a couple weeks ago. I think we got to 41.80 and change intraday, right? Much of what we thought was going to play out has already played out. And now we had a better than expected earnings season, but that's over. And now we're going to turn to the macro, and the macro is not pretty. We're going to be playing brinkmanship with the debt ceiling. I think it'll get done, but it's not that it will get done, it's how it will get done. And we'll probably push this to the 11th hour because the GOP wants spending cuts. And this is one of the few things where they have leverage. So it's in their best incentive to push this to the end. That's not going to be great for sentiment. That's not going to be great for the economy. The other thing is, at some point, we're going to get a decision on student loan and student loan forgiveness. We think the odds favor students have to pay things back and there won't be forgiveness. That's going to be a significant hit, or potentially could be a significant hit to sentiment and also to spending. And then we can roll down a number of things. But when we look at the longer term, we just don't see. We have a 20 multiple at this point in time. We need EPS to go a lot higher to get pretty bullish, and we just don't see that at this point in time.
Chris, I think you'd understand, recognize, sympathize maybe even with people who have sat here and said, I've heard so much of this before. I've heard it quarter after a decent quarter of earnings that we're going to see some weakness in the economic data. And at the moment, Chris, what they now face is whether there is this tradable window, so to speak, between a Fed pause, if this is indeed a Fed pause, and the economic weakness that really hasn't asserted itself just yet. Is there a window there, and how big is it?
Right. Yeah, so John, a couple of things there. It always takes longer for things to play out on Main Street than it does on Wall Street. On Wall Street, sometimes it happens in minutes, hours, days. On Main Street, it takes weeks, months, quarters. So it'll take a while for some of the issues in the banking sector to filter through. It'll take a while. It's been taking a while for monetary policy to take hatch, but it's going to take hatch. We did have a better than expected earnings season, but one of the things that we've noticed is sales growth isn't great. When we look at the consumer's okay, but it's the consumer's behavior that we're worried about. If you look at real retail sales, 4 of the last 5 months, you've had negative real retail sales. You had 1 month where it was fantastic, but that's not a great trend. If you keep looking at the TV, you keep looking at the headlines, these are not positive for sentiment. So we do think in the second half of this year is when things start to unfold and when the market begins to react to some of the negative news, and especially on the macro side.
Chris, I'd love your reaction to what Michael Hartner of Bank of America had to say earlier this morning. I shared a piece of his quote. I'll share the full part of his note right now. Just this little snippet. SPX up 11%, NASDAQ up 15% in the 2 months after Bear Stearns failed back in March 08. S&P 500 up 7%, NASDAQ up 10% in the 2 months after SVB has gone under. He says recession will crack credit and tech just as it did back in 2008. Goes on to say, actually, that a negative payroll print would likely be a buy catalyst for cyclicals in 23. But can we focus on credit and tech, just on the tech piece of that? Chris, when you talk about 5 to 10% corrections and the prospect of maybe clients needing to de-risk, What does de-risking look like to you? What are you advocating for? Is it trim tech, trim cyclicals? What is it?
So what it means to us is you want to trim risk, so your higher risk positions, also your more cyclical positions. In addition to that, we've said this all year long, you want to take value off the table because we're going to have some sort of economic impact. One of the things that, and this is a little bit goes against the grain, is the Uber caps have done really well year to date. We're looking at the Uber caps, and when we talk about Uber caps, Russell has a top 50 index that we use. And if you look at that index, the premium that you're paying for that index is only 10–15%. And you're getting pretty stable earnings and pretty stable growth. So we think the Uber caps will still outperform in the short term, maybe because everything goes down and they go down less. But really what we want to avoid, what we want to take off the table, it's risk, it's cyclicality, it's value.
Equities right now doing okay, positive 0.3%. Chris, stick with us. I want a final word from you on the banks, if that's okay, because coming up, the big banks face some big bills.
The regional banks have been under some stress. I will be meeting with senior bankers next week when I get back.
That conversation up next.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics that have made them vulnerable. The amount that they're having to pay for deposits is rising, and in many cases their investments are at lower interest and their stock prices are coming under pressure. I will be meeting with senior bankers next week when I get back.
Secretary Yellen said to meet with bank executives for the first time in a long time. This coming as the FDIC prepares to hit the biggest lenders with some big bills. The government's deposit insurance fund needs to refill to the tune of nearly $16 billion, and they want the big banks on the hook. Jefferies expecting that to translate into a 2.5% annual hit on EPS across the banks they cover. Shonali Basak has more. Hey, Shonali.
Hey, John, let's talk about that Jefferies note for a minute because the specificity here is interesting. Remembering that only about 113 banks are supposed to cover this special assessment for the FDIC to cover those uninsured deposits from the systemic risk exemption, about 48 of those firms out of 113 are paying 95% of that special assessment. Now, these are banks of asset sizes of $50 billion or more. To get from $15 billion to $50 billion to JP Morgan is a wide range of banks still, even among a smaller number of banks. So those smaller banks, as a percentage of their revenue, that hit would be larger. So again, bigger banks are impacted, but the smallest of those big banks are going to feel the pain the most. And you heard that kind of reflected here by the Jamie Dimons of the world here, that the smaller, mid-sized banks, everything outside of the G-SIFIs really, are still bearing a lot of compliance costs. And again, this is for the special assessment just for Signature as well as Silicon Valley Bank. This does not include the costs tied to First Republic.
Is it possible, Shonali, they pass that cost on to us somehow?
Yes, I mean, absolutely, because remember, this cost is not just the special assessment from the FDIC. There's a sense here that as the FDIC really morphs in terms of figuring out how to fill the holes from the banking stresses overall, there's a sense here that the banks will have to pay more in fees just overall, especially the biggest of the big. And then there's a cost tied to any stricter compliance when you look at what is expected from the Federal Reserve and any future regulations as well. Those costs will ultimately come out of our pockets one day, John.
Shonali, can't wait. Shonali Basak with the latest. Thank you. Chris Harvey back with us for a final word. Hey, Chris, I really wanted your insight on this. Shonali's just gone through a bunch of reasons for why I don't really want to own bank stocks, why people at home right now don't want to touch them. Chris, can you give us a good reason why we should own that sector?
So we have a neutral on the banking sector. What we're seeing in the banking sector is we are seeing more value being created. The question is, when can you exploit that? And we think the banking sector has to work through a few things. And one of the things that was mentioned earlier is EPS and EPS coming down. We think EPS numbers probably need to reset a little bit lower. But we're getting to a point where maybe in the middle of the summer, maybe over the next couple months, if we do get that sell-off, if we do get that reset, then banks look a lot more attractive. But you're beginning to see for a select number, a lot more value being uncovered and a lot more value being built. We just think it's not quite time to go overweight the group just yet.
Chris, I understand the sensitivity around your role not to name names, but can you describe features? Are you speaking more towards the regionals where we're creating immense value given the crash we've seen in some of these names? Is it the large cap names? What kind of banks are they?
Yeah. So it really depends. So I'll give you a non-answer, but I'll try not to give you a non-answer. It really depends on who you are. Right, if you look up the capitalization, there are a lot of really solid banks up there. They're trading at good valuations, and they appear to be pretty good risk reward. So if you're a little bit more conservative, that's probably where you want to go fishing. If you're going to go down and you want to be a little bit more aggressive, there are a number of banks that have some good deposit bases, that have good valuations, that have very good credit management, and I think longer term, you know, they've proven that cycle in, cycle out, and now that all the banks are on sale, they look a lot more attractive. But you're right, I can't go into individual ones, but really what you want to do is you want to look for those ones that have proven themselves over different cycles, managing credit and credit risk, and have done a good job, and I'll just leave it at that.
Chris, I'll let you leave it right there. Chris Harvey, thank you, sir. Wonderful to get your perspective. Chris Harvey there of Wells Fargo, looking for that correction on the S&P 500, somewhere perhaps anywhere between 5 to 10% on the S&P downside. Plenty of reasons for it. There were plenty of reasons for it a month ago, 2 months ago, 3 months ago. Remember early March, SVB failing. Stocks rallied through March, rallied through April. We'll see, but it's been frustrating for a lot of the bearish calls that just keep getting pushed out and pushed out a little bit more. On the S&P, about 22 minutes into the session, we are positive 0.2%. On the S&P, on the NASDAQ, we're positive by 0.1%. One name to watch yesterday was PacWest. PacWest crashed by 22.7%. That's a major move lower. You may hate the word crash, but ultimately we're talking about big moves in percentage terms. When you look at dollar terms, this name was a $10 name 2 Mondays ago at the opening bell. It moved lower to where we are now at about 470. Remember the low in the previous week had a 2-handle briefly on the 4th of May at about 250. Recovered since then, but just struggling. Half of where it was 2 Mondays ago and just struggling, sitting there at 474 and taking a beating yesterday after revealing that deposits once again rolled over last week. Let's get you some sector price action. We can do that now with Abby. Hey, Abby.
Hey, John. Well, it's pretty interesting because we have the S&P 500 barely higher, up 0.2%, but you have 10 of the 11 sectors higher, but not by a huge amount. Utilities leading the way, so a little bit of defense there, especially given the fact that yields aren't doing all that much. So it's not really an opposite play as it might be typically. Information technology down ever so slightly. So a broad-based small gain for the S&P 500. There's one stock I want to take a look at. I know we normally look at sectors here, so this would be the consumer discretionary sector. Amazon.com yesterday up for an 8th day in a row, the longest winning streak since 2018. Right now down on the day, but let's see whether or not it happens. This play for safety showing up in big tech, John.
It's quite a move. Tech looking resilient. Abby, thank you, and performing really well year to date against expectations after taking a beating through 2022. Let's try and get you to the weekend. Up next, here's your trading diary.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
26 minutes into the session. On the session, up by just 0.2%. On the week now, positive just by 0.1%. That's the price action. Here's the trading diary coming up. Top of the hour, UMich Consumer Sentiment Survey, Fed speak through the day. Daily Bullard, Jefferson on deck. Looking ahead to next week, Tuesday, retail sales, followed by the Senate Banking Committee holding a hearing on SVB. Plus Tesla kicking off its annual shareholder meeting, and finally rounding out the week with Biden attending the G7 Leaders Summit in Hiroshima. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.